Good morning, friends. Okay, let's continue with the discussion. Today, we're going to start with derivatives chapter. I'll set the initial context and then we start going through various areas. Initially, we'll go very slow, and then as we understand terms, as we understand concepts, we'll quickly start going through the various parts. As such, it should have been three sub chapters. Like security valuation had various areas like an equity valuation, bond valuation. Derivatives, we have totally in my material 11 parts, but broadly three parts. One is called futures, second is called options, and third is called other miscellaneous areas. So we are going to learn first about futures, then options, and then miscellaneous areas. Let's first understand what is derivative. A derivative is something which basically derives its value from an underlying asset. For example, if I ask what is the price of a TCS share, the share is quoted in the market and the value of TCS share is whatever it is quoted in the market. Its value depends on itself only. The TCS, whatever is the share price, it's not a derivative instrument, it is a normal asset class. What is the value of a car? Whatever is the worth of that car or value of the car is derived from the benefit which the car gives. Car is providing you certain benefits, and based on that the values arrived. So point is, there are certain asset classes which have value on their own because they give certain benefits to the user. A car gives the benefit of taking you to some place, you're coming back. A building gives you a benefit of a rental income or capital appreciation. A share gives you a benefit of dividend income as well as certain price appreciation. Like that, we have another set of asset class which are called derivative. They do not give any benefit on a standalone basis. Derivative instrument cannot give you a rental income, cannot give you a dividend income, cannot take you from one place to another place. These assets do not have any value on a standalone basis. An example, I want to go for an IPL match. When I want to go for an IPL match, I wanted to go and buy the ticket. The ticket is a real asset. The ticket is a real asset. You show the ticket, you can get into the stadium, watch the match. Assuming the tickets are not available in the counter, and now you need still the tickets are not available in the counter, but I still need the tickets. The ticket price is 500 rupees in the counter earlier. So I was thinking, how will I get this ticket? Because if I have the ticket, I'll be given entry into the match. Without ticket, no entry into the match. So ticket is a real asset. It gives you the flexibility to enter the stadium, that with the ticket. Now I go to an influential person. He gives me a letter which gives me an option. Option is, I go and give this letter to the ticket counter, and if I show the letter, he will give me 5 tickets. I have to pay 500 rupees per ticket. 5 tickets into 500 rupees per ticket. With that letter, I can get 5 tickets from the ticket counter. You also want a ticket, you do not have the letter. What can you do? You can go to an area called gray market. Gray market is place where the buying and selling are done by people. So let's assume I have the letter. With the letter, I can get 5 tickets into 500 rupees. You will go to the gray market and buy 5 tickets into only 200 rupees in the gray market. In the gray market, it's only at 200 rupees today. If in the gray market it is at 200 rupees, that letter has no utility. That letter has no utility because I will go to the gray market, buy the ticket at 5 into 200. Assuming in the gray market it becomes 5 into 600. Now the letter will derive its value from the underlying asset which is called gray market price. As the price changes in the gray market, the letter will have more value, less value, no value, more value, less value, no value. If with the letter you suddenly enter the stadium, they'll throw you out because the letter has zero utility in the stadium. Before the match, with the letter, you can buy 5 tickets from the counter. If you show the letter to them, they will give you 5 tickets. Whether you want to use the letter or not the letter, it all depends on an underlying asset. What is the underlying asset? Gray market price. Gray market price. If the gray market price starts going up, the letter becomes more and more useful. The gray market price starts going down, the letter becomes less useful or useless also. It can become useless also. This is a typical example of a derivative instrument. A derivative instrument is one which derives a value from some underlying asset, let's assume my kid wanted to buy chocolates he want to buy after a month, and the shopkeeper gives a coupon to him. The coupon says, you show the coupon to us, we will give you one dairy milk, you have to pay 10 rupees. That is the coupon. The coupon will say, give the coupon, get dairy milk at 10 rupees. The prices of dairy milk changes, let's assume, on a daily basis. 10 can become 11, 12, 13, 15, 14, 10, 9, 8, 7. So that coupon will have a worth if the dairy milk price in the market is less than 10 rupees, if more than 10 rupees. If it's more than 10 rupees, he will use that coupon and buy it at 10 rupees. If it is less than 10, he may not use the coupon. So the derivative basically derives its value from an underlying asset. Practical world, anything can be an underlying asset. Underlying asset has certain cash flows, has certain allied benefits. When I say allied benefits, car you can use it. A person can buy a car. He may say, I buy a car derivative. There's nothing like a car derivative, but you can buy a car derivative, let's assume. With the car derivative, you cannot say, take me from place A to place B. Car can only take you from place A to place B. Shares can only give you dividend income. Bonds can only give you interest income. Property can only give you rental income. Futures can never give any of these benefits. But still, there are reasons. The derivatives cannot give you any of this, but still there are certain benefits with the derivative instrument. So a derivative is one which derives its value from an underlying asset. We have technically four types of derivative. One is called forward, second is called future, third is called option, fourth is called swaps. These are the four types of derivative instrument we are going to analyze. Forwards and futures are almost same, where there is little bit of change in its functionality. You will understand as we proceed. Forward is learnt in Forex chapter, futures is learnt in this chapter, options is learnt in this chapter, swaps is learnt in a chapter called interest rate risk management. We have four types of derivative instrument. In that, the first instrument is futures. We are going to learn about futures. Now, what is futures? Let's understand. Futures means arriving out a future value for any asset. Let's assume spot and future. There are two prices which I can give for any asset class. There's a spot price and there is a future price. Gold. Today, let's assume 10,000 per gram. Just an imaginary say 10,000 per gram. Somebody asks me, what is gold going to quote on December 31? Somebody says it is 11,000 rupees. How you get 11,000 and all, we'll see later. Somebody wants to know what will be the gold price on March 31, 11,500. What will be the price of gold on June 30, 12,000 rupees? Futures basically mean arriving at a future value of any asset class. In practical world, if you look at today, TCS share price is 3106. This is the share price of TCS today, 3106. In the market, we have something called as futures. 25th November, the TCS price is 3,111. I'm expecting that on 25th November, it will be at 3,111. How do we arrive at value and all? We'll see later. This is my expectation, not my expectation of lakhs of people. Market is giving a value of 3,111. Similarly, somebody said, no, don't give me 25th November, give me December 30, 3132. December 30 is 3132. Somebody said, give me Jan 27, 3139. Market will give value for all these asset classes. When I was taking the previous batch, that time the values were little different, but basic concept remains the same. So, futures price and spot price. There are two types of market. One is called spot market, or cash market, where real assets are bought and sold. Real assets are bought and sold. You go to a shop, buy gold, sell gold, buy gold, sell gold. So spot market is there, otherwise called as cash market, where this gives me spot price. On the day when I did that batch, TCS price was 3786. Along with that, there is another market called futures market. Like we have a spot market, there is a futures market. In futures market, notional assets are bought and sold. Notional assets means real TCS will not be bought and sold. TCS futures, I am entering into a transaction for a future date. I'm entering into a transaction for a future date. I go to a shopkeeper and tell him that I want to buy gold on December 31, but I'll pay the money today itself. I'll pay the money today itself, but I'll buy it on December 31. Or I'll say I'll enter into a contract and I'll pay 10% money today, not full money. I'll pay 10% money, but buy gold when? December 31. He says December 31, we don't know what will be gold price. I say, no, I don't understand all this. Let us freeze the price. You decide what price you want to freeze. Let us freeze the price. This transaction is called futures. The purpose of a futures transaction is, I have a marriage at my home. Marriage is after 6 months. I need after 6 months to buy some 200 grams of gold. I do not have money today, but I want to freeze the price today. I want to freeze the price today. I do not have money today, but I want to freeze the rate. Why do I want to freeze the rate? Gold prices are extremely volatile. Unnecessarily, I'll get impacted. This is called hedging. I just want to play safe. I want to play around on the gold price, saying that gold may go up, may go down. I want to speculate something on that. There are speculation and other things which can be done. So first thing, there is a spot price, which is given by spot market. There's a futures price, which is given by the futures market. Two markets exist in the practical world. Spot market is separate, futures market is separate. Today also, if you open your demat account and apply for TCS, if you search for TCS, you'll get a TCS price, and if you search for TCS futures, you will get a TCS futures price. The broker will ask you, do you want to do only cash market? Do you want to do cash and futures market? So if you put a tick for cash and futures, both options will be there for you. If you put a tick only for cash market, only share buying and selling can be done. I buy share. Can I sell it in the futures market? No, both are not linked. They are separate market. Okay. TCS is one company or one asset. TCS future January is another asset. TCS future February is another asset. TCS futures March is another asset. It is like you have a ticket to go to a cricket match, but the ticket is for November 30 match. With that ticket, you can only go to November 30 match. You don't say I have a ticket and I want to go to November 15 match. Today I have a match and I want to go to that match. No, that is not possible. Ticket is for November 30. Go on match on November 30. Somebody can have a ticket for today. He can have a ticket for November 30 match. He can have a ticket for December 30 match. He can have a ticket for January match. Whichever ticket is available, you please go and do that. You have a November 15 ticket. I have a November 30 ticket. We cannot exchange each other. We cannot say that these are same only. Let's exchange. No, they are not same. They are different. November 15 ticket is different. November 30 different ticket is different. And the price can be different for both the matches. November 15 match, the ticket price can be different. November 30 match, the ticket price can be different. So we have different asset classes. Today, shares of TCS exist, which is, let's assume in my example, 3786. There is a TCS Feb 27, which is 3789. TCS March 27, which is 3810. TCS April 24, which is 3832. Different asset classes are there. Different values are there. Now, how are these values arrived at? Very simple. Now, write spot price, spot price, futures price. Gold today 10,000. Gold today 10,000. gold after 6 months? Question mark. Somebody wants to know what is the gold after 6 months. What is gold after 6 months? I want to know. Very simple formula. Then I'll explain the complex formula. No? Future value is equal to present value into 1 plus R power n time value of money. Future value is equal to present value into 1 plus R power n. Where did you learn all of this? In time value of money chapter at many places, at inter, at foundation, in your 12th. So future value is equal to present value into 1 plus R power n. Future value is equal to 10,000 present value. I want 6 months. So I want 6 month interest rate. I want 6 month interest rate, which is, let's assume, 4%. Just an imaginary sake, 4%. No compounding effect. Later on, you'll understand about different things on compounding. Okay, 4% is the rate of interest for 6 months. For 6 months, 4% rate of interest. What is the value you get? Live online guys, participate. What is the value you get? 10,400. 10,400. TCS price today 3,500. TCS price today 3,500. TCS after 1 month. I want to know what is TCS after 1 month. I want to know what is TCS after 2 months. I want to know what is TCS after 3 months. Three prices I want to calculate. After 1 month, after 2 months, after 3 months. This is what we are broadly doing. Rate of interest 12% per annum. 12% per annum. Future value is equal to present value into 1 plus R power n. Future value is equal to present value into 1 plus R power n. 1 month future value. 1 month future value is equal to 1 month future value is equal to, what is the present price of TCS? 3,500. 1 month rate of interest 12% for a year, 1% for a month. 1% for a month. Later on you will understand certain other things. Power as of now has no utility. Give me the answer. Three five, three five, three five, three five. TCS after 2 months, 2 months interest. TCS after 3 months, 3 month interest. Next, 3535. Any doubts on this? Any doubts on this? 2 month future value. 2 month future value. 2 month future value. 3,500 into 1 plus 2%. 2 months means 2%. 3570. 3 month future value. 3 month future value 1 plus 3% power 1. 3% power 1. 3605. How did this future value come? It has derived its value from today's price, underlying asset. You did all this calculation, surprise in the market. TCS price today, after a day only, 3,200. TCS price today, 3,200. Market price underwent a change. Stock market prices can change. Same thing again. TCS after 1 month, after 2 months, after 3 months. It's now 3,200. You let me know the answer. It's now 3,200. Price underwent a change. 3,200. Market trading happens. You will see prices changing in the market. It is not in your control. Prices will keep changing. And this happened and your prices became 3,2, 3,2, 3,264, 3,296. Clear? So this is what is happening in the stock market. As value of underlying asset changes, the value of the derivative instrument called as futures will change. Now just to give the practical angle, TCS today is November 13. TCS today is right. TCS November 13. TCS November 13 is equal to 3106. 3106. TCS November 25 is question mark. I want to know what is the TCS value on November 25. It exactly may not match our calculation, but just a point I want to explain. TCS November 25 I want to value. November 25 means another 12 days are there. Another 12 days. Rate of interest for 12 days. Let's assume 8% is the India's interest rate into 12 by 365. 8% into 12 by 365 for a 12-day period. For a 12-day period. It will be 0.26%. 0.26%. For a 12-day period, rate of interest 8% I have taken. I can argue for a 6%, 7%, any number I can take, okay? Future value is equal to November 25 future value is equal to spot 3106, rate of interest is 0.26%. 0.26%. Extra 0.26% increase has to be there. 3114, which may not match the given data, but just the concept. 3114. Practical world, the value is quoting at 3111. 3111. Our calculation says 3114. This is just a practical data for you to understand it. There is another future price which is December 30. December 30. Next. TCS December 30 question mark. How many days between November 13 and December 30? November 13 and December 30, how many days are there? 47. 17 days of November, 30 days of December. Rate of interest for 47 days. 8% into 47 by 365. 47 by 365. Point 1.03. December 30 future value. December 30 future value is equal to 3106, 1.03%. 1.03%. What's the value? I've got value in answer. 3138. Stock market is saying it is 3132. 3132. Maybe I have not taken the right interest rate in the calculation or some reason. But broadly, this is what futures is all about. At CA Inter, if somebody had told you that a question will come from time value of money, you would have got excited. But at final level, if derivative come, people think that so difficult, so difficult. There's nothing. This is now, I have done 10 questions on derivatives now. This is just one part of the derivative, futures, and we have solved 10 problems in 25 minutes. After explanation, you have done. Now, when I tell you to do the same thing in a question, you start shivering, you start thinking it is difficult, this, that. I really don't understand. This is what derivatives valuation is all about. Any doubts till this? Any doubts till this? You just need to take a spot rate, add interest on top of it, and get the futures rate. This is what derivatives is all about. Obviously, some adjustments are there. All that I will explain as we proceed. Any doubts till now? Types of futures price. There are two types of futures price. Actual futures price, which I showed you from that website. Fair futures price, which you have calculated in your notebook. In your notebook, you did some calculation. Price at which futures are quoted in the market. Price at which futures are quoted in the market. Price at which futures should be quoted in the market. Any buying, selling, hedging will always happen at actual futures price. I cannot go to the stock market or the derivatives market and say that today morning I learned derivative. My calculation says 3100. Give me TCS futures for 3100. Can't happen. In the market, if it is 3120, it will be 3120. Any buying, selling, hedging, anything can be done only at actual futures price. This is fair futures price which we compute with what, with the formula. It is like you can use Gordon's formula to calculate fair share price, compare with actual share price. You can use Walter's formula, you can use Gordon's formula, you can use your FCFE approach, you can use your step up growth model. You arrive at fair futures price. Actual futures prices given in the market, you have to do comparison. With that comparison, it can be undervalued, overvalued. You buy, sell. Any doubts till this? Now how do we arrive at value? Now for arriving at value, we use either of the two formulae. One formula is called spot price into 1 plus r power n. Another formula is called spot price into e power rt. E power rt is called continuous compounding. Practical one, all derivatives follow continuous compounding. I will explain the logic of the two formula with questions only. Okay, one formula is called 1 plus r power n. Another formula is called e power rt. 1 plus r power n, you know, that is nothing but time value of money. That's nothing but time value of money into e power rt is also time value of money formula. Let's see questions. I'll keep coming back to concepts. Let's read question number 1. Following data relate to TCS share price. Current share price of TCS 1800. Current share price of TCS 1800. 6 months future share price 1950. 6 months future share price 1950. Assuming it is possible to borrow money in the market at 12% per annum. 12% per annum. You are expected to explain the theoretical minimum price for a 6-month forward purchase and explain arbitrage opportunity. Explain arbitrage opportunity. Basic information is there. Study material second question. We are going to directly use theoretical price of a what? 6-month forward purchase. Theoretical price is fair futures price. Future price. Which month they want the price? I want participation. Which month they want the price? Live online guys, you keep typing it. It's okay. 6-month price I want. I want a price for a 6-month period. Now write fair futures price is equal to spot price into 1 plus r power n. Spot price into 1 plus r power n. Spot price into 1 plus r power n. What is the spot price today? Leave 2 lines. Interest for 6 months. What is the use of that power n? I'll explain later. Okay. Interest for 6 months. What is the annual interest? 12% into 6 by 12. Like 13 days we did 6 by 12. 12% into 6 by 12. We get interest how much? 6%. Interest is 6% into 1 plus 6%. Power as of now it's not even there. Ignore power n for the time being. When will power n come into picture? We'll see. Into 1 plus 6%. What is the value? 4 marks done in exam. This is a 4-mark question. The first part would be a 4-mark question or a 3-mark question maybe, and there's a second part which is called derivative, which is the arbitrage. I'll explain that. Any doubts on 1908? Any doubts on 1908? Clear? You arrived at the value. And what is the value you arrived at? 1908. What is the value in the market? 1950. Any doubts till this? Any doubts till this? Now, arbitrage opportunity. Arbitrage opportunity. Arbitrage opportunity. Now write. Fair futures price, which is computed by us. Fair futures price computed by us. What is the price you calculated? 1908. Okay. Actual futures price given in question. Given in question how much? 1950. Futures in the market are overvalued. They are overvalued. How is it overvalued? You said 1908. I don't know why they are giving 1950. They are giving 1950. Futures are overvalued in stock market. Futures are overvalued in stock market. Sell in futures market. Sell in futures market. Futures are overvalued in stock market. Sell in futures market. Buy in spot market. Buy in spot market. We have to do two transaction. Why and all you'll understand as we proceed. Buy in spot market. I'm going to sell it in futures market. Buy it in spot market. To buy, I need money. To buy it in the spot market. Futures market is just a notional transaction. In spot market, you need money to buy. Take loan to buy. Take loan to buy share in spot market. Take loan to buy share in spot market. Take loan to buy it in spot market. Arbitrage gain. Arbitrage gain. Difference between FFP and AFP. Ignore the sign and all, okay? It is higher number minus the lower number. Difference between FFP and AFP. 1950, 1908. You can earn 42 rupees without any risk. I will explain how 42 will be earned in 2 minutes, but I can earn 42 rupees without any risk. 42 rupees without any risk. I'll explain again. There's a fair futures price which is given by us 1908. Actual futures price 1950. If futures overvalued, I am going to sell it in the futures market, buy it in the spot market. To buy it in the spot market, I need money. For money, I will take a loan. I took a loan, bought it in the spot market. I took a loan, bought it in the spot market. This will technically give me 42 gain. This is one part of arbitrage step. Second is detailed step, which if you get more grip, present it in exam. Otherwise, this itself ICA may award you marks. This itself is kind of sufficient. Why we are doing buying as well as selling is what I have to explain, which I'll explain in detailed step. Any doubts till this? Now, detailed step, only listen mode. Only listen mode. I don't want you to write it. You can write it also, but anyway, the printed material will have the answer. You be in listen mode, understand it fully. Okay. Day zero. Day zero. Every arbitrage strategy will have two transactions. One, you have to buy in spot market. Second, you have to do something in one in spot, buy or sell, whatever, buy or sell in spot market, buy or sell in futures market. Our strategy was very simple. Our strategy is sell in futures market, buy in spot market. You can understand that you have two demat account. One is Zerodha, another is Grow. In Zerodha, you can do only futures transaction. In Grow, you can do only spot transaction. Now, don't tell me I'll buy in Zerodha, sell in Grow. That is technically not possible. Those are two separate markets. So, you buy in one market, sell it in the same market, buy in another market, sell it in the same market. So, day zero, take loan for rupees 1800. Take loan for rupees 1800 at what is the rate of interest given in the question? 12% for 6 months. For a 6-month period, I take a loan. Detailed step, be listen mode only. I don't want you to write. You'll unnecessarily waste time writing it. Detailed step, in exam, you want to present it. Not able to think through, just write at least the base step. Okay. I took a loan. Buy share in spot market. Buy share in spot market at rupees 1,800. Enter into futures contract. It is just a contract. Futures is always just a contract that in the last day, on the last day, I will buy or sell. I'll buy. What are we doing in the futures market? Enter into futures market to sell share at what rate? 1950. 1950 after what period? 6 months. Listen, I'll explain again. Futures are overvalued. Sell at 1950, buy at 1800. Sell at 1950, buy at 1800. This is what we are doing. Sell at 1950, buy at 1800. Now don't act smart and say that I want to cancel each other. No, this is different. This is different. Buying in one market at 1800, selling in another market at 1950. Just a contract. For this, you don't get any money. You will not get any money. You will not be paying any money. Practical world, some margin is to be paid. It is just a contract. With the shopkeeper, I've entered into a contract to sell gold after 6 months. He will say, okay, you come after 6 months, give me gold, I will give you money. Today, don't ask me to give you money. Any doubts till this? Day 180, 6 months got over. I'll explain the steps again one more time once this is done. Day 180, sell in futures market at rupees 1950. Practical world, something called as net settlement will happen. All that you will understand in some time. Okay, I sell it at 1950, take 1950. Practical world, net settlement happens, but if you have already done the class, you'll understand net or gross doesn't really matter. Sell in futures market at rupees 1950, get 1950, get 1950. You are getting 1950 money. Repay loan with interest. How much you will repay? 1800 plus 6%, 1908. 1800 plus 6%, 1908. Arbitrage gain, I get 1950, I pay 1908. 42 rupees is my gain. 42 rupees is my gain. I'll explain this again. I first find whether futures are undervalued, overvalued. Undervalued, you need to buy it. Overvalued, you need to sell it. Undervalued, buy it. Overvalued, sell it. If you are buying in one market, sell it in the other market. Buying in one market, selling it in the other market. More grip will come as we proceed. Buy in one market, sell in other market. So I go ahead and do both the transaction on day 0, and on the last day opposite of this will happen. You will understand as we proceed, because net settlement I don't want to explain now itself. So I took a loan, bought the share and entered into a contract. Day 180 I sold the share. Which share did I sell? Technically the share which I bought only. I will give the share to him. Physically I got the delivery and I go to him with that share and say that you please take the share. You please take the share and give me 1950 rupees. Practical world, net settlement happens. Just understand net settlement in some time. I give the share to him. He gave me money, went happily to the bank, gave them 1908, happily sitting with 42 rupees. Happily sitting with 42 rupees. Any doubts on this? Any doubts on the concept here? So here, can I do the same thing today with TCS? Practically yes, but the only problem is our calculation said some 3108. It is 3111. Gap is only 3 rupees, and there are transaction costs. You incur brokerage, you incur some STT, you incur some stamp duty that may take away this gain. In case there is a huge variation, some 100 rupee variation, 200 rupee variation, or a 500 rupee variation is there, go ahead and do. You can make money even in the practical world. Even in the practical world, you can follow this. Only challenge in the practical world is every buy and sell has some brokerage, has some securities transaction tax, has some stamp duty. So unless the gap is huge, you will not make any money. Any doubts on this explanation? In exam, I would prefer you to write first arbitrage opportunity, You understand, time is available, confusion is not there, do the next part. Some question, the next part is compulsory to do, but I still, if you are getting confused, write at least the base part and then leave it, right? Because at least that will give you some marks in exam. Because students try to do everything and they confuse themselves. Other than that, at least base, let it write properly. Any doubts in this? Any doubts in this? Now, in the concept book, this is what I have done as of now. Arbitrage strategy, difference between fair futures price and actual futures price is the arbitrage gain. Higher number minus the lower number. AFP greater than FFP, which is what we have done. Actual futures price greater than fair futures price. Futures overvalued. Sell futures, buy spot, borrow to buy share. Borrow to buy share. Inverse will happen if you do the other way around. You will see as we do question. Any doubts till this? Can we proceed? Any doubts in this computation? Anybody has any doubts? Can we proceed? Clear? Detailed step, I leave a choice to you. Comfortable, write the detailed step. Not comfortable, write it till this arbitrage mechanism. Fair futures price is 1908, actual futures price is 1950. This would mean that futures are overvalued. We should sell in futures market, buy in spot market to exploit arbitrage opportunity. Arbitrage gain, difference between FFP and AFP, and one more item you can add here saying that you will take a loan. Clear? Detailed step you want, this is what I have done now. This is the detailed step which is presented for you. This chapter, don't try to think too much and confuse yourself, because unless you see practical derivative working, you may not understand certain points, or you unnecessarily try to complicate things. I cannot help it. Sir, why can't this be done? How will buying happen here? How will selling happen here? Whatever I am telling you, please follow for the next 6 hours, and tomorrow you ask your extra doubts and some basic doubts, concept related doubts. I have no problem, but thinking too much saying that, sir, can it happen this way, can it happen that way, at least keep it parked for some time, because unless you understand full mechanism of working, you will keep facing challenges. Can we proceed? Any doubts on this? Can we proceed? Let's come to question 2. 6-month forward price is 208.18. Borrowing rate is 8% per annum, payable with what? Monthly rest. What should be the spot price? Okay, inverse now. What should be the spot price? 6-month forward price is 208.18. Borrowing rate is 8% per annum with monthly rest. What is monthly rest? You will understand. What should be the spot price? What should be the spot price? Now write. Fair futures price is equal to spot price into 1 plus r power n. 1 plus r power n. 1 plus r power n. Spot price, we are question mark. Future price is 208 equal to spot price into, listen, it is 8% per annum. 8% per annum. What is the time period we are analyzing? 6 months. What is the rate of interest for 6 months? 8% per annum. What is the rate of interest for 6 months? 4%. 6-month interest is 8 into 6 by 12, which is 4%. Now, in this question, they are saying something called as monthly rest. Monthly rest means you have to write monthly interest in the calculation. Monthly rest is monthly compounding. I'll explain little bit about this as we proceed. Monthly rest basically means monthly you will do compounding. Monthly you will do compounding. When you take a FD from a bank will tell you quarterly compounding, monthly compounding, half yearly compounding. Ideal compounding is continuous for a derivative instrument, which ICI doesn't follow in all question. So they have said monthly rest. Monthly rest means monthly interest. Tell me what is the per month interest? 8% for a year. 0.000 0.067. 0.67 percentage will become 0.0067. 0.67 percentage. 0.67 percentage is 0.0067. If R is per month, N is number of months. R is per month, N is number of months. Power 6. Reverse work and tell me the spot price. Power 6. 6 months are there. Power 6. Reverse work and get the spot price. 0067. I get 200 as the answer. 200 is the answer I'm getting. 0067 if you use. If you increase the decimal, decrease, it can vary little bit, okay? 200 is the answer I am getting. Rate of interest given in the question is 8% per annum. Monthly interest, because monthly rate means monthly interest. Monthly interest is 8 by 12. 8 by 12, 0.67 percentage. N is number of months. N is number of month. So 0.67 is 0.0067. 0.00 percentage. 0067 power 6. Power 6. 1.0067 power 6. You have to do the calculation. You get something like 1.0409 something, and 208.18 divided by this number. 208.18 divided by this number. Some rounding of differences can be there. I'm not really bothered about the rounding of part here. Any doubts on this? Any doubts on this? I've also explained it again. Any doubts on this? Can we proceed? Next, they are saying quarterly compounding. How does the answer change? Let's understand this. Quarterly, half yearly, continuous. There are three types of compounding which can happen. Four in this question: monthly, quarterly, half yearly, and continuous. Now, quarterly compounding. Quarterly compounding. Once you are done with all the four, you will get full grip. Quarterly compounding. Fair futures price is equal to spot price into 1 plus R power N. 1 plus R power N. 208.18 equal to spot price into quarterly means what is the quarter interest? What is quarter interest? Is yearly. What was the interest? 8 into 3 by 12. Quarterly interest 8 into 3 by 12. 2%. In 6 months. In 6 months, 2 quarters are there. In 6 months, number of quarters, quarterly interest. Number of half years, half yearly interest. Number of months, monthly interest. Number of years, yearly interest. R and N should be for same time period. R and N should be for same time period. So in 6 months, I have 2 quarters. In 6 months, I have 2 quarters. In 6 months, I have 2 quarters. 2 quarters with quarterly rate. 6 months with monthly rate. 180 days with daily interest rate. If you do 180, then daily interest rate. If you do 6 months, monthly interest rate. If you do 2 quarters, quarterly interest rate. If you do 1 half year, half yearly interest rate. If you do half year, 0.5, then you have to write annual interest rate. Then you have to write annual interest rate. R and N should be for same time period. What can be the combination? You can write 8% as it is. N is 0.5 half year. 0.5 half year. You can write 4%. What is 4%? 8 into 6 by 12. 4% 1 half year. 4% 1 half year. 2% 2 quarters. 2% 2 quarters. 0.67% 6 months. Power 2. Power 2. Let me know the spot price. You will get a slightly different price now. 200, 0, not a big variation, you will get a small variation only. Bhavesh, just check your answer. Divide by 1.02, divide by 1.02. 200.09610, maybe I'll call it as 200.10. 200.10. Any doubts on this? Any doubts on this? I can do quarterly compounding, I can do half yearly compounding, I can do monthly compounding, or I can do daily or continuous compounding. What is continuous? I'll touch upon in some time. Next, half yearly compounding. Half yearly compounding. Half yearly compounding. 208.18 is equal to spot price into 1 plus r power n. Spot price into 1 plus r power n. Now half yearly means, tell me half yearly interest rate. What is half yearly interest rate? 8% into 6 by 12. 8% into 6 by 12. 1 plus power 1. In 6 months, only one half year is there. In 6 months, one half year is there. In 6 months, one half year is there. Tell me the answer. You will get a different answer, obviously. 200 point. Any doubts on this? Any doubts on this? Now, when I do my derivatives valuation, I may follow a different compounding frequency. Last question when I did, we did into 1 plus r. In that power n, I said ignore anything. So, if question says 1 month interest rate is so much, okay, I'll discuss this in some time. Let me do a few more questions and then I discuss. Any doubts till this? Any doubts? Now comes continuous. Now, right. CCRFI. CCRFI, continuous compounded risk-free rate of interest. CCRFI. Practical world, derivatives have to be valued this way only. CCRFI is the approach we follow in the practical. Par futures price is equal to spot price into e power RT. Spot price into e power RT. 208.18 spot price into e power r is 8% for a year. Yearly rate only we write here. T is half year, 0.5. T is half year. You can also write if you want. R is 4% for a half year. T is 1 half year. 2% for a quarter. T is 2 quarters. That R, T is nothing but N. N and T are same, okay? So 208.18 spot price into e power 0.04. High probability they'll give this value in the question. But if not given, we have an approach which we follow. I'll tell you to write it and then we get the answer. High probability they will give the value in the question for e power 0.04. Leave some 2-3 lines. E power 0.04 is equal to 1 plus 0.04 divided by 1 factorial. 0.04 by 1 factorial. 0.04 square by 2 factorial. 0.04 cube by 3 factorial. There is no end to it, but we will stop with that. Power 4, 4 factorial. Power 5, 5 factorial. With this itself, we will almost get the answer. 0.04 power 3 by 3 factorial. With this, almost we'll get the answer. This is 1. 0.04 by 1. 0.0016. 2 factorial is 2 into 1. 0.000, I think 4064. 3 into 2 into 1. you get a final answer of maybe 4 5 decimal. 4 5 decimal final answer. 0.04 by 1 factorial is 1. 0.04 square is 0016. Divide by 2 into 1. 0.04 cube is 0.000064 by 3 into 2 into 1. As I said, as we proceed forward, the value will become insignificant. The value is going to become insignificant. Divide by this, then we have 0016 divide by 2. Overall, we get 1.04081. Are you getting this number? 081. Any doubts on this? How many decimal you can do? Maybe 4 is sufficient. 5 is also okay. Any number. 1 plus 0.04 by 1 factorial, 0.04 square by 2 factorial, 0.04 power 3 by 3 factorial. Now, in case I want to know exactly what is the value, then my Excel can help you, or in a practical world, they may give a table value. They may give a table value for you. 0.04, the exact value is 1.04081. This should be the value. We would have approximately got to that number. If you do 4 factorial, 5, 6, 7, 8, there's no end to it. You can keep doing number of factorial. 1.04081. 04081. Any doubts on this? Reverse work and get the answer. That's all. Whatever calculation we were doing, in that write 04081. 04081. 200.02 or 01, whatever answer you get. Clear? Any doubts in this? 200.02. Clear? One question we had spot price, we got futures price. This question we had futures price, we have got spot price. In this computation, when we did, we have done different compounding frequency. Which frequency when to follow, I will explain once we are done with lot of question. Maybe if I talk now, it will be easy for few students, but some may not understand. Any doubts till this? Can we proceed? Any doubts on this? Anybody has any doubts on this? I will start picking up speed as we proceed. So let me know if at all any doubts are there. Base once is set, then we'll be in a position to handle any type of question. Any doubts? Can we proceed? Let's come to third question. Share of X Limited is currently selling for 300. Risk-free rate of interest is 0.8% per month. 3-month future is selling for 312. Develop an arbitrage strategy and show what your profit will be 3 months, assuming X Limited will not pay any dividend in the next 3 months. No dividend in the next 3 months, and they have asked us to compute or prepare something called as an arbitrage strategy. In order to decide the arbitrage strategy, I will have to first calculate fair futures price. What is the spot price in the question? How many months is the futures contract? FFP is equal to spot price into 1 plus R power n. 1 plus R power n. 1 plus R power n. What is the spot price? 300. Listen, if question specifically says per month, then you have to write monthly interest rate and n will be number of months. If specifically per month word is there, write the monthly interest. If they had said risk-free interest rate is 9.6% for a year, 9.6 into 3 by 12, write the number power 1 or no power itself, technically no power. If specifically word per month is there, we'll have to write monthly interest. So 1 plus 0.008008. N is number of months because you're writing monthly rate. If you write quarterly rate, N is number of quarter. Quarterly rate, number of quarter would have been 1 quarter only. 3 months we are doing. Power 3. Tell me the FFP. Any doubts on FFP number? 307.26. Any doubts in this? Can we proceed? Clear? Able to understand this? Any doubts in this? Now write. Arbitrage opportunity. Arbitrage opportunity. Fair futures price computed by us. How much? You don't look at the screen. You keep writing on your own. Okay. Fair futures price computed by us is how much? 307.26. Actual futures price given in question 312. 312. Futures undervalued, overvalued. Futures is at 312 in the market, and my calculation says 307. Right? Futures overvalued. Futures are overvalued in stock market. Futures are overvalued in stock market. Sell in futures market. Buy in spot market. Buy in spot market. Take loan. Take loan to buy in spot market. Take loan to buy in spot market. Take loan to buy in spot market. Arbitrage gain. Difference between FFP and AFP. Higher number minus lower number. Difference between FFP and AFP. FFP and AFP. 312 minus 307.26. How much is arbitrage gain? Any doubts on this? Now, whatever you are writing here, no, these are only detailed step. What is detailed step? This is one of the detailed step. Sell in futures market. Buy in spot market is another detailed step. Take a loan is another detailed step. That is what is going to get repeated as detailed step. Comfortable, write detailed step. Not comfortable, 90% of the answer is over. This is what you need to do. Sell in one market, buy in another market, take loan or create FD. Take loan or create FD. Any doubts in this? Any doubts in this calculation? Now, this is not needed for you. Take loan for what is the spot rate today? 300 at what rate of interest? 0.8% per month for 3 months. I have to take a loan for 300 rupees for 0.8% per month for 3 months. Buy share in spot market at rupees 300. Enter into futures market to sell it at after the sales will happen after 3 months. Contract is entered today. Sell in futures market at rupees 312. Get rupees 312. Repay loan with interest 300 plus 0.8% first month plus 0.8% second month plus 0.8% third month. It will be 307.26. 307.26, and my arbitrage gain is 312 minus 307.26 and be a very simpler area than this. Any doubts on this? Any doubts in this? Unless you complicate yourself with extra thinking, it is a fairly simple area. Any doubts on this? Can we proceed? Done? Go through question 4. Detailed step you can write if possible, not possible at your end. Confusion, because see, I have tried all possible ways. A student sits in my regular class also, still they get confused sometimes. So if you have grip, okay. No grip, please write the base steps at least. Base step, no grip, then I have lot to worry about. Base step does nothing. Buy one market, sell one market, take a loan, or create an FD, and the calculation is done. Okay. Suppose there is a futures contract on a share currently trading at how much? 1000 spot. Okay. And life of the contract is 90 days. For simplicity's sake, I'm going to take 360 days in a year. Okay. We can take 365 also. That will make a lot of issues. Okay. 90 days is the life of the contract. So spot is 1000. Future 90-day. I want to take this 1000 to the future period. Time value of money. Time value of money. Then company will pay dividend of 7.5 in 30 days. 8.5 in 60 days, 9 rupees in 90 days. Some dividend information is given in the question. Now let's understand this clearly. If I buy share, will I get dividend? Participate. If I buy share, will I get dividend? If I buy futures, can I get dividend? If I buy ticket, I can watch the match. If I buy letter, I cannot watch the match. Letter cannot give me the viewing benefit. Letter, use it and get. Use the TCS futures and get the shares of TCS. How and all it happens, you'll understand as we proceed. Okay. So here, this 1000 includes 7 rupees 50 paise, 8 rupees 50 paise, and 9 rupees. When this is month 1, this is month 2, month 3. The 1000 rupees includes these value. What you calculate here will not include this value, because dividend is not applicable for futures. Dividend is not applicable for futures. So concept says from 1000, bring it to X dividend value. This is come dividend value. How will you bring to X dividend value? By deducting, by subtracting from 1000, 750, 850, 9 rupees. Can I do direct subtraction? No, because 1000 is month 0. 7 rupees 50 paise month 1. 8 rupees 50 paise month 2. 9 rupees is month 3. Bring everything to month 0. Remove it. After you remove, fair futures price is equal to spot price into 1 plus R power n, or spot price into E power RT. This is one adjustment to be done. This one adjustment we have to do. And this is also learnt when we did security valuation, that real value of a security is always what? X dividend value is always X dividend value. So from the 1000, I have to remove this. Question has said CCRFI. CCRFI means continuous compounded risk-free rate of interest. Continuous compounded risk-free rate of interest. Now write this. Spot price 1000. Fair futures price question mark. Spot price 1000, fair futures price 1000, question mark. Includes 7.5 in M1, 8.5 in M2, 9 in M3. It includes all of this. It includes all of this. Futures obviously does not include it. Today dividend value. Today dividend value. I have to bring it to today. 7 rupees 50 paise. I have to discount. Compounding is E power RT. Discounting is dividing by E power RT. Dividing by E power RT. 7 rupee 50 paise in first month. Discounted back by 1 month. 850 in second month. Discounted back by 2 months. 9 rupee in third month. Discounted back by 3 months. You have to discount it back and get to today's value. Which approach? CCRFI. Our other approach is 1 plus R power n. 1 plus R power n is multiplication future value, division present value. So 7.5 divided by, what is the rate of interest? 12%, 1 by 12, 1 month. 12%, 1 by 12, 1 month discounting. 12%, 1 by 12, 1 month. 8 rupees 50 paise, 12%, 2 by 12, 2 by 12. Third dividend 9%, 9 rupees, 3-month discounting. We are going in the reverse direction. Okay, I am not going to spend time on e power 0.01, 02, 03. E power 0.01, 1 plus 0.01 by 1 factorial, 01 square by 2 factorial, 01 cube by 3 factorial. All that is not my headache. You can write the present value as the present value of dividend is 24.49. All put together 24.49. 24.49. 7 rupees 50 paise, 8 rupees 50 paise, 9 rupees. I have to bring it to today. To bring it to today, we have two options. One is you can go through normal discounting or continuous discounting. Any doubts on 24? Any doubts on 24? Anybody has any doubts? Calculation, I'm not bothered. Okay, I cannot spend time on calculations here. I will spend time on only concepts. I've already explained how e power 1 value is calculated. Beyond that, it's up to you. Can we proceed? Now write fair futures price is equal to adjusted spot price into e power RT. Adjusted spot price into e power RT. Or you can call it as X-Dividend share price. X-Dividend share price into e power RT. X-Dividend share price into e power RT. Okay, there is a doubt that we have to calculate every time. Is there any shortcut? No shortcut for e power values. You will have to go through 1 by 1 factorial, 2 by, that is e power 0.01. Most of the exam question, they may give you the values. That is the only thing I can say. You have to go through this approach only. 1 plus 0.01 by 1 factorial, 01 square by 2 factorial, 01 cube by 3 factorial. There's also another calculated technique which I don't remember, where you take some square root some multiple times and then you get to the answer. I'll check if I can find a video on that and give you, but preferable is this. Do till 3 factorial. Adjusted spot price 1000 minus dividend. X-dividend price. X-dividend price. E power 12%. E power R 12%. 12%. 12%. How many months we are doing the calculation? 3 by 12. 12%, 3 by 12. Once you will subtract, you will multiply. I'm not bothered about all this. Okay. Answer, as she said, 1005 point. You will need e power 0.03 value. In class, if you want to check, then you can do this. Okay. E power 0.03 is this. You can do your calculation in your notebook. 1.03045. 1.03045. 1.03045. Approximately it will match. Some here and there differences can be there. I'm not really bothered about the rounding off part. Any doubts till this? Any doubts in this? 1.03045. Any doubts in this? Dividend has to be removed from the spot price. Has to be removed from the spot price. What is that adjustment? X dividend and cum dividend adjustment. Can we proceed? There's another requirement of the question called as cost to carry. Now I'll explain this with first the concept book and then we do the calculation. Cost to carry means cost to carry total expenses associated with holding an underlying asset till expiry. If somebody buys a share of TCS and holds it for 3 months, there is a price I pay for holding it also. What is the price I pay? Some brokerage charges I may pay, some depository charges I may pay, and to buy the share of TCS, you could have taken a loan, and interest on loan is also paid. What is cost to carry? Is cost to carry any asset for the futures period. Cost to carry any asset for the futures period. At my home, I got a plant. I have to give water, some manual labor could be there. 3 months I incur something. There are costs I incur, sometimes some benefit may also come. In the plant, some fruits may grow and I may get some benefit of selling it. Here, I bought a share for 1000 rupees. I will incur some expenses, get some interest income, get some dividend income. Cost to carry refers to the total expenses or cost associated with holding an underlying asset till the expiry period. It includes cost like interest cost, dividend, storage cost. Simple formula is the same example only. Spot price 1000, adjusted spot price 975, fair futures price 1005. The formula is 1005 minus 1000. What is 1005 minus 1000 is? Today you buy it for 1000. You could be paying interest of around 30-35 rupees, and you are getting dividend income of some 20-25 rupees. Net 5.22 is your extra cost. In an ideal situation, after 3 months, 1000 should at least become 1005.22. 1000 should at least become 1005.22, so that I recover my 5.22 expense. My expense is 5.22. What is this expense? Interest expense, stamp duty expense, depository participant charges, brokerage charges, and adjusted for dividend income. Simple formula, FFP as per the formula, not given in the, that is AFP. FFP as per the formula minus the spot price. Now write cost to carry is equal to, cost to carry for the given question. FFP as per formula you have calculated. FFP as per formula minus spot price. FFP as per formula minus spot price. 1005.22 minus 1000. You get answer how much? 5.22. You buy a car. You want to hold car. See, I want to buy a car today, or I want to buy a car after 6 months. If I buy car today for a 6-month period, I'll incur insurance, I'll incur some maintenance charges, and some benefit could be that I use the car for Ola purpose and earn income also. Anything can be there. What is cost to carry? Is cost incurred to carry an asset for the next 3 months, 6 months, 9 months, 12 months. Any doubts on this? Can we proceed? I hope it is clear. Base is set. Now new things will keep coming in. Let's come to question 5. Calculate the price of a 3-month PQR futures if PQR quotes at 220, 3-month futures interest rate is 230, 1-month borrowing rate is 15%, dividend is 25% per annum payable before expiry. Examine arbitrage opportunity, rework the arbitrage strategy. If you can do a short sell, with the stock quoted at 222, again we are going to do fair futures price calculation. Once we do fair futures price calculation, we'll be able to decide the arbitrage strategy. Now every question on fair futures price, first you will have to tell me, is there any dividend or not? Any dividend information there? Here, there. So now write spot price, futures price. Spot price, futures price. How much is the spot price given in the question? 220. They have given 230. That's of no use to me. Okay. I am going to calculate this. Let me call it as fair futures price. Fair futures price. I am going to calculate fair. They have given the price. They have given what price? 230 and rework 222. Rework is 222 and 230. They have given the price. I will do my calculation. They have given the price in the question 230. Includes dividend income. Can you tell me how much dividend the share will pay? 25% on face value. 25% on face value. Tell me the amount. 2.5. Dividend is 25% per annum payable before expiry. Per annum word is of no use in dividend because dividend has nothing to do with per annum. If somebody says dividend is 25%, you will be paying 25% dividend on that day. Dividend is normally on face value. On face value. So dividend is how much? 2 rupees 50 paise. Later on, you will understand something called as dividend yield adjustment. I'll explain as we proceed. Okay. 2.5. When are we going to pay this? When is the expiry of the futures contract? 3 months. 3 months futures contract. 3 months futures contract. So in month 3. In month 3. Clear? Any doubts on this? Last question. 3 dividends. This question only 1 dividend. Only 1 dividend. When is the dividend going to be paid? In month 3. In month 3. I want to bring this dividend to today. FFP is equal to spot price into adjusted spot price into 1 plus R power N. The word CCRFI is not there. The word CCRFI is not there in the question. If you read fully, you don't see a word CCRFI. Later on, I'll explain what compounding frequency and all. What is the interest rate given in the question? 15%, but they've used the word what? 1 month borrowing rate means every month you have to calculate interest and every month you will have to do reverse discounting. Discounting every 2 rupees 50 paise, bring it back by 1 month. Again bring it back by 1 month. Again bring it back by 1 month. That is called monthly discounting. Every month you have to do discounting. Every month you have to do compounding. The word used is 1 month borrowing rate. 1 month borrowing rate. If nothing like that was there, directly 3 months discounting, directly 3 months compounding. Any doubts in this? Any doubts in this? Now write present value of dividend equal to present value of dividend equal to 2 rupees 50 paise divided by the interest rate given in the question is 15%. I assume it is 15% per year. Single month can't be 15% rate of interest. 15% is for a year. So practical world, normally interest rates are given for a year. 1 month interest rate is 15% does not mean every month they will pay 15%. They will pay 15% for a year, but they will be paying every month. They will be paying every month. You go to a bank and ask 1 month FD rate, they'll say 6%. That does not mean they'll pay you 6% for single month. They'll pay 6% into 1 by 12 every month. Into 1 by 12 every month. So 2.5 divided by 1. Can you tell me monthly interest rate? 15% for a year. 1 point. If you do this, it will become second month. From third month, it will become second month. From second month, it will become first month. And from first month, it will become month 0. 3 months, you have to bring it back. You can do power 3 also, okay? 1 plus 1.25% power 3. There is a doubt why 15% is per annum rate and not per month rate. Tell me practical world, can interest rate be 15% per month? Can it be 15% per month? That's all, it is only logic. It can't be 15% per month. If it was something like 2%, last question had 0.8% per month. I told not to do anything. We kept it as 0.8. 15% per month in India looks very high. 15% per month means 180% for a year. I can't do 180% for a year and do the calculation. So that is why we have taken that to be yearly rate. Any doubts on this? Any doubts on this? Sometimes there will be confusion. You don't know whether to take monthly or yearly assumption. 15%, I at least don't have any confusion. 15% to me does not look like a monthly interest rate. It looks like what? Yearly interest rate. How much is the amount? 2.41 is 2.41. Any doubts on this? 2.41. You are getting 2 point something else or 2.4 only? Yeah, 2.41. Any doubts on this? Discounted back by 1 month, discounted back by second month, discounted back by third month. Any doubts on this? If it was a second month dividend, discounted back only 2 months. If it was a first month dividend, discounted back only 1 month. 10th month dividend, discounted back by 10 months. Any doubts in this? Now right, fair futures price is equal to adjusted spot price into 1 plus R power n. Ideally, all questions should have only one formula, which is into e power RT, because all continuous only in the practical world. ICI sometimes does continuous, sometimes do monthly, sometimes do quarterly, and it's not that they do some inconsistently and all. There are indications in the question. What is the spot price today? 220 minus 2.41 into 1 plus monthly interest rate 0125 power 3 power 3 power 3. Let me know the answer. 225.85. Then I'll come to the arbitrage strategy. Okay, 225.85. Any doubts on this? Any doubts on 225.85 or 86, whatever number you're getting? Any doubts in this? Can we proceed? I'll repeat again. There will be a price. If there is any dividend included in the price, remove that. Any dividend included in the price, remove that. Once you have removed that, compound it to the future value. Once you have removed it, compound it to the future value. Last question, 3 dividends. This question, single dividend. Single dividend. Can we proceed? Any doubts in this? Now write. Arbitrage strategy. Arbitrage strategy. 2 columns. Actual futures price 230, FFP 225.85, 85 or 86, whatever it is, and actual futures price 222. I think they are given a rework with 222 price. There's a rework with 222 price. Last part. Rework the arbitrage strategy if the investor can sell the stock short and being quoted at 220, 222, 222, FFP equal to 225.85, FFP equal to 225.85. Let's come to the first part. Futures undervalued, overvalued. Overvalued. Let's write the first part. Don't look at the second part as of now. Futures are overvalued. You can write step by step. Okay. In exam, you can maybe write it as 6 steps. Show it like 6 steps itself. Futures are overvalued. Step 1. Step 1. Sell in futures market at rupees 230. Sell in futures market at rupees 230. Basically, sell in futures market. I'm telling you to add the rate also. Step 2. You're going to buy in the spot market. For buying, you need a loan. Step 2 is buy in spot market at rupees. What is the spot price today? No, spot price. 220. 220. See, you are only going to write this only. Sell in futures, buy in spot, take loan. Only thing I am telling is add a rupee value also. You don't want to add the rupee value, don't add it also. That's okay. But I am just telling you that is not very difficult. Sell in futures market at what rate? Buy in spot market at what rate? How did we buy? Step 2 itself. Both of the step are happening together. Take loan. Take loan of rupees 220 for 3 months. For 3 months at 1.25% per month. Clear? These are my step. You don't want to write step 1, step 2, step 3, write point 1, point 2, point 3. Don't even number the step 1, 2, 3. Let me do it that way itself. In exam, you can just write it like this. This is point 1 in my exam. This is point 2 in the exam. This is point 3 in my exam. Point 4 arbitrage gain. Arbitrage gain. FFP minus AFP or AFP minus FFP. Detailed step will need little bit of more grip. You see later at home with the open mindset, steps will be understandable. You're getting grip, okay. Not getting grip, don't confuse yourself with that, because you start focusing on that, you lose the grip on the base, which is where my problem is. Arbitrage gain 230 minus 225. How much? 4.15 or 14, whatever is the answer. Any doubts on this? This side. Futures are undervalued. Futures are undervalued. Futures are undervalued. Market is 222. You are saying 225.85. You are saying 225.85. Market is saying how much? 222. Buy in futures market at 222. Buy in futures market at 222. First step. Buy in futures market. Sell means short sell. I don't have even the share, okay. Short sell in spot market at rupees 230. What is short sell? Is selling without having it. Short sell in spot market. Question said you can do a short sell. Last line was saying you can do a short sell. How short sell works, we have seen when we did that lending example. So short sell in spot market at rupees 230. Sorry, not 230, 220, sorry, 220. 220. I did short sell. I got money. Create fixed deposit for rupees 220 for 3 months at 1.25% per month. Arbitrage gain difference. This much alone, please write it in exam properly. Any student making mistake in this, I'll get irritated. I at least don't see any confusion in this. No, arbitrage gain is difference between FFP and AFP. 225 minus 222. 3.85. Always difference between FFP and AFP. Nothing to do with spot price. It has nothing to do with spot price. It's always difference between FFP and AFP. Fair futures price and actual futures price. Any doubts on this? Can we proceed? Any doubts on this? Difference between FFP and AFP. You want to understand how this gain will happen? Detailed step you want to understand? Later at home, go through the steps if you are interested. It will be self-explanatory, but some challenges may come for your understanding. If you want to understand more also, send me a message in WhatsApp. I'll clarify. But for the class and exam, this is sufficient. From an exam point of view, I feel this is sufficient. ICI doesn't many times even write the detailed step. They just say 2 lines. Buy in spot, sell in future, sell in spot, buy in future. They don't even write anything beyond that. We're at least adding one more point called as loan and FD, and then we're writing the final number. Any doubts on this? Can we proceed? Okay, let's come to question 6. Consider a 3-month futures contract on Newgen Bank Limited. Share is quoted at 1100. Continuously compounded risk-free rate of interest is 12% per annum. Continuously yield on the same is 4% per annum. We are going to talk about something called as continuous yield. What happens, you will understand now. Find out the value of futures contract. What action will you follow if futures is 1110? Detailed arbitrage steps not needed, and 1150 detailed arbitrage steps not needed. So strategy alone we will write. What is strategy? Buy in spot, sell in futures. Sell in spot, buy in futures. We have to do futures valuation. Let's write base information. There's something called as continuous dividend yield. What is that is what I'm going to explain in this question. Now write spot price. Each of this is different scenarios which I want to talk about. Everything is perfectly covered in my MCQ and concept book. At home, you are going to do all those MCQs. At home, you're going to do the MCQ. This chapter, again, MCQs are very comprehensive, can kind of cover everything what I have done. Now, right, what is the spot price? 1100. How many months? Question mark. 3 months, question mark. What is the rate of interest they have given? CCRFI, continuous compounded, okay? Continuous compounded rate is 12%. Yield, what is yield and all? I'll explain. Yield is 4% per annum. Okay, now listen. When I buy an underlying asset can do two things. It can give me daily income or it can give me one-off income. Daily income, one-off income. One-off income, calculate its present value and reduce it from the spot price. One-off income, that 2 rupees 50 paise was one-off income. 8.5, 7, 7.5, whatever given was one-off income. When I say one-off income, it's 3 times, 4 times, 5 times, 10 times. I grow a plant. Plant will give me daily vegetables. Daily income I am going to generate. If you are going to generate daily income, whatever income you are generating, its present value you have to calculate today. And remove that income from the spot price. Why should you remove? Because futures does not give that income. Futures does not give that income. From the spot price, I have to remove the income. Continuous dividend yield means daily it is paying dividend. Daily it is paying dividend. Now, if you tell me the daily dividend is there and remove the daily dividend, very complex. First day dividend, remove. Second day dividend, remove. Third day dividend, remove. Fourth day dividend, remove. In Excel at least I can try, but very difficult. Very difficult to keep removing dividend, which is where Modigliani-Miller approach came into picture. What Modigliani-Miller approach said is, your fair futures price is equal to spot price into 1 plus KE minus the dividend. This was the logic he said. So what they said is, if 12% is the income you want to earn, 12% is the growth has to be there, price will not grow by 12%. Price will grow by 8% and dividend will be 4%. Price will grow by 12% is the risk-free rate. I want 12% income from this share. The share price should go up by 12% in 3 months. But they are saying no, it will not go up by 12%. 12% is the overall growth. In that, 4% is through dividend. 4% is through dividend. What is that balance? 8% price increase. 8% price increase. Here came another formula when you have dividend yield in percentage and continuous. Last question also they gave percentage, but it was one off. It was one off, so I converted into rupees and did the adjustment. If you are going to tell me at the end of every month 1% dividend will be paid, that also I can convert into rupee element and then do the calculation. But unless it is a continuous means they will not give you any periodicity. They will not tell when it is getting paid and all. Continuous means every month payment will be there. Now right, fair futures price is equal to spot price into e power r minus y into t. I'll explain the logic of the formula. E power r minus y into t. Y e power continuous. Otherwise 1 plus r minus y power n. What is r minus y is? My share price will not grow by 12%. Share price will grow by, what is fair futures price? Growth in the share price. It will not grow by 12%. It will grow by what? 12 minus 4. 12 minus 4, 8%. It will grow by 8%. Share price will grow only by what? 8%. What is the logic? Is very simple. From the spot price, either remove the income. How do you remove the income? Adjusted spot price. Not able to remove the income, leave the spot price, and when you do your future forecasting, do growth, not 12%, do a lower growth. Do a lower growth. Somebody wants 12%, 8% is price appreciation, 4% is dividend income. You wanted 12% return. Share price will grow by 8%. If it was not continuous, no. I'll tell you approximate answer is 1100 plus 8% for 3 months. 8% for 3 months is my approximate answer. Continuous means I'll have to do e power r t. Now write 1100 into e power 0.12. A student had a doubt in the previous question on dividend that 25%. Why we did not do 25 as a percentage is because it is one off. If you continuously pay, if saying that 25% payable on a daily basis, you will have to do r minus y. You will have to do r minus y. 0.12 minus 0.04, 3 by 12. 3 by 12. 3 by 12. E power 0.02. E power 0.02 value is this. Tell me the future value. 1.0202. 1.0202. No. 1.02 into 1.02 will not give you the answer. How will you get 1.0202? You will not get it. You check, you will not get it. You will not get it. It will not work that way. The continuous compounding can't be done that way. Continuous compounding you want to do, you have to do exponential. Exponential is 1 plus x by 1 factorial, x square by 2 factorial, x cube by 3 factorial. No other way you will get the answer. So 1100 into 1.0202 1122.22. I give you 2 minutes. 1110 1150. Please give me this table. Exactly this table. The actual futures prices 1110 and 1150. 2 minutes for you. 1110 1150. I will wait for 2 minutes and then we discuss the balance part. Okay, the question gave two prices. What are the actual futures prices? I said 1110 1150. Let me write it this side. That is how my steps will match. 1122.22. Other side is 1110 and 1122.22. Futures are overvalued. Futures are undervalued. Sell in futures market at 1150. Buy in futures market at 1110. Buy in spot market at 1100. Take loan of 1100. Take loan of 1100 for 3 months at 12 percentage. The rate of interest is 12 percentage given in the question. 12 percentage. Create FD for rupees 1100 for 3 months at 12 percentage. Arbitrage gain just the difference. 1150 1122.22. Answer is 27.78 and the other side is 1122.22 minus 1110. Answer is 12.22. That's all. If it comes in MCQ, more easy. MCQ though I don't even need to write detailed step. They may ask what is arbitrage gain. Again, remember arbitrage gain is difference between fair futures price and actual futures price. Nothing to do with spot price. Calculation happens with spot price, but nothing to do with the spot price in the net gain amount. Any doubts on this? No, it will be 12% only. Outside the class, I'll explain to you if you want outside the class because unnecessarily it confused some other students. Any doubts on this? It will be 12% only. Outside the class, I'll explain if you want. Any doubts on this? Cost to, okay, there is a, Shika, I'll ask your doubt later. I'll answer your doubt later. You are now going back to the earlier question. Any doubts on this? Any doubts on this? Can we proceed? Done? Okay, on 31/8/2011, value of stock index is 2200. Write along with me. Write along with me. Spot price 2200. Spot price 2200. Just write in your notebook. Spot price 2200. Risk-free rate of return 8%. R is 8%. 2200 R is 8%. They have given dividend per annum dividend, but monthly dividend is there. 3%, 4%, 3%, 3, 4, 3. Some dividends there every month dividend is paid. It is possible that within a month also multiple times dividends are paid. I don't know. They have given dividend. Assume interest is compounded daily. Compounded daily means CCRFI. Compounded daily means CCRFI. Find out the future contract deliverable on 31/12/2011. 31/12/2011. Now we are today on 31/8, right? 31/8/2011. 2200. 31/12/2011 question mark. 31/12/2011 is question mark. 31/8 is 2200. 31/12 is question mark, which is broadly 4 months. I can do 4 months or I can do number of days, whatever be it. I will say that this will be the value which I'll be using. So if it's days calculation or months calculation, I don't know. I may do days calculation. Doesn't really matter. They have given that e power value somewhere. It will match that value. It will match that value in the solution. It has to ideally match that. If there is a huge variation in that value, then maybe wrong drafting. But otherwise, whatever e power value we are going to use, it is going to match here. There is a dividend in this question, but dividend is paid every month, and within a month also it can be multiple time. So dividend is paid in January, Feb, March, April, May, June, July. I need the dividend percentage. Now, in case I don't know when is the derivative contract starting, when is the derivative contract ending, can you add all the 12 and divide by 12? Add all the 12 and divide by 12 quickly. Add all 12, divide by 12. All the 12 months, add it and divide by 12. 3.33 percentage is the dividend yield of this. Every month they have given per annum rate. So I've added everything, divided by 12. 3.33 percentage is the annual dividend paid. Our contract is starting when? We are on which date now? 31st August, and it is going on till. So what concept says is, if you know the exact date, take average of your dates. Take average for the dates for which you are doing the valuation. In case you don't know the dates, don't worry about it. Add all 12, divide by 12. Last question said some 4%. That would have been all 12 months divided by 12. They would have given the number. In case specific, I am able to find. They say find out the value of a contract deliverable after 4 months. I don't mention which 4 months. Don't break your head. Just add all the 12, divide by 12 and apply it. Okay. So now write FFP is equal to spot price into e power r minus yt. E power r minus yt. Why r minus y? Continuous dividends are there. Every month, within a month also multiple times dividends may get paid. Spot price 2200. R is how much? Tell me the average dividend between August and December. That is after August. 3.25. 3, 4, 3, 3. In case this information is not there, go ahead and take 3.33 and proceed ahead. I can't break my head around. Last question, I did not tell you to do any of this. Question said 4%, follow 4%. So this is 0.0325. 4 months, 4 by 12. Listen, check whether that given number below matches. If not, then do days. Days is 120 or 121, 22 by 365. Check if it matches the given number. If it matches, okay. If it does not match, then you have to do days calculation. 0.08. Is it matching the number given? Okay, then fine. Into 4 by 12. 0.01583. It matches. If it does not match, then you have to go ahead and do days calculation. What is days calculation? from August, September 30 days, October 31 days, November 30 days, December 31 days divided by 365. Clear? Any doubts on this? So 2200 into e power 0.01583. In case they don't give the value, more difficult for us. Again, I'm repeating, e power value 99% will be given in the question. For that one-off reason, I have told you how to calculate it. 99% it will be given in the problem. This is what my experience has been with the questions. Okay, multiply with 1.01593. You multiply, you get how much? 2235.05. Any doubts till this? Now I go back to concept because I've done questions. Now what I talk will make a lot of sense for you. So I go back here. I do two types of valuation. One is called normal compounding. Second is called continuous compounding. What is normal compounding? Spot price into 1 plus R power n. What can be R? Monthly R can be followed. Monthly n can be followed. Quarterly R can be followed. Quarterly n can be followed. Half yearly R can be followed. Half yearly n can be followed. How do I decide? In 2 minutes I'll discuss it. In case no clarity is there, write R for the specific period. N is 1. No compounding. That's all. Or in simple words, in case you are not compounding, you can just do spot price into 1 plus R. That's all. No power n. No power n itself if you are not going to do any compounding. When we don't do any compounding, first problem we solved. It was 1800 into 1 plus 5%. Power 1 has 0 utility. Another question we did. 300 into 1 plus 0.8% power 3. That is monthly compounding. That is monthly compounding. We have done monthly compounding. We have done no compounding. We have done half yearly compounding. We have done quarterly compounding. We have done continuous. Continuous e power RT. No dividend, no storage cost, formula as above. If there is a dividend, 1 of dividend, 2 of dividend, 3 of dividend, 4 of dividend, replace spot price with adjusted spot price, or replace cum dividend price with X-dividend price. Replace cum dividend price with X-dividend price. What is the calculation? Spot price minus present value of dividend. Dividend in percentage, not one off. 10 times, 20 times, 30 times, continuous. Replace R with R minus Y. Like an asset can generate income, opposite is an asset can have expenses. An asset can income, reduce it from today's value. Expense, add it back. Expense, add it back. Income, X dividend, remove the dividend. X storage cost with storage cost. If you have storage cost, exactly opposite. Which asset can have storage cost? Gold. Plant. If I'm having some plant at home, I have to incur cost on it. So if you have storage cost, one off storage cost, SP plus PV of storage cost, very rarely you will see problems on this. Okay, I have one problem, I'll discuss it. But storage cost, exact opposite of income. Income we are subtracting, expense we are going to add it back. And in case it is in percentage, R is replaced with R plus S. How do you get present value? Dividend income by e power RT, dividend income by 1 plus R power T. Storage cost by e power RT, storage cost divided by 1 plus R power T. Now whatever I am saying will make lot of sense to you because I have already done the problem. During the futures contract, assets may declare dividend. There can be associated cost. These costs are not there for futures. Cost is also not there. Income is also not there. So we are removing that. We have done, you see all these questions at home. Whatever I have done, you will get all those. Don't look at the answer. Obviously, answer you should not look at, and you keep doing any of these questions. How do I compute e power RT values? E per RT is 1 plus x by 1 factorial, x square by 2 factorial, x cube by 3 factorial. There is no end to it, but we'll stop at 3 factorial. This is the information I normally need to calculate. I have been writing formula directly. But in case you want to think logically, then you have to write a format. Format will consider spot price, time period, rate of interest, dividend, storage cost, and a compounding frequency. These 6 items influence my fair futures price. Spot price changes, FFP will change. Time period changes, FFP will change. Risk-free interest changes, FFP will change. Dividend changes, FFP will change. Storage cost changes, FFP will change. And compounding frequency changes, FFP will change. Ideally, that last item should not be there. Practical world, continuous compounding. Now, how do I decide compounding frequency? Question uses the word CCRFI, daily compounding, or E power. Last question used that E power value was given in the question. Do continuous compounding. If they say 1 month interest rate, 2 month interest rate, do monthly compounding, do 2 monthly compounding, do quarterly compounding. Interest rate 0.6% per month, monthly compounding. Per quarter, quarterly compounding. No indication, compounding once n is equal to 1. If there is no indication in the question, it is just compounding once. ICI to some of the questions of late have been telling that alternatively you can do exponential compounding. What is exponential? E power RT. Some of the questions they started writing that point. But for doing exponential compounding, I'll need E power RT value. Not given. Let's not break our head. Let's do simple interest. That is no compounding, monthly compounding, quarterly compounding, half yearly compounding depending on the data in the question. Any doubts on compounding frequency? Arbitrage strategy already told. AFP greater than FFP, AFP less than FFP. If AFP is greater, futures are overvalued. If overvalued, sell in futures market, buy in spot market, borrow to buy share, and arbitrage gain. Exactly this you have to write 1, 1, 1, 1, 1. You may not put it in a chart form. Even chart form is technically right according to me, and opposite for the other one. Any doubts in this? Again, excellent examples are there. At home, practice it. Just at home, practice it. Cost to carry. This represents the cost incurred to carry an asset from today till the maturity period. FFP as per formula minus spot price. Minus spot price, not adjusted spot price. Why not adjusted spot prices? Adjusted spot price has that income which is getting removed. So when I hold an asset has certain expenses, certain income, net item is what I want to see, which is FFP as per formula minus the spot price. In adjusted spot price, that income is removed. I don't want to remove it. Any doubts in this? This concept we saw now. Dividend yield computation. Same yield every month. Take the given dividend yield as final yield. Different yield every month. Take average yield of the life of the futures contract. If you are doing April to June, take April to June average. If you are doing July to September, take July to September average. Any doubts in this? Give me answer to this. Expiring on November 30. November 30 expiry. Four months which are expiring on November 30. Okay, expiry on November 30. November 30 expiry means November, October, September, August. It could be that which is going to today's date is, or I can say what should be the dividend yield for valuing a 4-month futures contract on Feb 28. On Feb 28, future 4 months is March, April, May, June. Any doubts on this? So we are done till 8 concepts and good number of questions are done. Any doubts till this? Any doubts on this? My base is set. Any place if there is a confusion, let me know. Any place you need any clarity, let me know. Clear? Done? Okay, let's take a break and then proceed. 10 minutes break. Okay, let's proceed with the discussion. We'll keep doing questions only and I'll come back to concepts if needed. I think around 8 concepts are already done. We may have another 8 to 10 concepts in futures and futures will get over. Let's come to question 8. Gold futures have been opened up in India recently. 3-month futures is available at 800. The futures price is given 800. Current price is 775. It cost 5 per gram in arrears to store gold. It cost 5 per gram to store gold. This is with storage cost. I wanted to bring one question with storage cost. What is the fair price if CCRFI? CCRFI is 8%. Then if the rental is 4% per annum, I'll assume continuous 4%, and CCRFI, what is the fair price? If The futures is 770 is considered to be fair. What is the implicit convenience yield? I'll explain what is this convenience yield concept in some time. Let's write it. What is the spot price given in the question? Right, spot price 775. Actual futures price, which has no, we are not doing any arbitrage and all, but I'll write the actual futures price. What is the actual futures price? 800. Time period how much? 3 months. Time period 3 months. Compounding frequency CCRFI continuous. Compounding frequency is continuous. CCRFI. Compounding frequency continuous. Storage cost 5 per gram. Arrears means in month 3. Arrears means you'll pay at the end. Advance means you pay today. 5 per gram in month 3. 5 per gram in month 3. Now I have to do FFP. For FFP, you have to first add the present value of storage cost. Add the reverse of dividend income. Income is subtracted, cost is added back. Any doubts on the data? Present value of storage cost is equal to 5 divided by e power RT. 5 divided by e power RT. You have to bring it back to today. 5 divided by e power RT. E power RT. R given in the question is 0.08. T is the storage cost is reverse work by 3 months. T this just to calculate present value. We did one question where one dividend was 1 month, second dividend was 2 months, third dividend was 3 months. We are doing present value of storage cost. 3 by 12. 5 divided by 1.0202. 5 divided by 1.0202. I will not spend time on calculating e power value and all. 5 divided by 1.0202. What's the value? This is my present value of storage cost, which needs to be added back. Any doubts on 1.02? Sorry, any doubts on calculation? 1.0202 leave it. Any doubts on the calculation? We are bringing it back by 3 months. We are bringing it back by 3 months. Any doubts in this? Can we proceed? Any doubts in this? Done. Adjusted spot price is equal to spot price plus PV. Spot price plus present value of storage cost. Present value of storage cost. Present value of storage cost. 775, 4.9, 779.9. After adjustment is done, this is like you have X dividend. This is technically storage cost adjustment. We get something called as fair futures price is equal to adjusted spot price into e power RT. E power RT. %, 3 by 12. Same 1.0202. Same 1.0202. How much you're getting? If I ask you arbitrage steps, difference between AFP and FFP, AFP 800, futures overvalued. We are going to sell in futures market, buy in spot market and get a loan for that and get an income of difference. That's all. Don't worry about other steps and all. Now they are saying what you did is good, but I am changing the rent as what? 4% per annum. I'm assuming it is continuous 4%, not one off. One question said 25%, but it specifically said it is one off instance. 4% per annum, I am understanding as every day we pay rent, or every 10 days we pay rent, every 15 days we pay rent. First part said 5 per gram payable in arrears, only one time payment. This is percentage assumption. Assumption is everyday basis we are going to incur it. If that is the scenario, don't do anything on the price, do it on the R. Do it on the R. It is exact R minus Y, R plus S. R minus Y, R plus S. Any doubts till this first? Any doubts in this? Can we proceed? FFP is equal to spot price into E power R plus S into T. E power R plus S into T. If they say 4% per annum payable only once, convert that 4% into rupees, deduct it, add it to 775 and do it. One question we had 25% per annum payable on expiry or receivable dividend income. One off, adjust it in rupees. Multiple adjustment, doing in rupees is, when I say multiple, 3, 4 and all is still possible. Continuous, every day you are paying, adjust it this way. 775 E power 0804. It will be 1.03045. The numerator is, that is the value is 1.03045. 03045. There is a doubt on explaining E power R plus S. It is R minus Y when you have dividend income. Income is going to, logic is very simple. I want a 12% return. 4% income, 8% is the price appreciation. If you have storage cost, you want 12% return, means storage cost is there, you have to earn 16-17%. I have to earn 16-17%. So here price has to appreciate by 12%, 4% will go for storage cost, 8% is my real income. E power R plus S. R plus S is because I have to earn 12% so that I earn an income of 8%. What is E power? That E power RT is the price appreciation. Price has to appreciate by 12% so that in the end you earn an income of 8%. 798.60. Any doubts on this? Clear? 1.03045. Yeah, tell me. Yeah, correct. Continuous. But the word is CCRFI, na? Here, CCRFI is there. If they mention exactly when it is paid, convert into rupees and adjust it. Any doubts on this? Can we proceed? Okay, you have done the calculation. You are saying 798. Question is saying, no, I don't agree to your 798. It says, if the futures price of 770 is to be considered as fair. Question says 770 is fair. You are arguing 798.60. Continuation of part 2 of the question. You did your calculation 798. Question is saying, no, 798 and all is wrong. It has to be what? 770. What is the implicit convenience yield? Now, what is this implicit convenience yield? Let's understand. Today, let's take an example of some 15-20 days back. One commodity which was highly volatile was silver. In the spot market, silver was 1 lakh, let's assume. Just an imaginary number, okay? That time it was some 1 lakh 60, 70. 1 lakh was the silver price. In the futures market also, it will be quoted. In the futures, let's assume it is at 1 lakh 10,000. Futures has an expiry date. It cannot keep having, there will be an expiry date month end or 2 months, 3 months, 4 months. Spot does not have any expiry date. So if silver is continuously going up, this 1 lakh is continuously going up for next 12 months. But this futures will stop at second or the third month. After that, the benefit cannot come in futures. Many a times when commodity is very scarce, people want to buy it in the spot market and not in the futures market, because I want to gain out of price appreciation. After 3 months, I may buy another futures. but it may not be available in the market. It is a scarce commodity. It is a scarce commodity. So people will pay premium in spot. Premium means extra in spot and lesser in futures. Lesser in futures. When I say extra, does not mean spot has to be more than future. Spot real value 1 lakh. People will pay 1 lakh 20, 1 lakh 30, 1 lakh 40, 1 lakh 50. That's what happened when silver prices were continuously going up. Futures real value 798. They're saying no, we don't agree to a 798. We'll pay only 770. So this concept is called convenience yield, benefit of holding anything in physical form. Benefit of holding anything in physical form. Future value of convenience yield. There's a future value, there's a present value. What is future value? FFP as per formula 798.6. FFP as per question 770. Gap is 28 rupees. You are paying lesser. You are paying lesser in the futures market, or indirectly you are paying more in the spot market. Indirectly, if 770 is FFP, I reverse work spot, I may get 720, 730. But I am paying more in the spot market or less in the futures market. That concept is called convenience yield. Whenever something is in physical form, it always gives benefit for an infinite period. When the product is very scarce, product scarcity is not there, convenience yield will not exist. Convenience yield will not exist. What is convenience yield? Benefit of holding something in physical form as compared to holding it in futures form. If you hold something, gold example, they gave another idea. If I hold gold in physical form, I can use it to take a loan. I can convert into an ornament. I can do anything I want to do with the physical gold. If it's in futures form, you can't do anything. So when something is held in physical form or spot form, it may sometimes command a premium valuation, and futures may command a discounted valuation. Futures may command a discounted valuation. Now write convenience yield is equal to FFP as per formula minus FFP as per question. FFP as per formula minus FFP as per question. As per formula 798.6. Question 770. Question is saying fair is 770. Question is saying fair is 770. If they had not said 770, then I would have taken actual futures price given in the question as fair and done the calculation. Convenience yield is very simple. What I compute and what question gives, in case there is a difference, that can be interpreted as even convenience yield or arbitrage gain, depending on scarcity, no scarcity. Depending on scarcity, no scarcity. Answer is 28 point. This is called future value. You want to bring it to today because you are comparing two future values. You want to bring it to today, discount it back by 3 months. Discount it back. So if you want to bring it to today, discount this value to today. Discount this value to today. That is called present value of convenience yield. There is a future value of convenience yield. There's a present value of convenience yield. Holding something in physical form has some benefits which are intangible in nature, which our financial numbers can't use it, can't say. If I have gold in physical form, I can maybe convert into some commodity, convert into a ring or a chain and wear it. That my formula cannot consider. FFP as per formula cannot consider this benefit of converting into a ring, using it as a ring. I have, let's assume, petrol in spot form, petrol in futures form. Suddenly there is a problem of availability of petrol. Spot form, if I have, I can use it and go to one place. Futures form, you can't do anything. Futures form ultimately can give you that petrol after 3 months, but I need it today. I need it today. Any doubts on the concept? Okay, now I'm going to come to an area called net settlement. What is net settlement? Is futures practical world, we do something called as net settlement. We don't do an item called as gross settlement. What is gross settlement? What is net settlement? I'll keep explaining. I'll come to implied risk-free rate later. Physical settlement and net settlement. There are two types futures contract can be settled. One approach, let's assume I go to a jewelry shop and tell the jeweler on December 31 I will buy gold at 12,000. I'll buy gold at 12,000. On which date? On December 31 I will buy. Today we are on November 13. Spot, November 14. Spot, future. There are two prices. Today the price was 11,000. Jeweler told me 12,000. Jeweler told me 12,000 and I said I will buy at this price. I will buy at the price of 12,000. I told the jeweler, this is what I want to do. He says, okay, you want to do it. Came December 31. Came December 31. Price in the spot market is 11,500. Future should also be same 11,500 because both are same date. Both are same date. Practical world, some variation can still be there. But in futures market, it is at 11,500. I told I'll buy at what rate? 12,000. Futures market today the rate is how much? 11,500. So I told this to my friend. He started laughing, saying that why did you enter into this contract? If you had not entered into the contract, you could have bought gold at what rate? 11,500, and you uselessly entered into this contract at what rate? 12,000. So I thought I will not meet the jeweler and escape from the scene. If I escape from the scene, the jeweler may ask me to pay something. That is called net settlement. If the jeweler asks me to pay, something is called net settlement. Okay. Or I happily go to the jeweler, give him 12,000. He gives me 1 gram of gold. That is called physical settlement. What is physical settlement? Give 12,000, get 1 gram of gold. That is called physical settlement. But when I told this to my friend, he started laughing, saying that you are doing some useless thing. Why did you enter into all this? So I told this to the jeweler and I said, I'm not going to take your call. I'll not come to your place and all. You please ignore it. Jeweler got irritated. He says, you entered into a contract. Now you cannot say that you will not fulfill your commitment and all, because you told you will buy at 12,000 and price now is 11,500. If I find somebody else, he will buy only at 11,500. You are going to buy at what rate? 12,000. So if you are not fulfilling your commitment, I am in trouble. Please fulfill your commitment. Take this gold and give me 12,000 rupees. I am still adamant, saying that I am not going to do it. Then he says he'll put a legal case, other things, all that is going on. So one thing I can do is I can pay 12,000, get a gram of gold and the transaction is over. Another option is I ask him, what is the loss for you if I don't buy gold from you? If I don't buy, what are you losing so that you are irritating me? He says, give me 500 rupees. Just give me 500 rupees and we are done with the transaction. What is that 500? Gap of 12,000 and 11,500. Just give me 500. Do whatever you want to do after that. Do whatever you want to do after that. Don't even come to my shop after that. You just give me 500 rupees and move out of my shop. Why I want that 500? I will get 500 from you and 11,500 from your friend. Your friend is coming along with it and he buys the gold now. He buys the gold at 11,500. Very happy for me. I got my 12,000. I got my 12,000. 500 comes from you. 11,500 comes from your friend and I get my 12,000. Shopkeeper is very happy with this. If you pay 500, it is called net settlement. And if you pay 12,000 and get gold, it is called physical settlement. How does net settlement work? He will say, you did this buy, no? Now, let's assume it is in a demat account, I pressed a buy order. Now I have to press a sell order. I have to press a sell order in the demat account. In the demat account, I have to press a sell button. I press the buy button. Now I have to press the sell button. Moment I press the sell button, the demat did the calculation. 12,000 buying price, 11,500 selling price, 500 loss. 12,000 buying price, 11,500 selling price, loss. Another contract on November 14. Infosys or TCS 3,700. Spot December 31, 4,000. I press the sell order today. My wish. I can press a sell button. I can press a buy button. I can sell. That is, I can enter into a sell contract. I can enter into a buy contract. I press the sell button. Came December 31. This was at 3,900. This will also be at 3,900. You press now buy. If buying price is more, loss. Selling price is more, profit. This is what net settlement is all about. Net settlement means on the last day, you are saying, don't ask me for the money. Just find out the difference. Either you give me or I will give you. Either you give me or I will give you. Who will give? Who will take? Check the buying price, check the selling price. Check the buying price and check the selling price. Able to understand the transaction? So here the concept is physical settlement, pay cash, receive share or product, deliver share or product and receive cash. Money not there, no need to deliver. India goes through this. Indian markets go through no need to deliver. What will you do? Buyer of futures, current selling, all this don't remember, just understand the logic. What is the logic? Did you press buy button first or sell button first? It's a demat account. In the demat, if I go to stock market against this price, there will be two buttons, buy button, sell button. You can press the buy button today, you can press the sell button today. If you press the buy button today, after one day, after 1 minute also you can press the sell button. You can do buy now, next minute you can sell the same thing, next minute you can buy the same thing, next minute you can sell the same thing. The price will keep changing. The price will keep changing. Only rule is, if you have purchased TCS 25th November, you have to again cancel or sell with TCS November 25. You cannot say I will use TCS November 25, then TCS December 31, TCS January. All that is not possible. So net settlement means, when did you press the buy button? When did you press the sell button? Two questions we will do. You will get full grip. Let's see it here. Mr. X bought Nifty futures of how much? 10 lakh on which date? January 1 for delivery on March 31. Nifty lot size is 200. Calculate the profit or loss if Nifty future on maturity date is 6,000, 4,500. Let's write it in a format. Right, date, 3 columns. I used to have 5 columns. My students will know 5, but now I brought it down to 3. Date, spot, futures. This is to further simplify it. Date, spot, futures. I purchased on which date? Jan 1. I purchased how much? 10 lakh. What is the lot size given? 200. So I purchased, right, 10 lakh divided by 200. My purchase price is 10 lakh divided by 200. 10 lakh divided by 200. 5,000 in bracket buy button. Buy button. You need not use the word buy button in exam and all. I'm just saying you press the buy button on that day. Mr. X bought how much? 10 lakh by 200. By 200 lot size. What is the spot on that day? Not available. I'm not getting into it. On that day, what was the spot Nifty? We don't know. Not getting into it. Not available. Not available. Can I calculate? If needed, I can calculate. How will I calculate? Fair futures price is equal to spot price into 1 plus R power n, reverse work the spot price. Then March 31, last day. March 31. On the last day, both will ideally be same. It is 6,000. There are two situations, okay? First situation, it is 6,000. First situation, it is 6,000. On the last day, it is 6,000. Originally, which button did you press? Buy. Now press the sell button. Press the sell button. If you press the buy button, now press the sell button in your demat. Did you make money or lose money here? Buy button at what rate? Sell button at what rate? 1,000 rupees per unit, 200 units. 200 is the lot size. 200 is the lot size. So you are making good money. You are making good money. Profit equal to 1,000 into 200. 2 lakh rupees profit I made. There will always be a lot size in the practical world. It can be 50, 25, 100, whatever the lot size the question gives. You cannot buy one share. You can buy only group of shares, can be 50, 30, depends on one futures contract practically will be closer to around 10 lakh rupees, and accordingly the lot size will be fixed. 2 lakh rupees is the profit. I did the same thing, but on the last day Nifty is at what rate? 4,500. Write the same table. Date, spot, futures. Spot and futures. January 1, don't know the spot price. It's okay. If I don't know, it's okay. I'll not get into that headache. I don't know the spot price. Let it be. We purchased at what rate? 5,000 in bracket buy. Buy button. 5,000 buy button. You came back on which date? Listen, you can come back even on January 2, January 3, January 4, January 10, January 20, January 30. You can come back on any date you wish to. That's up to you which date you want to come back. I came back on which date? March 31. March 31. I came back on March 31. What is the rate in the market? On last day, both spot and futures will be same, 4,500. I pressed and started feeling unhappy because my selling price is lower than my buying price. Selling price is lower than my buying price. Started thinking, why is this happened? There is a loss here. Loss is how much? 500 into loss of 1 lakh. Any doubts on this? Any doubts on this? I suffered a loss of 1 lakh rupee in this entire transaction. In the entire transaction, I suffered a loss of 1 lakh rupee. Does this happen in the practical world? Exactly this only will happen. Exactly this only will happen. Only thing is, you need not wait for March 31. You can close it even on January 1, 10 a.m. started, 10:1 closed. You can even close it in 1 minute also. You can even close it in 1 minute, and in the practical world, in your demat, the profit or loss will be reflected every minute. They will reflect every second. It will keep changing, and it will be reflected what is the profit or loss you're making. When you feel you have made profit, you want to come out, you come out, or you want to wait, that's up to you. But profit or loss will change every second in the practical world. Any doubts on this? Can we proceed? Let's do this. A sold one Nifty futures contract. A sold one Nifty futures contract for rupees how much? 3,40,000 on January 15. For this, he paid an initial margin of 34,000 to his broker. Each Nifty contract is for the delivery of 200 Nifties. 200 Nifties on Jan 25. Index closed at 1850. What is the profit or loss A has made? We'll put it in the same format. Date, spot, futures. Spot and futures. Spot and futures. If you don't know the exact date, day 0, end date. That's all right. On which date did we enter the first contract? Jan 15. We sold at what rate? 3,40,000 divided by the lot size. 1,700 in bracket. Which button did we press? Sell button. I press the sell button initially. I can press sell button initially. I don't know the spot again here. We don't know the spot. We don't know the spot. We press the sell button at 1,700. We came back. January Nifty means it practical expires on last Thursday of the month. There are talks of changing it. I think they have changed it also, but earlier it used to be last Thursday of the month. So they have given January 25. January 25 could be the last Thursday of the month. Practically, I think there are talks of changing it. Maybe they have changed it also. I have not followed it fully. Jan 25. Jan 25. What is the index closing at? 1850. Now I have to press the other button. There is a margin which is paid. That is a refundable deposit. You'll understand about that later. It's technically a refundable deposit. 1850. Which button? Buy button. buy button, buy button, profit loss. I'm suffering loss here because I pressed the wrong button initially. Now I am suffering a loss. Selling is at lower rate, buying is at higher rate. I can have a loss of 150 here into 200. Listen, it can be sometimes 5 contract, 10 contract, 15 contract, 20 contract. That question will give here only one contract, but as you proceed you will see difference there also. Any doubts on this? 30,000 is my loss. This is called net settlement. This is technically called net settlement. I already did it in my regular batches using some 5 column format. Some of you would have got it, but this is most simplest form I can bring it. Any doubts on this? Buy button, sell button, just keep that in mind and then proceed. What can be complication in the question? They may give you this and they may ask you to calculate this. They may ask you to calculate this. How will you calculate? Spot price into e power RT. Expiry Jan 25, but I may close it on Jan 20. I'll give you Jan 20 spot rate. You calculate Jan 25 futures rate. You calculate Jan 25 futures rate. How will you do? Spot price into e power RT. That is an extra layer of difficulty. I will add it in the question. Able to understand till this? Any doubts on this? Can we proceed? Let's come to this. Question 11. Go through the question. There is a doubt that overall loss, last question 64,000. No, initial margin is a refundable deposit. It is neither your income nor your expense. We will learn about initial margin later. Margin is paid. What will happen practically? I'll tell you. You will pay 34,000. They will return 4,000 to you. Loss is 30,000. They will return 4,000 to you. Margin is technically a refundable deposit. It's neither your income nor your expense. Go through 11. Go through 11. 2 minutes for you to read it. Okay, they have given NSE price 100 per index point, means 100 is the lot size. Lot size is 100. One Nifty is equal to rupees 100. On 15th September, index closed at 1195. December futures are at 1225. Historical dividend yield is given. Borrowing rate is given. Whether they are underpriced or overpriced, arbitrage mechanism, gain or loss with some two different prices are given in the question. Gain or loss will be equal to arbitrage gain only. How it happens, we'll see. Assume 365 days in a year. You have to do days calculation. You have to do days calculation. Clear? Can we start now? Now, right. Fair futures price is equal to spot price into 1 plus R minus Y power N or power T. R minus Y. There is a dividend yield. R minus Y. Dividend yield is there in the question. They have talked about some yield on the indexes, 3% per annum. Yield means continuous. What is the spot price given? 11 into 1 plus, I'll come to this in a minute. Okay, 1195 into 1 plus. Any doubts till this? Can you proceed? Leave some 2 lines. Tell me the number of days. Ignoring 15th September because it is closed on 15th September. September, October, November, December. Tell me the number of days excluding 15th September. 90. September 15 days. October 31 days. November 30 days. September and December. Any doubts on this? What happened? Is there a doubt? It's closed on 15th September. Exclude the 15th September. Closed. 15th September is over. 15 days of September, 31 days of October, 30 days of November, 15 days of December. How many days is there? Any doubts? Is there a confusion? R equal to what is the rate of interest given in the question? 9.5 into 91 by 365. Keep it as 4 decimal. 91 by 365. 365. 2.3685%. 2.3685%. 3685%. 91 days. Simpler 3 by 12. Simpler is 3 by 12, 3 months. Complication because they said 365 days in a year. They ICI will do days calculation. Why? What is the dividend yield given in the question? 3 into 91 by 365. 91 by 365. 7479. Let us keep it as 4 decimal to avoid the rounding off to some extent. Okay, 7479 rupee answer and all 2 decimal, but this let's keep it as 4 decimal. 7479. Any doubts on this? Substitute this as R. R is 2.3685%. Y 7479%. Power technically 1 or no, ignore that power itself. Ignore the power itself. 2.3685 7479. 1214.37. 1214.37. This part calculation and all you will have to take grip. There is no indication of CCRFI in the question. No monthly, quarterly, half yearly. It is technically simple interest. Technically simple interest, just R minus Y. Just R minus Y. Any doubts in this? 1214.37 is fair futures price. Anybody has any doubts on this? Can we proceed? Any doubts on 1214.37? Clear? Everybody has clarity? Can we proceed? Now write FFP. FFP 1214.37 OR. Rupees 1,21,437 per contract. Into 100. Into 100. Per contract. Into 100. 100 is the lot size. Rupees 100 per point. It's not technically rupees, okay? That 1214 is not rupees, it's 1214 points. Value term is rupees 1,21,437. Your transaction will happen at only 1,21,437 into 100 into 100 because the first line of the question has said 100 points per index, 100 rupees per index. Actual futures price given in the question. Tell me what is the actual futures price? OR 1,22,500 per contract. One two two five. Clear? Any doubts on this? Can you proceed? Any doubts on this? Done. Futures undervalued, overvalued. Futures are overvalued. Futures are overvalued. What should I do? Sell in futures market at 122,500 per contract. Sell in futures market at 122,500 per contract. If I sell in one market, I'll have to do what? Buy in spot market at 119,500. 119,500. Clear? To buy this, I would have taken a loan. Take loan for 91 days. Take loan for 91 days. Take loan for 91 days at 9.5%. Arbitrage gain 122 500, 121 437, 1063, 1063. Any doubts in this? Can you proceed? Clear? Clarity till this is there? Any doubts on this? Can you proceed? Now, what is arbitrages? Whether price goes to 1260 or it goes to 1175, I should make that profit. Arbitrage means making profit without any risk, without any risk. So I should make the same profit. I'll show you the calculation at home. You go through this once more time. So these are my steps. I borrow 119 500, I buy 100 shares, I sell it at the rate of 1225. I press a sell button. I press a sell button. On the last day, I'll press a buy button. There will be a net settlement. There will only be a net settlement. Practical world, what happens? Only net settlement. Index closed at what rate? 1260. I have to repay along with the interest. This will be the amount. You can do calculations later at home. Okay. Cancellation of futures contract. Sell at 1225. Buy at 1260. There is a loss. Loss of how much? 3,500. There is going to be a loss if they give this price. If they don't give any price, don't get into this loss calculation. When initially I explained step, I did not talk about this loss and all. If they give a price, if they give two prices, you may have to write detailed step. You may have to write this detailed step. There is going to be loss. What is the loss? The difference between your buying price and your selling price. What did you do? You press the sell button. That's what you told me. Sell button at 1225. On the last day, 3,500. What did I do? I bought what? 100 share. No, this I will sell now at 1260 in the spot market. I'll sell the shares. I can sell my shares. No, so I sell shares, earn dividend income. Net I make 1063. Net I make 1063. What is happening on the last day? Interest payment, loan payment, dividend income is there, profit or loss in futures is there, and spot sale is there. All put together 1063. If it closes at 1175, I cancel and make a profit, but I sell it at lower rate in the spot market. Net I earn my 1063. Arbitrage means you have to earn 1063. Arbitrage means you have to earn 1063. I'm keeping it in front of you for 2 minutes. You go through this. If you get any doubt, let me know. Understand the sell button, buy button concept and see this calculation. I'll wait for 2 minutes. I'll wait for 2 minutes. This question, as I said, you will need this detailed presentation to be done. You don't have a choice as far as this question is concerned. If they had not given that closing prices, then at least I could have said, or if they say validate your arbitrage gain, then you have to show the steps. Any doubts on this? Let's come to 12. Again, a minute for you to go through the question. Go through 12. Okay, let's read this and you'll understand what extra complications questions can start. A future contract is available on R Limited that pays a dividend of rupees 4. One issue is when dividend is paid is not given, so we'll be taking an assumption there. Dividend is rupees 4, whose stock is currently priced at 125. Each futures contract is for 1000 shares, lot size is 1000. Daily marking to market. Daily marking to market is basically a feature of derivative. That does not mean daily compounding. What is daily marking to market? You will understand when I go to an area called maintenance margin. The corporate treasury bill rate is 8%. Given the above information, what should the price of one futures contract be? I have to value the futures. Then stock price decreases. What will be the price of the futures contract? And as a result of decrease, whether you will be making gain or loss. I'll put it in the format which will be easy to understand. Now write date, spot, futures, spot and futures. Date, day 0, day 0. What is the spot price today? 125. This is a question mark. We'll see later. Okay. They're saying what should the price of one futures contract be? Then they're saying if stock price decreases by 6%, what should the price of one futures contract be? Decrease, sometimes they will say in 3 months decrease is happening, 2 months decrease is happening, 1 month decrease is happening. This futures contract is for what time period? Is there a time period given for futures contract? Where is it given? Okay, 1000 in 1 year. In 1 year. So this is 1 year futures contract. I'll have to get 1 year price. Okay. ICI has assumed, which is what I can also do. Next day, in one day, price has gone down by 6%. In 1 day, price has gone down by 6%, or you can, for all practical purpose, same day price has gone down. Same day price has gone down. So today price was 125 in the morning. By the evening came, price has gone down by what percentage? 6%. How much is the price now? I need to calculate two FFP, one with 125 1 year time period, another with 117 again 1 year time period, again 1 year time period. What I can do additionally, I can say this happened in month 3. Then you have to do 9 months compounding to get month 12 value. You have to do 9 months compounding to get month 12 value. What ICI has assumed, day 0 125, day 0 closing 117.5, day 0 125 will lead to maybe 145 150, I don't know, I'll have to do the calculation, and 117 will obviously lead to a different price. Once this is done, there could be a buy and sell button at these two places. You'll understand third part of the question. There could be a buy button and a sell button at these two prices in the last column. In the last column that is given in part 3 of the question. What, as I said, if I want to complicate, what will I do? I'll give you the spot rate. You take effort, calculate the futures rate. After you do the futures rate, press a buy button, press a sell button. That data is there in the question. I'll come to part 3 in some time. Any doubts till this? Any doubts? Is there any dividend in the question? 4 rupees when? Time is not given. I assume year end. I assume year end. Can I make any other assumption? I don't know. Other assumption is little difficult. I cannot say month 3, month 2, month 5, month 10. So random assumption I can't make. Dividend is assumed to be what? Year end. Now write. Present value of dividend. 4 divided by 1 year discounting, 1 plus R. No continuous, 1 plus R. 4 divided by 1 plus R. 4 rupees is the dividend. I bring it to today by dividing with 1 plus R. What is the rate of interest? What's the value you get? 3 point. What is the complication in the question? I am not giving you the FFP number, or I am not giving you the AFP number. So you are calculating the FFP and writing that as AFP. Any doubts on 3.7? Any doubts on 3.7? FFP with 125 price, adjusted spot price into 1 plus R. Beautiful question. Adjusted spot price into 1 plus R. Into 1 plus R. Adjusted spot price into 1 plus R. 125 minus 3.70 into 1 plus 8%. 8%. Give me the answer. 1 OR. One contract is how many shares? 1,31,000. 1,31,000. Any doubts on this? Repeat at 117.5. Repeat for 117.5. Repeat for 117.5. Any doubts on 131? Please repeat and tell me for 117.5. Listen, 117.5 can have 1 year balance, can have half year balance, 3 months balance. That all you have to see the information. Here they have assumed 1 year balance and done, which is logical. FFP with 117.5. 117 minus 3.7 into 1 plus 0.08. 122.9 or 1 lakh 22,900. Student has said 122.9. Can you just confirm this? Clear? Any doubts on this? Question wanted, what is the value of one contract? One contract is 1 lakh 31, 122, 900. Started on day 0, ended on day 0 itself, or 1 day. Can I do 6 months? Then you have to do 1 plus 6 month interest rate. Dividend, you have to reverse work from 12th month to 6th month, get its present value, remove the present value, compound by 6 months, compound by 6 months, balance period, balance period. The change, they could say that today you bought, in 2 months 6% is the fall. If 2 months 6% is the fall, balance 10-month compounding, dividend 10-month discounting. Any doubts on this? Write the figures here. 131. What are the values? 131 and 122.9. Clear? Now I would have done something in this. Any doubts on first 131 and 122.9? Any doubts? Clear? It says, as a result of stock price decrease, will an investor that has what? Long position in the futures contract realize a gain or loss? What will be the amount of his gain or loss? Long position means you have purchased today. After a day, you may want to sell and cancel it or continue. That's your wish. Continue is your wish. But long position means you purchased button first. You press the buy button first. To calculate profit or loss, you'll have to press the sell button, calculate it. Real sell button you press or not press, that's not my worry. But originally I pressed which button? Long position means originally I pressed buy button, after is sell button. So original buy, long position means original buy button, afterwards sell button. This is the exact question we did some time back, where both the rates were given directly. You did not have any headache. We wrote 5,000, 6,000, 2 lakh profit, 5,000, 4,500, 1 lakh loss. That was given directly. Complication, I am telling, no, I will not give you directly. You do the work of doing the calculation. Any doubts in this? Any doubts in this? Long position means buy first, sell later. Tell me profit loss. Loss or profit here? Loss how much? 8.1 into 1000. 8,100 loss. I suffer a loss in this transaction. I suffer a loss in this transaction. If I had done this in the spot market, my loss would have been 7,500. 125, 117.5. 125 by 117.5 sell. If at all you are done there, their loss would have been 7,500. And in the other market, futures market, losses coming out to be 8,100. Any doubts in this? Can we proceed? Clear? Any doubts on this? I give you a minute. Understand the calculations fully. Let me know if there is any doubt anywhere. 1 minute for you to understand it fully. Let's proceed forward. Let's come to 13. Let's come to 13. Let's come to 13. Mr. SG sold 5 4-month Nifty futures contract. 5 4-month Nifty futures contract for rupees 9 lakh. At the time of closing of trading on the last Thursday, index turned out to be 2,100. Contract multiplier is 75. Based on the above information, calculate price of one futures contract, approximate Nifty Sensex on 1st Feb 2020, maximum contango or backwardation, payoff of the transaction, carry out calculation on months basis. One good thing, months basis calculation. Go through the question, then I'll start explaining. You go through this. Let's go through this question. Mr. SD sold 5 4-month Nifty futures contract on 1st of February. 4-month means it expires after 4 months. When did he do? On 1st February. Let's write it, okay? Let's write it. Date, spot, futures. Date, spot and futures. Spot and futures. Which date we entered a contract? Feb 1. Feb 1. How many contracts? 5 contract for rupees 9 lakh. So 9 lakh divided by 5 is 1 contract divided by lot size. Divided by lot size. 9 lakh divided by 5 divided by, what is the lot size in the question? 75. What's the value? In bracket, sell button. I press the sell button on 1st May. I press the sell button on February 1. On February 1. For which contract? May 31. May 31 contract. Any doubts on 2400? Clear? Then, at the time of closing of trading on last Thursday of May 2020, last Thursday is when it closes, right? May end. It is closing at what? Index is closing at? Index means spot. Spot is closing 2100. Futures will also be same. Last day both are same. So index closes at 2100. 2100. Tell me the profit or loss. Close. Let's close that part. Buy button. Buy button. 5 contracts. 75 lot size. We have done 5 contracts here. Buy button. Profit or loss? First tell me that. Profit. How much? 300. Why profit 300? Sold at 2400. Very clearly mentioned the question. I'm just reading question and writing the numbers, okay? You unnecessarily complicate saying that why is this happening, why is that not happening? It is not doing scenario analysis. You follow what the question says. Why is he selling first? Why is he not buying? All that you try, because students overthink and then they make mistakes. So 300 is the number into 75 into 5 contract, profit 1 lakh. Any doubts on this? Clear? Question wanted me to calculate payoff of the transaction, which is profit 1 lakh 12,500. Price of one contract, right? 9 lakh divided by 5. Very simple. 9 lakh divided by 5, 1 lakh 80,000. Divided by 5, 1 lakh 80,000. Any doubts on this? See here, approximate Nifty Sensex on 1st February 2020, if the future contract is theoretically correct and the same day risk-free rate of interest, dividend yield. What are they asking you to calculate here? What is the requirement? Did you understand this? What is the requirement here? Approximate Nifty Sensex. I've got the answer in live online. They are asking, please go back and tell me this. Go back and tell me this. Once you calculate that, there's another area, another concept called as Contango backwardation, which will come once you get this number. They are saying you reverse work and get this number. Let's do reverse work and get the number. We are going to do no continuous. CCRFI word and all is not there. Able to understand the table? Always write it like this. Spot, future, future to spot, spot to future. We will keep moving forward or moving backward. Right? FFP is equal to SP into 1 R minus Y. Power T and all is of no use. 1 plus R minus Y. R minus Y. 1 plus R minus Y. And they are saying whatever is the price given in the market is theoretically correct. So AFP and FFP is same. What is the FFP? 2000 equal to spot price into 1 plus R I want for 4-month period. 4 months R, 4 months Y. 4 months R, 4 months Y. We did one question, 91 days R, 91 days Y. Here months calculation, they say I don't want to complicate things for you. Do months calculation. R equal to 9%, 4 by 12. 4 by 12. Y, put it there, that's all, answer is over. There can't be simplest. It is just understanding. You'll have to understand exactly the wordings. It will become very simple. I have tried simplifying it further. Even some of you who have attended my regular classes will know that the way now I'm explaining, I'm trying to simplify it to the extent possible. With this, 100% clarity should be there. Only thing is, there is a mindset. Mindset nobody can change. You talk to people, your experience with the derivative area could be little bad, and then you keep in your mind that it is difficult, then nobody can do anything. What is the spot price you got? Any doubts in this? Can we proceed? Okay, there's another concept called Contango backwardation. What are these? Let's understand that and then answer it. Any doubts till this? Can we proceed? Okay, now listen. In the practical world, the stock market can be of, the futures market can be of two types. One is called Contango market. Second is called backwardation market. For doing this, I calculate something called as basis. Technically, I don't need it, but ICI may ask you to calculate basis and then give an answer. Okay. What is basis? I'll discuss in some time. In a normal situation, spot 100, future should be 120 because stock prices are expected to continuously go up. Today 100, future is 120. That is a normal market. That normal market is called Contango. Normal market is called Contango. What is normal market? Today 2376, future 2400. Today 2376, future 2400. That is called normal market or an upward sloping market. Some rare scenario, it can become a reverse market. What is reverse market? Spot 2500, futures 2300, futures 2300. Does that happen in practical world? Yes, when there are lot of price movements, lot of fluctuations there, sometimes in backwardation market can. What is backwardation? You are assuming that in future prices will go down. You are assuming that futures prices will go down. Backwardation, as the name indicate, reverse market. What is reverse market? Futures less than spot. ICI may want you to calculate this. Spot price minus futures price. If you calculate this, you get a negative answer. Don't go with the negative positive answer, but you may have to calculate this. Logic is very simple. Markets going up, that is technically a Contango market. Markets going down is a backwardation market. That is a backwardation market. Any doubts in this? Any doubts in this? Can you look at this number 2400, 2300? Tell me Contango backwardation. 2400, 2300. It is a backwardation market. Spot is 2400. Futures is 2300. See, in a normal scenario, futures has to do what? Futures has to go up. Futures has to go up. Spot is 2400. Futures is 2300. That scenario is a backwardation market. Some of you look confused. I don't know why. Is there a confusion? No, I'm talking about this example. There is an example here. I'm not talking about the sum which you have done. Okay, sorry. I'm talking about this example which is there. I'm not talking about the sum. I'll come back to the sum. MCQ. Spot 2400, futures 2300. Okay, live online also some students have told this. I'm talking about this question. Okay, this example which you see here. Spot price 2400, futures price 2300. Answer here is it is a backwardation market. Question which we are doing, it's a Contango market. Question which we are doing is a Contango market. Any doubts in this? They may ask you to calculate basis. Now, right, basis equal to the question which we are doing now. Basis equal to spot price. I really don't see any utility of this. Okay, zero utility according to me, but I may expect you to write this and then write the answer. 2376 minus 2400. bracket Contango. Negative answer you get, it's a Contango market. Don't go with the basis logic, just go with the logic of market going up, Contango, market going down, backwardation market. Market going down is backwardation market. Any doubts in this? Clear? Can we proceed? Any doubts in this? Go through 14. Go through 14. Okay, let's see this question now. Mr. X, a senior portfolio manager at ABC Asset Management Company, he expects to purchase a portfolio of shares in 90 days. However, is worried about the price increase in coming days, and to hedge against this increase, he wants to take a position in 90-day forward contract. Index currently is at 2290. Let's write the data. You're not going to do anything, okay? Day, spot, futures. Day 0, 2290. Assume continuously compounded dividend yield and risk-free rate of interest 4.16. What should be the forward purchase price of the contract? What is forward is 2290 into e power 0.0416 minus 0.0175 90 by 365. Can you tell me this number? Which of this number matches? Something will. The first one is okay. E power 0.005942 will match, and you'll get the answer. Clear? Any doubts till this? Any doubts in this? No calculation. I don't want you to do any calculation. If I want you to do, I'll tell you. Any doubts in this? Then, what is this question? I'll explain in some time. Last part. Let's first close this last part. Gain or loss if after 70 days index is at what? 2470. So last day 2470 profit loss you calculate and close it. One buy button, one sell button will come. Which is buy, which is sell, we'll see in some time. Clear? This is one part of it. Second part, they said after 28 days index is at what? 2450. So ideally you have to take this 2450 to another 62 days. ICA has done different way. You see that answer at home. I don't want you to follow ICA answer because it's not logical, but the e power value will not match. They have done little differently. What you should do here is day 0, 2290, 2303, day 28. Day 28, they are saying index is at what? 2450. Same formula, 62 by 365. Same formula, 62 by 365. The given below value will not match there. And our answer and ICA answer will have a slight variation. I've given both the answers. You see this at home, okay? Into 62 by 365. Clear? Now, whether it is a buy button or sell button, let's understand it. I wanted to buy shares in the spot market. Okay? They are saying, I want to buy a portfolio of shares in 90 days. However, is worried about the expected price increase in shares in the coming days, and he wants to take a position in 90-day forward contract. See, if I have money, I will buy gold. If I do not have money, I'll enter into a contract to buy gold. I'll enter into a contract to buy gold. This is not arbitrage here. Here we are not doing arbitrage. Okay, don't say one buy, one sell. All that is not there. Spot market, futures market, all that logic is not there. Here I wanted to buy gold. Went to the shopkeeper, said give me gold. He said give me money. I said money is not there. This is the situation. I need to buy the share, but in this 90-day period, gold prices can go up. So then what did I say? I don't have money. He says pay 5%. Pay 5% margin you pay, and we will freeze the rate. So original position is buy, opposite position is sell. Original position is buy, opposite position. That is originally you will press the buy button and later you will press the sell button. Later you will press the sell button. Why are we doing this? In case prices go up in this period, futures will give me some profit. With that profit and my base money, I'll buy it in the spot market. I'll buy it in the spot market. See, anybody can buy it in the spot market, can buy it in the futures market. If you just, your purpose is only to do one transaction, then no two places. Don't buy here, don't buy at the other places. What is arbitrage? Buy at one place, sell at one place and make money. Make money. If you are going to do at both the places, technically you learn something called as hedging. Hedging will give you zero profit, zero loss. If your objective is to make zero profit, zero loss, then do at both the places. Practical world, everybody will not have an objective of zero profit, zero loss. I want to make money. For making money, I have to take risk. I am now speculating that price may go up in the market. I told if it's going to go up in the market, please go and buy today itself. Gold prices will go up. Unfortunately, money is not there. If money is not there, how will I buy? So here you see, worried about the expected increase, hence he will enter into a long position. Long means you will buy it today. 2303 was the original answer, compared with 2470. 2303 with 2470. This part I feel we should do. This is my logical solution. From 2450 I have to go to 2460. From 2450 I have to go to the future rate. ICI has done little differently. You do see that at home. Okay, I don't want to complicate because of an illogical solution. That complication I don't want to bring in the class as of now. Clear? With this, my valuation area is over. With valuation, in some time we are going to do hedging. Any doubts till this? Any doubts in any of the concepts till now? So let me quickly revise what we have done till now, and maybe one concept is pending. I'll discuss that also. First, we learned that there is a spot market, there is a futures market. Spot market will give you spot price. Futures market will give you spot price multiplied with something futures price. Okay. Futures you can have for January, February, March, April. There are two types of futures price. One is actual futures price. Second is fair futures price. Actual futures price you can buy or sell only at this rate. Fair futures price is your theoretical price which you will use as AFP if no other information is there in the question. I can do normal compounding. I can do continuous compounding. What is normal compounding? Into 1 plus R power n. Continuous E power RT. R can be monthly, N can be number of months. R can be quarterly, N can be number of quarters. R can be half yearly, N can be number of half years. Or R can be yearly, N can be number of years. Or you can do E power RT. No dividend, no storage cost, proceed ahead. Dividend in rupees, remove present value of dividend. Storage cost in rupees, add present value of storage cost. Dividend yield in percentage, remove from R minus Y or R plus S. This is how you will calculate E power RT value. If at all question does not have information, do this. These are the variables which will impact my futures price. So somewhere search for all of the spot price, time period, risk-free rate of interest, dividend, storage cost and a compounding frequency. What compounding frequency do I take? No indication, power 1. Indication there, CCRFI. What indication for CCRFI? Daily compounding, continuous compounding, E power RT value given. Or if they give 1 month interest rate, monthly compounding. If they say interest rate per month, monthly compounding. Interest rate per quarter, quarterly compounding. No indication, just go ahead and do compounding once. Arbitrage strategy comparing AFP and FFP. AFP greater than FFP, futures are overvalued, sell in futures, buy in spot, take a loan, gain is difference between FFP and AFP and vice versa. Cost to carry is the difference between FFP which you calculate as per formula minus the spot price, Dividend yield, if they give one dividend yield, please copy paste the same and proceed it. But if they give different for different months, take average. Take average for your futures time period. Convenience yield, extra benefit in the spot price or disadvantage in the future price. What is disadvantage in the future price? You are saying it has to be 1000. Market is punishing it to 960. 1000 minus 960 is future value of convenience yield. You want to bring it to today, discount this by E power RT or divide by 1 plus R and get present value of convenience yield. Okay, there's a term called implied risk-free rate. Let's understand with one example also. What is implied risk-free rate? Normally, when I do futures valuation, I use risk-free rate of interest to do the futures calculation. If somebody is investing in a stock market or somebody is investing in a futures market, he's taking risk and earning money. Arbitrage means without taking risk, you are going to earn money without taking risk. For example, spot price 20,000, Fair futures price 24,000. What is the gap between? How much percentage is the gap? What is the percentage gap here? 20%. Ideally, in 20%, 20% is for 6 months. R is, what is this? FFP is equal to spot price into 1 plus R. What is FFP? 24,000. What is spot price? 20,000 into 1 plus R. R is coming out to be 20% for what period? 6 months. People are earning 20%. Very high, but I can't help it. Okay. 20,000, 20% for 6 months. In a year, people will earn 40%. I get into arbitrage. If I get into arbitrage, I will earn more than 40%. I will earn more than 40% if I do arbitrage. Arbitrage gain is extra 1,000 rupees. Arbitrage gain is extra 1,000 rupees. What is extra 1,000? Difference between FFP and AFP. So I will earn extra 1,000 on today's price. 20,000, 5% for 6 months. I will earn extra how much? 5% for 6 months, and 20% for 6 months is the risk free rate. 25% is what I can earn. What is implied risk free rate? Normal plus extra which you can make, plus extra which you can make. What is extra? Arbitrage gain. Any problem you did question. First question we did, it was 1,800. Fair futures price was 1908. Actual futures price was 1950. What is implied risk free rate? The gap here was technically 12% in that question. Extra I can earn 42. What is 42? Difference between FFP and AFP. On what amount? On the spot amount. Into 12 by M into 100 to annualize it. 12 by M into 100. Arbitrage gain is the extra profit for an investor. Is a extra profit for an investor without taking risk. Somebody earns more by taking risk. That is not risk free rate. Without taking risk, why are you earning money? That's called implied risk free rate. Then physical settlement, deliver the product, get the share, or deliver the product, get the money, deliver the share, whatever it is. Net settlement, buy button, sell button difference. Buy button and sell button difference. And Contango market and the backwardation market. Contango market is basically normal scenario, upward sloping. Backwardation is reverse scenario. Any doubts in this? Clear? Let's take a break. We'll continue at 10:20. Okay, let's continue with the discussion. The futures part technically has three things. One is valuation, which we have done. Second is hedging, which includes valuation. So we are going to do that in some time. And I now proceed to the third segment first, which is called initial and maintenance margin. There's something called as margin. What is it? So that you understand the working of futures fully. And then when I do hedging, maybe I may able to relate, you may be able to relate it a little better. What is initial and maintenance margin? Let's understand. See, you entered a contract with a jeweler saying that you're going to buy gold or sell gold. When you entered the contract, jeweler trusted you, you trusted the jeweler. On the last day, the customer is not ready to fulfill his obligation. I gave initial example and is not ready to fulfill the obligation. Reason? He knows that he's at a loss and he doesn't want to fulfill the obligation. In the stock market, they don't want all this headache. So what they do is the broker through whom you enter into a contract, Zerodha or a Grow or an ICICI Securities, they will collect some money from you at the beginning. That's called initial margin. In one of the question, there was a margin of 34,000. I said it will not impact the calculation. You will understand now maybe more clarity. So I will pay an initial margin. Once this margin is paid, daily profit or loss is calculated. That's called daily mark to market. We saw in one question there was a term called daily marking to market. Daily basis profit or loss is computed. If we are having profit, our balance will go up. If we are having loss, our balance will go down. So margin refundable deposit with the broker for allowing us to take position in futures. No trust factor logic and all. You give me, put some money and then you do it. Margin deposited at the start of the contract. There are two ways this margin can be calculated. One way is they'll give you a value of a contract. There will be some percentage, could be 10, 15, 20. Practical world, normally for Nifty and all, they collect 10%. but this margin can change also. When can it change? For example, election results are going to come. On the day of election results, prices move up and down significantly. So a person can make huge profit, can make huge loss. That time they'll say margin is double of the normal. They may increase the margin, they may decrease the margin. Objective of the margin is very simple. On the last day, I don't want this guy to act smart and say I don't want to fulfill the obligation. That's the only purpose of this margin. So it can be value of one contract into some percentage given in the question into number. There's one more formula which says daily absolute change. What is daily absolute changes? Historically, the nifty value of one contract has changed by 10,000 rupees, gone up, gone down by 10,000 on an average. 10,000 up, 10,000 down. Historical data. I looked at the historical changes in the value of the contract. On an average 10,000. I take that as the margin, and to be on the safer side, I collect little bit extra. What is extra? 3 times of the standard deviation. How standard deviation would have been calculated? Whatever we learnt in the portfolio chapter, looking at the historical profit or losses, you would have calculated profit loss every day, taken the daily absolute change, which is average, and then done a standard deviation, 3 times of standard deviation to be on the safer side. Despite this margin, can there be a loss and all? Depends. Okay. So this I collect from the person. First day I collected. Profit happened, margin went up. Profit loss happened, margin goes down. So this will keep happening on a daily basis. Then broker also has something called as a maintenance margin. Initially I collected 1 lakh, but I'll say 1 lakh becoming 99,000. I don't want to disturb you. 1 lakh has become 99,000. I don't want to disturb the person saying that 1 lakh has become 99,000. You give me more money. Normally, there'll be a limit. If 1 lakh goes below 80,000 or 70,000, that's called maintenance. There'll be a limit. Limit is maintenance margin. I set that limit. After the limit is set, I will call you. If it goes below 70,000, you have to bring it back to 1 lakh rupee. Actual margin is lower than the maintenance margin. What is maintenance margin? It could be some percentage of initial margin, or they will give saying that this is the whatever, some data will be there on the maintenance margin. 1 lakh is my total margin. Maintenance margin is 80,000. I collected the money. Happily things were happening. 1 lakh became 99, 98, 97, 96, 95, or went up. Broker did not disturb me and all. But moment it went below 80, he told, please replenish it back to 1 lakh rupee. Your job is to replenish it back to 1 lakh rupee. You are not doing it. He himself will press the buy or sell button on your behalf. Moment you press buy or sell button, your profit or loss is decided. Return whatever is your balance money and say you are over. That's all. He himself, practically people do. Broker, if you're not replenishing the money, he himself will press the buy or sell button. Auto square off. It's called auto square off. They will do square off at their end if you're not bringing the money which is needed. Clear? Okay. So actual margin lower than maintenance margin. Margin call with there. You will have to bring it back to the initial level. If you are between 1 lakh and 80, he will not speak to you. You need not speak to him. He will not disturb you. You also need not disturb him. More than 1 lakh, you are allowed to withdraw if you want. If it's 1 lakh 10, withdraw 10. He will not tell you anything. You just press withdraw 10,000. Money from your demat account will come to your bank account. So amount withdrawable, balance in the margin account minus the initial margin. Now, I could be a buyer initially. I could be a seller initially. If I am a buyer initially, price went up, profit. Price went down, loss. If you are a seller initially, exact reverse will happen. Seller initially, reverse will happen. Buyer initially, easy to understand. I bought something, price went up, profit. Price went down, loss. Daily profit calculate, daily loss calculate, daily margin calculate. What is daily margin calculation? There is an initial margin, up, down, up, down, up, down. It will keep happening. As long as you are above maintenance margin, broker will not disturb you. You need not disturb the broker. If you are going beyond initial margin, you can withdraw the money if the question gives that information. Clear? Any doubts on this? We will do one question on buyer, one question on seller to get grip on this. Any doubts on the concept here? Let's see a question. Good MCQs are there. I'm not doing MCQs because I'm extensively discussing the descriptive question. MCQ I would want you to practice at home. Okay. Question 31. Sensex futures are traded at a multiple of 5050. Consider the following quotation of Sensex futures in the next 10 trading days. Next 10 trading days, they have given the prices. They have given technically there is a high, low, and closing. Three prices they have given. High is given, doesn't matter to me. Low is given, doesn't matter to me. Closing is given, which is what will matter to me. They have given 10 prices. You have bought what? One Sensex futures contract on which date? On February 4. Average daily absolute change is 10,000. Standard deviation is 2,000. Average daily absolute change is given. Standard deviation is given in the question. Maintenance margin is 75% of the initial margin. You are required to determine daily balances and payment of margin calls, if any. Okay. Now, right. Initial margin, nothing much for you to read. Initial margin, daily change, daily absolute change, plus 3 times of standard deviation, just to be on the safer side. 3 times of standard deviation. 3 times of standard deviation. The daily absolute change is 10,000. 10,000 is the daily absolute change given in the question. What is the logic for 3? No logic. They've said just to be on the safer side. You may argue I want to do 5, 10, 15, 20. 3 times they said you collect extra money and keep it with yourself. 3 into what is the standard deviation? 2,000. I'll collect how much? When I say I'll collect, it will just hit from his bank account to the demat account. It will be there in the demat account, 16,000 rupees. This 16,000, I'll also put another condition called maintenance margin. What is the definition of maintenance margin as per the question? 75% of initial margin. See, 16 becoming 15, I don't want to disturb for small change and all, but I'm saying 75% is my maintenance. Below that you go, then I will tell you to replenish it back. Maintenance margin, 16,000 into 75%. I tell you to pay this, keep this amount in your bank account at any point, in your demat account at any point of time. There will be daily profit or loss calculated. We have bought one contract. You can buy 10 contract also. If you buy 10, the maintenance margin will be multiplied with 10. Any doubts on this? Can we proceed? Any doubts on this? Now, I don't know the number of columns. It could be more columns. Let's write it. I may need 6, 7 columns. Not very sure. Okay. First 2 columns, copy paste from the question. Date and price. I will need 6, 7 columns. I'm not very sure. Date, closing price. Copy paste from question. Feb 4. 3296.5. Feb 5. 3294.4. Feb 6. Just first 5 days. Okay. We'll not do beyond 5 days. Just 5 days. 3230.40. Feb 7 till Feb 10, write it. Okay, don't write beyond that. Feb 7 3212.30. If there is no margin call, I may increase the number of days, but first 5 days as of now. 3267.50. When did we buy? When did we buy this contract? 4th. I have bought it on 4th. Any price given on 4th? At what price did I buy? Any price given for 4th? You purchased it on 4th. Any price given? No. I assume I purchased at this closing price. This is my assumption. Okay. So right below it is assumed purchase at closing price of 3296.5 on Feb 4. On Feb 4, 3296. Third column, profit loss. Feb 4, I don't make any profit. No profit, no loss. Feb 4, no profit, no loss. Clear? February 5, price went up, went down. Down, loss for me. I am a buyer. I am a buyer, loss for me. Write the loss amount. 3294 minus 3296. What is the lot size given in the question? 50. This is my loss. Closing price minus opening price into lot size. Closing minus opening. Tell me the loss amount. 105. Next again calculate. 3230 minus 3294.4 into 50. Again, I think we have suffered a loss. 3200. Again, closing minus opening into 50. 3200 loss, 105 loss, 905 loss, minus 905. Feb 10. 3267.5, 3212.3. I think this is a profit. Last situation is profit. How much profit we made? 2007. Other 5 days at home you do it, okay? Any doubts in this? Any doubts in this? Clear? Every day we are calculating. Buyer is easy to understand. Seller I'll explain in some time. Buyer means price going up is profit. Price going up is profit. We have already done this. Can we proceed? Next. Margin, opening margin. Opening margin. Closing. Just give me a minute. Opening margin. Okay. Closing margin before call. Closing margin, totally 7 columns, okay? Opening margin, closing margin before call, margin call, revised balance, revised closing. Opening margin, closing margin before call, margin call, revised closing. Clear? 4 columns, okay? Opening margin, closing margin before call, margin call, revised closing. Right? Opening margin 0. This day we started with 16,000. We deposited 16,000 that day. We deposited 16,000. And closing is also 16,000. This opening margin column can be avoided also. I will go copy paste it here now. This is easy for me to explain. 16,000. Next month, next day 16,000 is the opening margin. You suffered a loss, remove 105. Suffered a loss, remove 105. 15. This will be this. If you do 7 columns, any question easy to understand, okay? I think my solution may have 6 columns. 15,895. Is it below 12,000? No. No margin call. I need not bring in any extra money. No extra money. Same 15,895. Same 15,895. Same 15,895. Next month, next day 15,895 start. 15,895 start. Reduce the loss value. 15,895 minus how much loss? 3,200. Minus 3,200. How much? 12,695. Is it below 12,000? No, no margin call. You can happily be with 12,695. You can be with 12,695. Any doubts on this? It's a very simple calculation. Once you understand concept, there's nothing there. Next 12,695. After the loss, 12,695 minus 905. 11,790. Is it below 12,000? Bring it back to 16. Take it back to 16,000. Take it back to 16,000. So margin call is bringing in extra money. Bringing in extra money and take it back to what level? 16,000. You have to take it back to 16,000. So this is 16,000 minus 11,790. I will be asked to bring money and take it back to what level? 16,000 rupees. Put together it is 16,000. Next day opening 16,000. Next day opening 16,000. We have made a profit. Value will go up. If you want, you can withdraw that. Question is not talking about withdrawal. Question is not talking about withdrawal, but if you want, you can withdraw that money. Extra money you can withdraw, and deficit is there. You have to take it back to the initial margin. You have to take it back to the, you don't say that I'll take it back to maintenance. No, take it back to the initial margin. So this is 16,000 plus. You get 18, no margin call, 18,760. This will go on for another 5 days. Okay. Any doubts on this? Can we proceed? So question may ask you to calculate these balances. You see the balances here. I've done 6 columns. 7 columns will make it very, very clear. No confusion at all will be there. Okay. We have done this. Some question may ask you to then say calculate profit or loss, assuming you do this entire table. One way of calculating profit or loss is put a total of all of this. Put a total of all of this. Tell me the total of all of this. It's there in front of you in the notebook, in the screen. Just put a total quickly. All total, minus, plus, minus, plus. Total of all of this. They may ask you to calculate profit or loss. 9,000. 96. Positive, negative. Negative. Okay, loss. So this is one way. Okay. Second way, right? Profit loss is equal to 50 into selling price minus purchase price. 50 into selling price minus purchase price. This is even an easier way, and this can cross validate whether your calculations is right or wrong. Total you put and cross validation is this. 50 into, at what rate did we buy we made a purchase at what rate? 3296 point. On the last day, now I press the other button. I press the buy button initially. Last day I press the sell button. Last day I press the sell button. I'll repeat again. 50 into selling price minus purchase price. What is 50? Lot size. Lot size. What is purchase price? You have told 3296. Last day price 3102. You look at the difference. You should get exactly same number. If you get anything different, calculation mistakes have happened somewhere. 10 days calculation when you do, in a hurry you may end up making mistake. This is second way. 50 into selling price, purchase price comparison. What is purchase price? Day 1 or day last, depends, because what you did I don't know. If you buy first day is purchase price, last day is selling price. If you sell first day is selling price, last day is purchase price. Any doubts in this? Clear? Any doubts in this? This is another way of doing it. They may ask you to calculate profit or loss. Can we proceed? Clear? Just give me a minute. Okay, I'm going to do question 32. We will do only short question. Okay, short question. Let's read it. Price of March Nifty futures contract on a particular day was 9170. Minimum trading lot is 50. Initial margin 8%. Maintenance margin 6%. Index closed at the following levels on next 5 days. Mark to market cash flow. What is mark to market cash flow? Is daily profit or loss. Mark to market. You are marking your values to the market today. Mark to market and daily closing balance, which is what we did in the previous question. And next is net profit or loss on each of the contract. To make it little complicated, we are going to do 5 contracts. I sold 5 contract. Okay, I'm going to do 5 contract. 5 means every number will be multiplied with 5, but just I want to do. And only short portion we are going to do. Short portion means you sold at 9170 initially. Later on you will reverse it. Later on you will reverse it. Clear? 5 contracts. I'm changing the question as 5 contract. Go through the problem first. 5 contracts. and we are going to do short position, only the short position. We are changing the question as 5 contracts. Let's start. Initial margin is equal to, what is the price at which we have bought and sold? 9170 into 50, this is one contract, into 5 into some percentage given. 9170 into 50 into 5 into 8%. 1,83,400. The printed answer obviously will have it for one contract. 1,83,400. Maintenance margin. See what this 1,83,400 mean is, to buy, I am making a purchase of technically some 22 lakh rupees. 22 lakh, 9170 into 50 into 5. I am buying 22 lakh worth of Nifty by paying 1,83,000. By just paying 1,83,000, I am buying how much Nifty? 22 lakh Nifty. So I have buying or selling, whatever it is. I am buying or selling Nifty of 22 lakh by just paying how much? 1,83,000. Maintenance margin, what they said? 6% on the original value. Not on, last question said percentage of initial margin. This is 6% on the original. 9170 into 50 into 5 into 6%. 137. Open exact same columns. Exact same 7 columns. Any doubts on this? We are doing short position. I'm repeating, okay? I'm doing short position. Long I'm not going to do. Short position I'm doing now. Open exact same column. Date, closing price, profit loss, date, closing price, profit loss, opening margin, closing margin before call, margin call, revised closing. It will start with day 0 and then there are 5 days given. There is a day 0. Day 0 is the price at which we enter the contract, and then they have given 5 days prices. 9170, 9380, 9520, 9100, 8960, 9140. Now let's understand what is short position. Short means you have sold at 9170. Daily the broker will say you sold, you bought, you sold, you bought, you sold, you bought. That's what the logic. So I sold at 9170, purchased at 9380. The next day sold at 9380, purchased at 9520. The transactions will keep happening like that. That's what broker does in the calculation. Here if prices go up, it is a problem for me. Prices going up is a problem. How will I do calculation? Listen. Closing price, listen for a minute. Closing price minus opening price, just like the previous one. What is the lot size? 50. Number of contract -5. Number of contract is -5. Have the same formula. Closing minus opening, or you want to then do the other way around, then you have to do opening minus closing. I'm telling you to do the same way. Closing minus opening into the lot size, multiply with -5 contract. Multiply with -5. Instead of buying something, you have sold something. You don't understand -5, then ignore the formula. Think logically every time and then do the calculation. What is thinking logically? Price going up, loss. Price going down, profit. Clear? Any doubts on this? Into -5, you understand, write it. Not able to understand -5, then please do the other way around. Clear? So, to put it simple, 9170 becoming 9380 is a loss for me. Is a loss. How much is the loss? -52,500. -52,500. Second day price went up, price went down. Again problem. Going up is problem for me. Closing minus opening into 50 into negative 5. How much loss? 35,000. Third day, huge thing has happened for me. Price crashed significantly. Price has crashed significantly. Day 3, I'm very happy. Day 3, I'm very happy. Price has crashed. Price goes down, I'll be very happy. A seller is always waiting for a price to fall so that he can buy it back at lower price. So that he can buy it back at, see, seller has to buy it back at some time. You sold, you have to buy it back. You want the prices to go down, buy it at a lower rate and make money. So this is 9,100 minus 9520 into 50 into minus 5. How much profit? 1,05,000 profit. Live online guys, if there are any doubts, you will have to tell me. Any doubts on this? Clear? Next, 8960 9,100 into 50 into minus 5. Exact opposite of buyer, okay? That's all you'll have to remember. Exact opposite of buyer. How much? Negative? Positive, okay. Positive 35,000. Positive 35,000. Last one is 9140 minus 8960 into 50 into minus 5. Negative? Tell me the total of this column. This is the overall profit. And then we will do a cross verification later. Cross verification later. In calculator you can do. Overall total will give you the profit or loss. What the profit or loss? Profit loss. Okay, 7,500 is the total. Any doubts on this? We will do a cross validation in some time. That's the good part, that you can cross verify your answer in some time. That we will do it in the calculator also. I will show it in the notebook here. Any doubts on 7,500? Can we proceed? Any doubts on the numbers here? Fairly simple, straightforward calculation. Start. Opening margin 0. We started this day with a 0 margin. Deposited how much? 1 lakh. 84. Okay, 83,400. This 183,400 will go down. Loss is there. Minus 52,500. Minus 52,500. 30,000. 130,900. Any doubts on this? Unfortunately, goes below 137. My limit is 137. My limit is 137. If you go below 137, bring the money back to 183. So I have to now do 183 minus 130. I have to bring back this money. I don't have a choice. 183,400. 183,400. Very simple calculation. Understand workings properly. Any doubts on this? Question has asked for one contract only. I purposely did 5 contracts. Okay. 183,400. What is the value after loss? Which is still okay. My limit is what? 137,550. My limit is 137,550. Okay with this. Okay with this. No problem. So I continue at 148. Next day bumper profits for us. 148 plus how much? 1,05,000. If I want, I can withdraw. Question may say that he withdrew any money above the initial margin, then show withdrawal. Then you have to show withdrawal. What is withdrawal? Like margin call is deposit, withdrawal can be opposite. How much is this? No margin call. We are at 253,400. Again, value is going up further. Extra 35,000. How much? 288. No margin call. We are at 288,400. Last day 288. We suffered a loss of how much? 45,000, negative 45, 243, 400, 0, 243, 400. Any doubts in this? Straightforward, simple computation. Any doubts in this? Into minus 5, understood, great. Not understood, then think logically every time. What is thinking logically is you'll have to compare both the price, then decide profit or loss. If at all by mistake you make any errors, because sometimes you thought profit but it's a loss, you'll get stuck in the last step. You'll get stuck in the last step. Now, right, overall profit. This in exam not needed if you have already put 7,500 total. Overall profit is equal to number of units into selling price minus purchase price. Selling price minus purchase price. Number of units is number of contract into that lot size, whatever it is, into selling price minus purchase price. Either day 0 is sales or day 0 is purchases. One of them is sales or purchase, other is opposite. Overall profit is equal to 5 contracts into 50 units into. Did we buy initially or sell initially? Sell at what rate? 9170, na? 9170. Now you press the other button at closing price, which is 9140. This should give you that 7,500. If not giving, somewhere in between you made a mistake in your calculation. That is possible, you making mistake. So this is a last final check for you. Final check is this. Any doubts on this? In case you thought it's a loss and it is in fact a profit, you will get stuck in the last step. In the last step, you will get stuck. Any doubts on this? We are getting same 7,500. With this, my discussion on initial margin, maintenance margin is over. If you want to, for practice, this question you can do long question, or preferable do the next question. 33rd question is there in the material. You practice that question. With this, you will get grip on this area. Any doubts on this? Now, why I discussed this before is because now I'll be moving to an area called hedging. In hedging, somewhere I will keep talking about this maintenance margin sometimes. So students were getting confused. So it's better. I thought I'll close this and then come back. Any doubts on this? Can we proceed now? Okay. Now we move to an area called something called as hedging. What is hedging? What are we doing? Let's try to understand with questions only. Again, I'm going to go to the question, do it in the question, and then come back and explain the concepts. That is what I'm going to do so that it's easier for you to understand. Any doubts till this? We have done valuation, we have done maintenance margin, we have done initial margin. In hedging, valuation will keep coming back. Maintenance and initial margin will not come back. But that concept understanding will help me to explain certain points easily. Let's get to the question now. Let's come to question 15. BSE 5,000, value of portfolio 10 lakh 10,000. BSE 5,000, value of portfolio 10 lakh 10,000. Risk free rate of interest 9%, dividend yield 6%, beta of portfolio 1.5. We assume future contract on the BSE index with 4-month maturity is used to hedge the value of portfolio over the next 3 months. Hedge the value of portfolio over the next 3 months. One future contract is for delivery of 50 times the index. Based on the above information, calculate price of future contract, gain on short futures position if index turns out to be 4,500 in 3 months. Clear? I'll read it again. Let's understand it and then we start doing it. First requirement is price of futures contract would mean fair futures price calculation. You will have to do a fair futures price calculation. Today the spot price was given as 5,000. In the earlier page it was given BSE is at 5,000 and I have a portfolio of how much? 10 lakh 10,000. I have a portfolio of 10 lakh 10,000. What is hedging? Why are we doing all this? You'll understand as we proceed. I went to the market to do hedging. What is hedging? Sometime assume a future contract on the BSE index with how many months maturity? So I went to the market and found a contract with how many months maturity? 4-month maturity. I said, let's take this contract. Let's take this contract. I'm hedging for something called as 3 months. That wording is of no use for you. Let's ignore it for the time being. One future contract is for delivery of 50 times of the index. They want price of one future contract and gain on short future position. Why short? You will understand as we proceed. If the index turns out to be how much? In how many months? 3 months. Let's write the data the way we write. Right? Date, spot, futures. Spot and futures, 4-month futures. I have gone with a 4-month contract. Spot, 4-month futures. Write the data this way. You will 100% get answer. Very simple. Spot, 4-month futures. Day 0. Day 0. Spot is at 5,000. We don't know this. We will do it in some time. Spot is at 5,000. We don't know. We'll do it in some time. Then suddenly you're coming back in month 3. We did one question where there was a 6% fall. And I told you that sometimes they may give for a different time period. So in 3 months, this 5,000 has gone down to how much? Again a question mark. If it has gone down by month 4, copy paste both. If it's in month 4, copy paste both. 4,500, 4,500. But it is happening when? By the 3rd month. Why are they giving 3rd month? That's their wish. They have given us 3rd month figure. 5,000 became 4,500 in how many months? 3rd month. From 5,000, I have to compound by 4 months. 4,500, I have to compound by 1 month. I have to compound by 1 month. They have given risk-free interest rate. They have also given dividend yield. Both are given in the question. Risk-free interest rate is given. Dividend yield is given in the question. In the question, have they given any CCRFI indication? Any CCRFI indication? No. Now write fair futures price. Any doubts on the table here? The moment you put it this way, your mind will automatically tell you what needs to be done. If you put it in this approach, you will be able to handle any type of question. Fair futures price is equal to spot price into 1 plus R minus Y. 1 plus R minus Y. Original 5,000 into 1 plus. What is the risk-free rate given in the question? 9% into 4 by 12. 4 months calculation. 4 by 12. Yeah, whatever answer. And 6% into 4 by 12. 4 by 12, 4 by 12. 4 by 12, 4 by 12. We did this in some time back where they said 125. We calculated, then 117.5. We again did a calculation. What's the value you got here? 505050. So one question mark is done. This value is 5050. This question mark is 5050. Clear? Another question mark is also there. What is the question mark? You are in month 3 and I want the month 4 value. Month 3, I want the month 4 value. If I had told you that do time value of money, we would have been very happy. Only problem is student will not understand what exactly is needed, and which is where they get confused. 5,000 became 5050 at the end of which month? 4 month. Now again, FFP is equal to spot price 1 plus R minus Y, 1 month compounding. Only 1 month compounding. 1 plus R minus Y. Tell me what is the spot price? Into 1 plus 9% into 1 by 12. 6% into 1 by 12. 1 month. 9% into 1 by 12. 6% into 1 by 12. Answer is how much? No. I think Pavitra, you have done a mistake. Just check it. You have to use 4,500. 4,500. So answer is what? 4511.25. Always put it in this table format. It will guide you to the answer. This is a new table format which I've started only in this batch of material. So this table format will guide you to the answer. 4511.25. Any doubts in this? Now comes the next layer of complexity. What were the two layers of complexity? Let's understand. First question we did, I gave you the futures value. You calculated profit or loss. Second question, I gave you the spot price. You calculated the futures price and calculated the profit or loss. This we have done it. How many contracts is also not given, which is hedging. How is it hedging is done? I'll explain. How many contracts is not given? When you did this question, when we did this 117.5 problem, we were given in the question that how many contracts are done. One contract, did I buy, did I sell? Everything was given. One question we did, that Contango and backwardation. Question did tell how many did we buy or how many did we sell. Here I don't know what did I do. Did I buy? They are talking about short position, but still I will have to logically calculate and then come to this. Did I buy something? Did I sell something? Can you please give information on that? It is not given directly in the question, which is where concept of hedging is going to come into picture. Any doubts till this? So three parts always is there. One, valuation, which is tested in the question. Profit calculation, tested in the question. Third part, number of contract also not given, which is hedging. We did first question where simple. I give you the month 4 number, one number happily plus minus and calculated. Second question, I give you today price, you calculated and then calculated the profit or loss. Now today if I ask you calculate the profit or loss, I don't know, did I do one contract, two contract, three contract, four contract, five contract? Where is it given in the question? Also I don't know, did I do short or long? It does talk about the word short position, but still I don't know clearly whether it is a short position did I do or a long position did I do. This is the only difference between those three layers of question. First question, two prices given, you were just doing buy button, sell button. Second question, spot prices were given, calculated buy button, sell button. Third layer, calculated, but I don't know what did I do also, which is where hedging is going to come into picture. Next, number of contracts. Number of contracts. Security beta weight product. Security beta weight product. Security beta weight product. Understand this working very clearly. Once this is understood, this chapter is over. Technically, this chapter is over. I'll be just doing time pass of doing more questions. Security beta weight product. Our portfolio. We already had one portfolio. There will be some beta given in the question of our portfolio. 1.5. What is the amount of our portfolio? 10 lakh 10,000. Multiply these two. 1.5 into 10 lakh 10,000. Into 10 lakh 10,000. 15 lakh 15,000. BSE futures. Sorry, Nifty futures or whatever name. BSE futures. BSE futures. What does this and all? I'll explain. First, you write whatever I'm telling you to write. BSE futures. Write beta one time. Beta one time. Overall beta. Overall beta or overall. If I am hedging, I want beta to be 0. 0 beta means no risk. Hedging means I don't want any risk. You are having a portfolio and you are saying you don't want any risk. I tell him, sell your portfolio if you don't want any risk. He is saying, no, election results are coming. Just for 1 month, I don't want any risk. So for this 1 month period alone, I want to hedge. Question was talking about some 3 months hedging they want to do. After that, they will release the hedge. If you keep permanently hedged, it means 0 profit, 0 loss. Why are you investing itself? I invested in a portfolio, 10 lakh 10,000. One option, election results are coming. It's a very big event. I don't want to be impacted. What can I do? Sell my portfolio. Moment I sell, securities transaction tax, brokerage, short-term capital gain, long-term capital gain. I don't want this headache now. So then the other option is I'm going to do hedge through futures. What is hedging? Beta 0. What is the use of beta 0? Market going up, my portfolio 0% change. Market going down, My portfolio 0. Overall, how does it happen? You will understand. So I did 0 beta. I did 0 beta. What is weight is total of this. Listen, this value can be anything. BSE futures can be 1 lakh, 10 lakh, 15 lakh, 20 lakh, 30 lakh. It can be anything. It will not come in the weights total. What is weights total is my asset or liability. It's a balance sheet. In a balance sheet, I will have my portfolio, but BSE futures will not come as an asset or liability because I don't pay this money or I don't receive this money. What will I pay? Initial margin. I'll just be paying initial margin. So when I put a total in the weights column total, this question mark will not come. Anyway, I don't know the question mark also, but even if I know also, it will not come in the total. Reason is you are not paying this, you are not receiving this. What will you pay? That's why I did the earlier segment first. Maintenance margin and initial margin. What is this overall weights total? My assets minus my liability. My assets minus my, if you short sell something, liability, borrow something, liability, invest in risk free, asset, all asset minus all liability. Portfolio is an asset. Risk free, if you create some deposit, it is an asset. If you borrow something, it is a liability. If you do short sell, there's something called a short sell, that is a liability for you. That is a liability. Total is 1010. Last column 0 into 1010. 0. 0 into 1010, 0. Clear? Reverse working, 0 minus 1515. Negative 1515. Negative 1515. Reverse working, 0 minus 1515. Minus 1515. Very simple approach. Understand the table once, you will be able to handle any type of question. You don't want to do table approach, formula is also there, which also you can do. That's your wish. Any doubts on negative 1515? This column, negative 15 divided by 1. BSE will always have 1 beta. Negative 15 by 1. We get answer is what? Negative 15. We get answer is negative 15 lakh 15,000. This number is the critical number. I'll explain little more as we proceed. I'll explain again. I have a portfolio of 10 lakh 10,000. In the stock market, election results are going to come. Somewhere little scared about the result. So I don't want to have this risk. I advise sell it. But he says, no, capital gain, all this headache I don't want to have. So then what we did is we are doing hedging. How does hedging helps? You'll understand. Any doubts till this first? Now right below table, we should sell BSE futures of rupees 15 lakh 15,000. We should sell BSE futures of rupees 15 lakh 15,000. BSE futures of rupees 15 lakh 15,000. In brackets, sell because it is negative number. If you had got a positive balancing figure, buy. If you get a negative balancing figure, sell. Let me complete the full calculation. Then you may get full grip on what are we trying to do, why are we hedging and all, you will understand. Any doubts in this? Value of one contract. Value of one contract. This was part 1 of the question. We are yet to answer even part 1 of the question. Value of one contract, 50 into 5050. You calculated 5050. 50 into 5050. Value of one contract, 50 into 5050. How much? 2,52,500. 252,500. Number of contract to be sold. Number of contract to be sold, 15 lakh by 252,500. Number of contract, 15 lakh by 252,500. Once I'm done fully, I'll repeat the explanation. Still, if there is confusion, I'll take those questions. 15 by 252,500. How many contract? 6 contracts. Number of contract to be sold is 6 contract. Now, why did I do all this headache? The headache is you had all this. Now you write in bracket sell button, buy button and 6 contract. We were doing all this calculation to know what did I do initially. Sell and then I did buy to calculate profit or loss. How many contracts? 6 contract. We have done it for 6 contracts. Sell button and then buy button. Sell button and then buy button. Able to understand this? Any doubts in this? What is this? Why are we doing 2-3 minutes more? Okay. Profit 5050 minus 4511 into 50 into 6 contract. 161 161 625. 161 625. Any doubts till this? Just 2 more minutes of explanation, then I revise it fully and then I take any doubts if you have. 161 625. Any doubts on this? Why I had to do this headache of detailed calculation? Because they did not tell 6 contract. If they told 6 contract, I would have directly calculated like the previous question. Any doubts on this? Now listen. Is this a real profit for me? No, it is not a profit. Why it's not a profit? Let's understand. What was our objective is, I don't want any impact. I don't want any impact. So where is that no profit is coming? Listen. What is the index today? 5000. It is becoming how much? How much is the fall? Percentage. 10% fall. What is beta of my portfolio? If market falls by 10% and I have a beta of 1.5, I will fall by 15%. I'll fall by 15%. Market fell by how much? 10%. I am more than that. I will fall by 15%. So on that 10 lakh 10,000 there, no, I will be losing 15%. Somewhere exactly it will not match. Okay, exactly it will not match. This loss will be offset against that profit which you made. This loss will offset the profit which you made. Objective was to lose at one place, earn at one place, no profit, no loss. Almost exactly it may not match because there is a timing gap and all here. There's something called as a basis risk. You will understand all that later. But as of now, my objective was very simple. Earn at one place, lose at one place, no profit, no loss, or almost no profit, no loss. How much is the loss here for me? 1 lakh. And what is the profit we made? 1,61,000. This loss will offset the other profit. This loss will offset the other profit. And what does hedging mean is, you buy in one market, sell in the other market. We are already having plus 10-10. That's why we got negative 15. We had plus 10-10. We got negative 15-15. And this ensures that profit at one place, loss at other place. It can be reverse also. 5,000 could have gone to 5,500. In that 10 lakh 10, I will make money. But this 5,500, if I press the buy button now, I will have a loss. I will have a loss. Objective is to earn at one place, lose at one place, and make almost no profit, no loss. For how long? Very temporary period. Very temporary period. Don't say that I'll do it for a permanent period and all. No permanent. Only for a shorter period. Only for a shorter period. Able to understand the calculation? Any doubts on this? I'll wait for a minute or two. Go through the entire computation. If there are doubts, let me know. 2 minutes for you. Okay. I will come back to question. Let's understand. Computation of beta in bracket hedge ratio and change. This is not very critical because we have already done beta discussion. Beta, the other name for beta is called hedge ratio. Why is it called hedge ratios? This will decide the amount to be hedged. The formula we use is F2 of beta computation. What is F2 of beta computation? Standard deviation of the security by standard deviation of the market into correlation of security with market. What is standard deviation of security? Spot. Spot is the standard deviation. Security is spot. Futures is called the market. Market is futures and security is spot. Most of the times they may give the beta directly itself. This can be used to find percentage change in price. Percentage change in share is equal to beta of share into percentage change in market. Into percentage change in market. Beta measures the risk of a share in relation to market. Beta greater than 1 indicates riskier than the market. Beta less than 1 indicates less risky as compared to the market. 1.5 will mean Nifty 10%. We are 15% up, down, both the sides. Clear? Any doubts on this? We have already done this. I really don't want much to spend here. Perfect hedge, target beta hedging, hedging of a specified protection percentage. Different words can be used. Hedging means protection against fall or increase in prices. I don't want fall impact. I don't want increase benefit also. Benefit also I don't want. Loss also I don't want. Under hedging, the hedger will have an underlying transaction. What is underlying transaction? I had a portfolio of 10 lakh 10,000. Then I did hedging. Without 10 lakh 10, if you do, that is called speculation. Without having some underlying transaction, if you do, it is called what? Speculation. Speculation means you will make money in the futures market or loss in the futures market. What is hedging? Money in futures, loss in spot. Loss in futures, profit in spot, effectively zero earning. Effectively zero earning. A question may say, I want to do perfect hedge. Overall beta will be zero. Overall beta will be zero. They may say full hedge. Full hedge also mean overall beta is zero. They may give a target beta. If they have given a target beta, write that as the overall beta. They may say, I want 1.2, 1.5, 1.8, 2.5. They may give any number. If they have given that number, please write that. Percentage, I'll explain in some time. Format for computation of amount to be hedged. Security, beta, weight, product. There can be BSC futures. There can be anything. In my example, there is a share of A Limited. There's a share of C Limited. One has positive weight. Another one has negative weight. I will put a total and get Nifty futures as balancing figure. Nifty futures as balancing figure. Beta is equal to risk of security or market. Total of weights. Total of weights. Total of position in spot market. Forward purchase or sale will not be considered in weights total. Will not be considered in weights total. This is because no inflow or outflow happens for future purchase or sale except for that margin. Ignore the margin element for the time being. Product is equal to weight into beta. What are the variables which will decide the amount to be hedged? What is amount to be hedged? Last question, 15 lakh 15,000. What are the variables? One is weight column. In the weight column, total will not include what? Beta futures. Second is what is the beta of Nifty, Sensex, index, which is one time. How does this impact the answer? In case instead of one time, if this was 2, then it would have become minus 15 divided by 2. It would have become minus 15 divided by 2 in the calculation. But normally BSE futures I will have 1. Purchase or sale transaction. Purchase is positive in weights. Sale is negative in weights. Purchase is positive in weights. Sale is negative in weights. Now you'll be able to relate to whatever I'm saying one by one. Everything should be very, very clear. Amount to be hedged. Weight of index futures. What is index futures? BSE, NSE, Nifty, whatever name you want to give. Number of contracts is always based on actual futures price. Whenever you are doing your contracts calculation, it should always be based on, I have bold here, actual futures price. Because when I started initially, I had written this, but that time maybe that much attention would not have gone to this item. Any buying or selling or hedging will be at the actual futures price. Will be at the actual futures price. Can there be a difference between AFP and FFP? Yes, many questions we have seen. The last problem we did, there was no data. There was no data on actual futures price and fair futures price. So concept is very simple. It says, I'll come back here. Amount to be hedged. What is amount to be hedged? 15 lakh 15,000. Negative. Negative divided by size of one contract. What is size of one contract? 50 into 5,050 in the previous question. We should ensure actual futures price is used for finding the size of one contract. Fair futures price should not be used. FFP can be used as proxy if AFP data is not available. If AFP data is not available, I take proxy. I take proxy. Any doubts on this? Any doubts on the concept here? Able to understand till this? Simple words, one by one, I'm just reading it. I've already explained everything in the question. Now I read it. It is easier for me to explain that way. Any doubts on this? Can we proceed? Lot of good examples are there at home. It's your wish, you want to do 100%, try all this. Okay, any doubts on this? Clear? Can we proceed? Any doubts on this? Excellent examples are there in this chapter. Every concept I put sometimes 5-6 examples and all. You solve all the examples, you're done with the chapter. Any doubts? Can we proceed? Done? Let's go back. Let's come to question 16. Mutual fund is holding the following asset: investment in diversified equity share 90 CR, cash and bank balance 10 crores. Beta of the share portfolio is 1.1. Beta of the share portfolio is 1.1. Index future is selling at 4,300. The fund manager apprehends that index will fall at the most by 10%. How many futures should he short for perfect hedging? Substantiate your answer. Go through the question for a minute. Please go through the question. Okay, I will start doing it. Questioner said what? He wants to do hedging, perfect hedging. Perfect hedging means zero beta. Perfect hedging would mean zero beta. That is the hedging I am going to do. Security beta weight product. Security beta weight product. Security beta weight product. Beta weight product. It's a very simple area. I have investments in shares. I also have cash and bank balance. I can have anything. There are a lot of things. Let's keep writing one by one. Investment 90 crores. I'm doing it in lakhs. 9,000 lakhs. 9,000 lakhs. I'm doing it in lakhs. Okay. 9,000. Is there a beta given for shares? 1.1. Do multiplication. This is positive item because this is my asset. This is my asset. 9,900. Second item is what in the portfolio? Cash. Cash ideally doesn't carry any risk because it's just a money. The value will not. What is risk is value going up, going down. This is 1,000. Zero product. Product is zero. Third is index futures. Index futures. 1 is the beta. Question mark. Question mark. Overall. Overall. What is overall is I want perfect hedge, zero beta. I may sometimes want not a perfect hedge, then you can have some other beta. That's okay. So overall beta is 0. Overall beta is 0. There are formulae to get to the answer. Understand the table. You will not find anything easier than this. 0 is the beta. Weights total 9,000 plus 1,000. 9,000 plus 1,000, 10,000. 0. Balancing figure 0 minus 9,900. Negative 9,900. Negative 9,900. Negative 9,900. Any doubts on this? Weights negative 9,900 by 1. I have to sell index futures of 99 crores. 9,900 lakh. 9,900 lakh. I have to sell index futures. I have to sell index futures of how much? 99 crores. Any doubts in this? Can we proceed? Clear? Able to understand this? Any doubts in this? Below, number of contracts to be sold. Number of contracts to be sold. 9,900 lakhs divided by. Have they given futures value or spot value? That 4,300. Futures. So directly futures is given, no headache. Spot is given, headache. You have to calculate futures and then do the calculation. And this is actual futures price. We are not doing any calculation. What is the lot size given in the question? Into 50. 2.15 lakhs. Get me the number of contract. divided by 2.15, 4604.65. We round it off to the closest one. 4605 contracts. I did this for with a purpose in mind. The purpose is also explained in the question. Any doubts till this? Purpose of the question is how many index futures you have answered. One index. Substantiate your answer if the fund manager apprehension materializes. What was the fund manager thinking? He was thinking that index will fall by how much? My portfolio will fall by 11%. My portfolio will fall by 11%. Understand the calculation because some of you have asked me doubt in this in the previous question also. 10%. My portfolio will fall by how much? 11%. Listen. Loss in portfolio. You can write loss in portfolio 90 CR into 10% into 1.1 time. 11% loss. 11% loss. Loss in portfolio 11%. Loss in portfolio 11%. Amount is 9.9 crore. I was a little unhappy that I'm having a loss, but okay, I am not worried because I've done hedging. Hedging objective is to make closer to zero profit, zero loss. Any doubts on loss here? Into 1.1 should be very clear to you. Any doubts on this? Profit in futures 4605 contract. 4605 contract. What was the lot size? 50 into, listen, index is going down. I have already sold at higher rate, buying back at a lower rate. I've already sold at 4,300. Now I will buy it back at a lower rate. So I will be making a profit of, listen, 4,300 is the rate. 10% on this is my profit. 10% on this is my profit. Index is falling by how much? 10%. Very happy. Index falling. I'm very happy now because what did I do? I entered into a sell position. Sold at higher rate. Buy it back at lower rate. Sell button at higher rate. Buy button at lower rate. This will be 9.9 crores. Some small rounding of gap will be there. That's all. It will be 9.9 crores. 4,605 into 50 contracts into 4,300 rupees and 10% of that 9 crore 90 lakhs 7,500. That 7,500 extra is because of rounding off. We did contracts rounding off. So this profit is 9 crore 90 lakh 7,500. Overall profit is almost zero. This is what hedging wants me to do. I want hedging to do. Fund manager means mutual fund manager. He is thinking index will fall. One option is selling all the shares. If he sells all the share, capital gains, people will ask, why are you selling so many shares? So I go through a hedging route. Any doubts on this? Any doubts on the profit or loss calculation? Clear? Any doubts on this? Done. So my objective was very simple. Give me zero profit, zero loss. Give me zero profit, zero loss. Any doubts on this? Can we proceed? Which number? See, index is falling. Index fall 10%. Beta one time. Share fall question mark beta 1.1. 1 is equal to 10. 1.1 will be equal to 11. I have 90 crore portfolio, 11% loss. 90 crore portfolio, 11% loss. And in the futures, 4,605 contract into 50 lot size into 4,300 and I make a profit of 10%. Make a profit of 10%. Any doubts in this? Make a profit of 10%. Any doubts in this? Clear? Can we proceed? If you want, I can do one more small thing also, but this is how I will be doing later set of question. Percentage change, profit loss. What is percentage change? 11% minus 10%. Index change by 10%, other one change by negative 11. Weight into this is my profit or loss. 9,000 into negative 11, negative 9,900 into negative 10%. Negative into negative, positive. Negative into negative, positive. This is how the profit or loss is calculated. Negative into negative. Any doubts in this? Can we proceed? Any doubts on this? Done? Let's come to question 17. A trader is having its portfolio shares worth 85 lakh at current price. Cash is 15 lakh. Beta of the share portfolio is 1.6. After 3 months, prices of shares dropped by 3.2%. Prices of shares dropped by 3.2%. First, they will ask for calculating today's beta, right? Today's beta, right? Today beta. Today beta. Hedging will come in sometime. Today beta. Security beta weight product. Security beta weight product. Shares cash. Shares and cash. Shares and cash. What's the beta of the shares? 1.6. 85 lakh. 1 crore 36 lakh. 85 lakh, 1 crore 36 lakh. How much cash we are having? 0, 15 lakh, 0, 136, 1 crore, 1.36, 1.36. Shares is there, cash is there, 1.36 is the beta. Self-explanatory, nothing much. It's a very simple discussion. Any doubts on this? Any doubts on 1.36? Can we proceed? Then they are saying, what is the portfolio beta? If that word after 3 months should ideally not be there in the question. I don't know why I say I added that word, but they keep adding the word. Ignore that word after 3 months for the time being. If the trader on current date goes on long position on what? 100 lakh Nifty futures. He did a long position on what? 100 lakh Nifty futures. They are not telling you to do hedging and all. They are saying, I'm giving you the number. You just do the beta calculation. I'm giving you the number. Your job is just to calculate the beta. Don't tell me hedging, all this I'm not asking you to do. Same format. Security beta weight product. That word after 3 months should ideally not be there. Security beta weight product. We continue to have shares, we continue to have cash, and we do Nifty futures. Nifty futures. Share cash and all, you write the same thing. 1.6, 85 lakh, 1 crore 36 lakh. Some price drop and all is given in the question. It has zero implication to the answer. I'll then explain what ICI does and all. Answer will remain same, but I'll tell you to do this question. If it repeats, write the ICI approach also. 0, 15 lakh. 0 and 15 lakh. Yep. What did we do is we went on a long position on what? 100 lakh Nifty futures. Long position on 100 lakh Nifty futures. So write 1, 100 lakh is 1 crore. Multiplication 1 crore. Long means buy. Long means buy, but in the total weights it will not come. In the total of weights it will not come. 1 crore, 1 into 1 crore, 1 into 1 crore, total question mark, total is 1 crore, 2 crore 36. 2 crore 36. 2 crore 36. I'll then tell you what ICI does also. Needed. In exam you can present it that way if needed. Any doubts on this? Beta is 2 crore by 1 crore. 236 by 1 crore. 2.36. See, I originally had a beta of 1.36. I bought in the spot market. If you again buy in the futures market, you're doubling your risk. Both the places you are buying, it is risk doubling. Both the places you are selling, risk doubling. If you buy in one market, you should sell it in the other market. Why he did all that, we will not debate on it. But this is what they have done. Any doubts in this? Okay. Now write percentage fall in shares given in question 3.2%. Fall in shares is 3.2%. This is ICI approach, okay? Percentage fall in shares 3.2%. Beta equal to percentage fall in share by percentage fall in stock market. Fall in Nifty, let's call this percentage fall in Nifty. Fall in share, fall in Nifty. Question has said, what was the beta of the share portfolio in the question? 1.6, and shares have dropped by how much? 3.2%, right? 1.6 is equal to 3.2 divided by percentage fall in Nifty. Tell me what is the percentage fall in Nifty? I don't know. I used to do this 10 becoming 11. So many doubts have come from students. So I've written detailed formula now. Now in exam, if you're getting confused, write the detailed formula and find the fall. How much is the percentage fall in Nifty? 2%. Percentage fall in Nifty 2%. Any doubts on this? Add 2 more columns. Not sure if you have space or not, but I will need 2 more columns. 2 more columns. Percentage change, profit slash loss. Percentage change, profit slash loss. Percentage change, profit slash loss. 3.2% fall. Cash and all not applicable. 2% fall. 3.2 and 2% fall. Both are fallen only. Both the places suffer loss. Both the places you have to suffer loss. 3.2% gone, 2% gone. 3.2% gone and 2% gone. Ideally, without acting smart, we should have gone for a short position in futures, but we went for what? Long position. Both the places suffer loss. Both the places suffer loss. $3.2. What is the loss? 85 lakh into 3.2%. 85 lakh into 3.2% is the loss. How much? Cash, no problem. Cash, ideally, what is the problem is this loss will be paid through cash. The cash is only going to be used to pay the loss which is there. Shares will fall. Nifty loss, whatever happening, you have to use the cash and pay the loss. This 1 crore into negative 2%. Overall loss is how much? 4,72,000, and technically it is 4,72,000 on my portfolio of 1 crore. On my portfolio of 1 crore. My portfolio value is only 1 crore and I'm suffering unnecessary double loss. It's just unnecessary double loss which I've suffered. 4 crore 72 lakhs on a 1 crore investment. On a 1 crore investment. What is the loss we have suffered? 4.72%. ICI does all this calculation, okay? They will do all this calculation. I would have told my approach, but my approach will become very, very simple. Not sure ideally they'll award marks. This question, at least I want you to do this extra computation. 4.72%. Any doubts in this? Any doubts in this? Now, right, beta of, any doubts on 4.72? Beta of new portfolio is equal to percentage fall in portfolio divided by percentage fall in market. 4.72 loss, market 2% loss, 2.36 beta. 4.72% loss, market is only 2% loss. Market 2% loss, we are suffering 4.72% loss, beta 2.36 times. Beta is 2.36 times 4.72% and 2%, 2.36 times. Any doubts in this? Clear? Able to understand this? 4.72, this is ICI presentation. I really don't see any major utility, but in exam, this question at least I would want you to do, because this question I've given the ICI presentation. Normally I don't give. Market has fallen by 2%, long on 100 lakh of Nifty futures, loss is 2 lakh, beta 1.6, loss in shares 272, total loss 472, 4.72%, 2.36 times. Any doubts in this? Can we proceed? Any doubts in this? I'll wait for a minute. There is a doubt in beta formula. It is fall or change, both can be done. It is percentage fall or percentage change, both are technically same only. If both are in the same direction, positive beta. One up, one down, negative beta. Any doubts in this? Can we proceed? Any doubts in this? Go through 18. Go through 18. Okay. Calculate the hedge ratio. Hedge ratio means calculate beta. Calculate beta for perfect hedge in futures market. Advise the position, number, amount, all the three will come from our table. Security, beta, weight, product. Beta is equal to, right? Beta is equal to standard deviation of spot by standard deviation of futures into correlation of spot with futures. Correlation of spot with futures, or standard deviation of security by standard deviation of market into correlation of security with market. They have given variance, take a square root. They have given variance in the question, take a square root. 16%, square root is 4 by 6 into 0.75. Beta is 0.5. Clear? This is called hedge ratio. What is hedge ratio? Is ratio between the spot value and the futures value. 0.5 is the beta. 0.5 is the beta. Any doubts in this? 4 columns: security, beta, weight, product. Security, beta, weight, product. As we do this set of questions, keep in mind sometimes I will add 2 more columns. Sometimes I may add 2 more columns. Not very rarely I'll add, but I may add it. So keep in mind that security, beta, weight, product. Security, beta, weight, product. A company is long means you have purchased. How much? 10 metric ton of copper at what rate? 534. Intends to remain the same for the ensuing quarter, but suddenly they're talking about some perfect hedge. I've already purchased and now I want to do perfect hedge. Not sure why and all, but they are saying you want to do perfect hedge. 2 items: copper futures. Copper and copper futures, because we are doing copper futures for hedging. Last line of the question says copper futures for hedging. Beta of copper is 0.5. Futures will always be 1. Overall 0. Overall 0. Overall 0. 0.5, 1, overall 0. Weight 10 metric ton, what is the spot rate today? Into 1000 kgs, 1 metric ton 1000 kg. 10 metric ton into 534 into 1000. Multiply. 0.5 into 5340. 2670. Clear? So very simple. There can't be a simpler than this. Total 5340. Futures will not come in total. Multiplication 0 into 5340. 0. Balancing figure 0 minus 2670. Negative. And negative 2670 divided by 1. Negative 2670. Negative means we'll take a short position. Negative means short position. Positive means long. Short means selling. Long means buying. Negative 2670. Any doubts in this? Again repeating, can't be a very simpler area. It's just mind block of students. Can we proceed? We should sell copper futures of rupees 26,70,000 for perfect hedge. Just one word, sell in bracket, you can write short position. The name of the position is short position. Short position. They've asked for amount, number and position. Position is short, amount 2670, number let's calculate. Any doubts till this? Value of one contract 1000 kgs into. Is there a futures price in the question? Is there a futures price in the question? Can you calculate it? How will you calculate? For calculating, I need expiry date, no idea. Or maybe ensuing quarter, you can say rate of interest not given. No other information is there in the question. So they ultimately said 534 is the proxy for futures. That's all. I don't have a choice here. 534 is the proxy. If there was information, take time, do the calculation. 534 is the proxy. No choice available for me. We have seen questions where we have done the calculation. Here, no information is there. So 5 lakh, and this is what they have done, and this is right also. 5,34,000. Rare scenario where spot price is taken as futures price. Rare scenario, but no other choice available. Number of contract to be sold. Number of contract to be sold 2670, 534. 5 contracts. Any doubts in this? Any doubts in this? Can you proceed? Any doubts on the concept here? Able to get clarity? Any doubts on this? Done? Go through 19. Go through 19. Read the question. Part 1, beta of the portfolio. You are also not going to do. I am also not going to do it. Security, beta, weight, product. Assuming you do this, note down these numbers. Beta 0.8491. Weights total 188. Note down this number. I will need these numbers for later discussion. 0.8491, 188,54860, 160,09114. Security, beta, weight, product. I don't want to spend time on this. 0.8491, 1 crore 88 lakh 54,860, 1 crore 60 lakh 9,114. How do we do the calculation? You very much know this. It is unnecessary, lot of time consuming area. So I am not doing that part of the calculation. Clear? Can we proceed? Okay. Question has asked for theoretical value of the Nifty futures. Theoretical value means you'll have to calculate fair futures price for which month? February 2013. Number of contracts, if you want what? full hedge. You are looking at full hedge. Full hedge means 0 beta. Then they are saying number of contracts, if you want the beta to reduce to what? 0.6. You are saying today it's 0.8491. You want it to become only 0.6 or you want it to become 0. Two situation. First, right, fair futures price is equal to spot price into e power RT. Reason for e power RT is there is a value given e power. There is a e power value given in the question. Spot price into e power RT. Otherwise, I would not have done this e power RT in this question, but they have given e power value in the problem. They have given e power value in the question. So we are going to use that spot price into e power RT. What is the spot Nifty today? 5,900 into, I know very well that value which is given is what is going to be used here, but somehow I'll have to get to that number. 5,900. What is the rate given in the question? Okay, now listen. There's something called as natural log. This LN means natural log. Practical world, nobody can get a CCRFI loan or nobody pays a CCRFI interest. When we did hedging, we said take a loan or create a deposit. If it's CCRFI, it will assume CCRFI will happen. So, because CCRFI does not exist, if needed, this is normal 10.5%. Using this, you can convert into CCRFI. Using this, you can convert into CCRFI. Will we do this for every question? Next question, same wordings, but I'll not convert because data is not there. Data is not there. How will I convert? If data is there, I'll convert a normal rate into a CCRFI rate because cost of capital means what? Normal rate. Where is CCRFI in a cost of capital? Cost of capital is always normal rate. Till now, you have never understood the term CCRFI from inter-level, and we have been doing cost of capital. So, where is CCRFI? So, in case you have a normal rate, but derivatives want what valuation? CCRFI. You can convert a normal into CCRFI if data is available. Not available, don't break your head. Now, mathematically, if I do listen, e power 0.0998, which is given below. If I do this, I will get 10.5%. I will get 10.5%. What is CCRFI conversion is? E power, this value is 10.5. 1.1049 something is 10.5%. So indirectly what they are saying is you can use normal rate, but convert that normal rate into what? CCRFI. Convert that normal rate into CCRFI. For example, it's given here. Normal rate can be converted into CCRFI rate using what? Natural log values. Using natural log values. CCRFI rate can be converted into normal rate using e power RT values. Normal cost of capital 10.5%. Natural log 1.105. Same question. 0.0998. Somebody paying 9.98% CCRFI or paying 10.5% normal rate, both are same. 9.98% CCRFI, 10.5% normal rate is same. In fact, good question. This is what is ideally should be done in every problem. You should convert a normal rate into a CCRFI rate and then do the valuation. How do you convert? Using natural log values, and the reverse you want e power RT values. Reverse we never do, but this if you want to convert if data is there, because ideal approach of valuation is what? CCRFI. Any doubts on this? Now write e power 0.0998, 9.98%. E power 0.0998, which is what? 9.98%. Time period, listen, they have said number of days in a year is what? 365. We are on January 1. Listen, you can take 58, 59, whatever you multiply, I want this. Is it 58, 59? I don't know. There is a e power value given in the question. There is a e power value. You can multiply with 58 by 365 or 59 by 365. One of them will match. They have given e power values in the question. I don't have a headache here. Into 58. What is 58? January 1 excluded. 30 days and 28 days. January 1 included 31 days and 28 days. It could be 58, could be 59. Tell me which one will match into 58 by 3. 58. Okay, net I know I have to multiply with that number. 5900 into 01598. Two decimal answer. 01598. Any doubts on this? See, this days headache should not even come. I don't know, it has come. I'm doing it. Number of days in a year, if they specify, they do days calculation. For me, one simpler thing is they have given e power value in the question, which tells me that mostly that will be used. So I can do 58, I can do 59, whichever matches there. Any doubts in this? Can we proceed? Any doubts in this? Next, perfect hedge. Perfect hedge. Perfect hedge. Perfect hedge. Security beta weight product. Perfect hedge security beta weight product. Security beta weight product. Our portfolio .8491. I think whatever number I told you to write it down. 8491 1 crore 88 lakh 54,860. 1 crore 60 lakh 9,114. Our portfolio. Start with our portfolio. Our portfolio. We are going to hedge it through which one? Which futures are we using here? Nifty futures. Nifty futures 1. Overall 0. Overall 0. Next part of the question, overall they are giving a value. Overall 0. Weights total 1 crore 88 lakh 54,860. Multiplication 0. I'm writing in bracket just for your understanding, okay? Otherwise all those brackets are not needed. 0. Product balancing figure. What is balancing figure? Negative 160 09 114. Reverse working. Negative 160 09 114. And this number is negative 160 divided by 1. I need to sell. I need to sell. I need to sell. Any doubts on this? By now you should have got used to the format. Very simple format. Automatically answer will come from the format. There is a formula. I have given the formula also in my printed answer. Just in case you want to follow ICI formula. ICI has awarded marks. Here I don't have a headache. That area alone my answer is very fast. There's no major calculation done. That's why I gave an alternate answer. Number of contracts is equal to. Negative means sell, that's all. Identification is nothing. Negative means sell. You buy something, it is an asset, positive. You sell something, liability, negative. No, I'm not asking money coming in. Nowhere I'm asking about money coming in. I'm only asking about you purchased this 1 crore 88 lakh. No, why are you written positive there then? 1 crore 88 lakh you have written positive, no, in the calculation. Why is it positive? When I buy something, money will go. So don't confuse yourself. Sell means you're technically negative value. Buy means technically it's a positive. If I buy something, it is an asset, positive for me. If I sell something, it is a liability, negative for me. Negative for me. Number of contracts. Number of contracts. Number of contracts to be sold. To be sold 1 crore 60 lakh 9,114 divided by 200 into, have they given any actual futures price in the question? Any actual futures price in the question? No. So 5994.28. There is a doubt why Nifty futures is not added in the total, because Nifty futures is neither inflow of money for me nor outflow of money for me. I just pay margin. I just pay margin. I don't pay any money. What is the total of weights? My asset minus liability. Real asset minus real liability. Tell me number of contract. 13.3 rounded off to 13. Same table again. You are looking at a different beta figure now. Same table again. Same table again. What is the beta we are targeting? Beta of 0.6 times. Same table, beta of 0.6. Repeat it. I don't know. So keep doing it. 0.6 and you will complete the answer. You do for your satisfaction. I'll be doing it in the screen. 0.6. Get the number of contracts. Once you're done, let me know the answer. What is the decimal number you got? Take your 4 contracts. 3.9 to 4 contracts. 3.9 to 4 contracts. Any doubts on this? Number of contracts is 3.92, which is becoming 4. Any doubts on this? Clear? By now, you should have got grip in this area. Any doubts in the calculation? Anybody has any doubts in the computation? Question may suddenly say, I want the beta to increase to 2 times. Put 2, reverse work, you will get the answer. Reduce it to 0, calculation. Increase it to 50, decrease it to 40. Whatever the question says, you can do it here. Whatever is the requirement of the question, you should be in a position to handle it. Any doubts in this? Can we proceed? Number of contracts is 3.92, which is 4 contract. Any doubts in this? We'll be taking a break, but before that, I'll just show you how ICI answers it. This is ICI formula. Value of spot position by value of one contract into portfolio beta. Value of spot position by value of one contract into existing beta minus target beta. In fact, faster to do, provided you know the formula and all. In exam, you get confused, unnecessary headache will be there. That is why I do it this way. If you do it this way, it will be faster to complete. In fact, faster to complete in the formula. But my approach will give exactly same answer. I say approach will also give same answer. Answer will remain same. This is the formula they do. Clear? Any doubts on this? Okay, let's take a break of 15 minutes. Okay, let's continue with the discussion. Some more questions are there in hedging with futures. Once we are done with that, we'll see revising today or maybe next session. Okay, question 20. Go through this question. Once you are gone through this, I'll start explaining it. It's question number 20. Go through this first. Okay, let's see the question. Exactly similar to the previous question. 2 reverse working elements they've added, one forward, one reverse, whatever. On January 1, an investor has a portfolio of 5 shares. One question mark is there, and overall beta is 0.859. Cost of capital is given. Like the previous question which we did, we're going to do the conversion and do all of it. I don't want you to do anything. I'm going to do it in the screen so that you get grip on the question and those changes. So we have security security, beta, weight, product. We have 5 securities: A, B, C, D, E. Overall, beta is given in the question. First one is question mark, 1.15, 0.4, 0.95, 0.85. Overall is given, which is 0.859. Overall is given in the question, 0.859. Weights is your basically amount invested into the share price, 3000 into 612.65, which is 1 crore 83 lakh 79, whatever number, 1 crore 83, sorry, 18 lakh 37,950. First share. Second one is 5,000 into 334.2. Third one is 6,000 into 454.45. Next one is 10,000 into 775.1. Last one is 781.05. I put a total here. I do the multiplication and keep putting a total. Also a multiplication for this last one, sum of product and sum of weight. So that last one, beta, using that we do balancing figure, reverse working from the overall total 1 crore 40 lakh 27 298 minus all the total. So I do this minus sum of all the numbers. Don't worry about numbers calculation, okay? Don't get into even numbers calculation. Just understand what we are doing. Beta reverse working 0.90903 sum is the beta of this product company. Any doubts on this? Any doubts on the beta number? Then second segment of the question asked for theoretical value of Nifty futures. I'm not doing it. Spot price into E power RT. You will have to convert same way. Natural log value is given. You will have to convert and then do the computation, which is fairly simple, straightforward for us. Then number of contracts to sell to get a full hedge. Full hedge is 0 beta. All that is fine. Last part we will do it together. Now write security. Write security, beta, weight, product. Last part. Security, beta, weight, product. Security, beta, weight, product. Our portfolio 859, 163, 29, 800, 140, 27, 298. Note down this number. Our portfolio 163, 140.859. Next, Nifty futures. It's a very well drafted question overall. When I read it first time, it confused me also. Well drafted question overall. Now, our usual approach in the previous question we did was, you give me a beta, I tell the number of contract. This question said, what will be the new beta if 4 future contract are sold? Are sold, read fully. Sold to the investor means as an investor I have purchased it. As an investor I have purchased it, or sold to the investor. I am the investor. I assume I am the investor here. So as an investor I have been sold, which means I purchased. I purchased this Nifty futures. When I read it first time in an urgency, I did take it as sell only, but wordings is very clear. Are sold to the investor, are sold to the investor. So Nifty futures 1, sold means we have purchased it. Sold means we have purchased it. How many contract? 4 contract into, you had to do the calculation of one contract. I'll copy paste 6603, 6603.87, 6603.87 into lot size was 200. Again I'm repeating, sold to the investor means we have purchased it. Everything else is same. Subtle change in the question. They have just done a small change in the problem. Sold to the investor, which means we have purchased it. We have purchased this 4 into 200 into 6603.87. How 6603 calculated and all you know already, so I don't want to spend time there. 5283096. When I did it first time, I thought it's minus, but it's plus. We are purchasing it. We are purchasing it. Balances formality. We are purchasing it. One crore 93 lakh 10,394. Reverse work and get the beta. Everything from the format only. Everything from the format only. Our format will automatically give. Only point is sold to the investor. That use the word sold to the investor, which means we have purchased. Buy in spot, buy in futures, beta will go up. Beta will start going up. Beta is how much? 1.18. Any doubts on this? Wording is very clear, sold to the investor. Otherwise, there's nothing there in the question. It's almost same as the previous question. One, they told I will not give you beta. You take your time and do the calculation. And second part they ended up doing was this. This is okay. Full hedge is okay. Full hedge, no problem. The problem was with this. 1.18. We are sold. 4 futures contract are sold to the investor. It would mean investors have purchased 4 nifty futures contract. Being very honest to you, when I solved it for the first time in an urgency, I read it as sell only. I did my answer. I normally solve everything and then check ICA solution. When I checked it, answer did not match. Reason is in an urgency, I read it wrongly. I read it wrong. Sold to the investor. Sold to the investor, which means the investor has purchased it. Any doubts in this? Otherwise, there's nothing there in the question. Clear? Ideally, the previous question I should not have done. I wanted to start with the previous and then move to the complex one. Any doubts on this? Go through 21. Go through question 21. Okay, coming to this question. On April 1, an investor has following 8 securities. First part, beta, you are not going to do. I'm also not going to do. Note down the numbers. Beta 1.1019, 994, 450, 1095, 832. 1.1019, 994, 450, 1095, 832. 1095, 832. Clear? This part I don't want to spend time. Security, beta, weight, product. Every question on hedging will unnecessarily tell me to waste some time around this. So this I hope you are clear. We'll proceed now reading the question. Cost of capital is 20%. Investor fears a fall in the prices in the share market. He approaches you for advice. Current Nifty value is 8,500. Futures are traded in 25. 8,700, 8,850. Theoretical value of the futures contract expiring in which month? May month and June month. We are today in which month? April. I have to find May and June value. They have given e power values in the question. So I will have to do continuous. Last question also we did continuous, but we converted the cost of capital into CCRFI. That and all I'm not going to do here because I don't have data. I don't have data. I will not do the conversion. I will continue with R as given in the question. 20% means I'll do 20%, 10% means I'll do 20%. I cannot do that conversion of 10.5 becoming 9.98. That is not possible for me to do. Previous question that was possible. This question it is not possible. They want a May value, they want a June value. And then they are saying, I want to do full hedge, 50% hedge, 120% hedge. What is 50%, 120%? You will understand in some time. Now let's write fair futures price. Fair futures price is equal to spot price into e power RT. Spot price into e power RT into e power RT. May month. May month. They have asked for a May month calculation and a June month calculation. What is the spot Nifty in the question? 8,000 into, then June also 8,500 into e power R is rate of interest, which is 20%, 0.2. We are in which month as of now? April. You want May? I will not spend more time on futures calculation. I've already spent good amount of time on fair futures calculation. T is how many months? 2 months. So 2 by 12, 3 by 12. That's all. It's over for me. Okay. You at home, you do. This 2 by 12 will need something called as interpolation. You see that in the solution, or you can do in the calculator 1 divided by x by 1 factorial, x square by 2 factorial, x cube by 3 factorial. That part you do at home later on. Assuming you got this answer, I proceed to the next element. Any doubts on this? Any doubts in this element? Can we proceed? Clear? Now write perfect hedge. Perfect hedge. Perfect hedge. Security beta weight product. Perfect hedge. Security beta weight product. Security beta weight product. Our portfolio, Nifty futures overall. Our portfolio, Nifty futures overall. I'm going to do the same question in 5 different types. Some small change will be there in every question. Our portfolio, Nifty futures and overall. I gave you the numbers originally. What was our portfolio? 1.1019, 9 lakh 94 450 1095 832. Question has given 3 things: full hedge, total portfolio, 50%, 120%. What is 50? What is 120? Let's understand in some time. What is the beta for Nifty futures? 1. Overall 0. Weight will be 994 450. 994 450. You should be in a position to do 0 into 994. Anywhere you need explanation, you'll have to tell me, because my role is almost over now. We're just doing question so that you feel everything is covered. That's all. Else I could have told you do all these questions on your own also. I'm done with futures part of it. So one concept is still pending, but almost done with futures part of it. Just doing questions so that you get comfort. That's all. Balancing figure is what? Negative 1095 832. Divide negative 1095 832. Number of contracts equal to number of contracts to be sold. Number of contracts to be sold equal to 1095 832 divided by 1095 832 divided by. Listen, there are reasons for doing this question. This is the reason. We want hedge till which month? So I'll use June futures. First is I want hedge till June, so I'll be using June futures. If I want hedge till May, I'll be using May futures. In that also, I will be using the actual futures price. I'll be using the actual futures price, which is given in the question. Not given, take fair futures price. Not given, take fair futures price. Where is fair futures price calculated? Some time back we have written it. We have not calculated the answer. So I will be using what? Actual futures price. Which month? June month. That is the only concept I wanted to explain, and this percentages I'll come. Any doubts on this? Any doubts on this? Again repeating, I want hedge till which month? June month, June contract. May month, May contract. Assuming you want till July and you don't have that contract, then take the closest available. June month, June contract. June month, June contract, and AFP, actual futures price. Not not fair futures price. We are not going to use fair futures price. Denominator is 8850 into 25. 4 point rounded off to 5. Any doubts on this? Clear? If you want 50% hedge, answer is 50% of this number. And if you want 120% hedge, answer is 120% of this number. 50%, 50, 120%, 120% of this number. Basically, you are doing more hedging or less. There's nothing like 120%. It's either 100% or it is technically unhedged. If you do 120%, you are unhedging on the other side. You are going to the other side and 20% unhedged. 20% unhedged. Any doubts on this? Next, number of contract for 50%, 4.95 into 0.5, rounded off to 2 or 3. I don't know, I can give both the answer. It looks very close. 2 or 3. It can be 2 contracts or 3 contracts. Two or three contracts. Number of contract for 50%. Number of contract for 120% into 1.2. 6 contracts. Any doubts on this? Simple. Two things I wanted to explain in this question. One is if you have 2-3 months, take the contract for the month till which you want to do hedging. You want to do hedging till June, take June month. You want to do hedging till May, take May month. Whichever month you want to do the hedging, please take that month. So I wanted June, I've taken till June month. And the second thing we have learned is if there's a 50%, 50% of the answer. 100%, 100% of the answer. In exam, assuming they don't ask 100 and directly ask 50 only, then there's one way. In this overall beta, no, what you need to write is original 1.1019. If you want 50% hedge, beta will go down by 50%. If you want 100% hedge, beta will go down by 100% and become 0. If you want 100% hedge, beta will go down by 100% and become 0. You want 120%, positive beta will become negative beta. In the calculator, if you do 1.10 minus 120%, it will become negative beta. So if somebody asks what is the beta for 120% hedging in the calculator, 1.1019 minus 120%, negative 0.22. From a positive beta, we are moving to a negative beta. Why we are doing, I'm not debating on all that. What is protection percentage? 100% means 1.1019 minus 100%, 0. Minus 100%, 0. 50%, can I do it that way? You can do same answer you will get. That will be, I already have 100% answer. So 50 and 120, I gave shortcut. Otherwise, what you can do? You can write the beta and get the answer. Same solution will come. If you deduct 120%, if the question asks what is the beta at 150% protection, 1.10 minus 150%, minus 150%. There's nothing like more than 100. If you are going more than 100, your positive beta will become negative beta. Positive beta will become negative beta. Any doubts on this? Clear? I go back to the concept book again. One time I quickly summarize what we have done on the hedging part alone, where these points are again there. Beta, hedge ratio, comparison of spot position and the futures position, F2 of beta computation, SD of spot market, SD of futures market into correlation, can be also used to find the percentage change. Percentage change in share is equal to beta into percentage change in market. You can say percentage change or percentage fall, percentage rise. Both going up, positive beta, both going down, also positive beta. Perfect hedge, target beta, hedging of a specified percentage, perfect hedge, 0 beta. Fully hedge, 0 beta. Target beta, already done. Hedging of specific percentage, new beta is equal to old beta minus 60%. New beta is equal to old beta minus 60%. Format, security, beta, weight, product. Beta is beta, risk of security or market. In the total of weights, Nifty futures will not come in the total. Product, weight into beta, product total it will come. These are the variables we consider, and contract is always calculated with actual futures price, always with actual futures price. Normal rate can be converted to CCRFI. CCRFI can be converted into normal rate using natural log values. Using natural log values. Now we are going to learn one more thing, modification of beta. One, we have learned Nifty futures. What is Nifty futures? The source security. There's another way of reducing or increasing beta, which you'll understand as we proceed, which is through risk-free security. Any doubts till this? Can we proceed? Any doubts on this? Done? Go through this question. Go through this question. This has that risk-free adjustment. Go through the question first. I'll give you 2 minutes to go through the question. Okay. Details about portfolio of a shares of an investor is below. You're not going to do that part of the calculation. They have given 3. Investor thinks that portfolio is carrying very high risk as compared to the market, and hence interested to reduce the portfolio systematic risk to 0.91. This in the institute study material was called beta only. I changed the systematic risk because in one mock test paper they changed it. In institute study material, the word will be beta only. So basically, systematic risk means beta. Beta is a measure of systematic risk. Instead of using the word beta, they have used the word what? Systematic risk in the question. This is a small change they played around in the problem when they did it in exam. So they said systematic risk has to become what? 0.91. Two things he can do. One is risk-free security. Second is through Nifty futures. We will not be doing Nifty futures now onwards. Unless needed, I will not do Nifty futures part. What is Nifty futures? Security, beta, weight, product. That part of it we are not going to do. Interpret the opinion of the investor. What is opinion? He is saying I carry high risk. How will I interpret the opinion? By calculating the beta. How will you calculate? Security, beta, weight, product. So we calculated it is 1.3 times. So he's right. He's right in his view that we are having too much beta. We are having too much beta. 1.3 times is the beta of the portfolio. Instead of using the word beta, they've used the word systematic risk. When we did portfolio chapter, we learned that systematic risk is measured through beta, and unsystematic risk plus systematic is the standard deviation. Clear? Value of risk-free securities to be acquired, number of shares of contract to be sold, these two we will do. Number of Nifty contracts to be bought or sold, up to you, for you to do at home if you want security, beta, weight, product. And new systematic risk, if you have taken a position in Nifty futures and there is a 2% rise, which is also a little self-explanatory. I'll come to it. So I am going to now bring an element called how can you increase the risk or reduce the risk through risk-free security. Today it is at 1.3. Let's assume I want 0.91, which is question's requirement. Another requirement I want to keep it as 1.56. We will do both. Okay. I want to increase. I want to reduce. I can do both of them through what? Nifty futures. Sorry, through risk-free security. One is through Nifty futures. Second is through risk-free security. Nifty futures, till now we have done 3-4 questions. By now you should have grip on it. I don't want to spend time. Now, right. Change in beta. Change in beta through risk-free securities. Change in beta through risk-free securities. Increase of beta. Sorry, decrease. First is decrease. Decrease of beta to 0.91 times. That's the requirement. Decrease of beta to 0.91 times. Four columns: security, beta, weight, product. Security, beta, weight, product. Share portfolio. I already have a share portfolio. Calculation and all I've told you not to do. I'm going to tell you the numbers. You write it at home. If you want to do it. In fact, I wouldn't want you to do that time waste because it's just multiplying and then dividing. Share portfolio today has a beta. Write the numbers: 1.3, 5,000, 6,500. Sorry, don't write 5,000. Don't write 5,000. Just write 1.3. Just write 1.3. Don't write 5,000. Okay. Don't write 5,000. Just write 1.3. Then write risk free. Write risk free. 0. Overall 0.91. Now, as the name indicates, if I put money in risk free security, obviously my risk will go down. I want the risk to go down from 1.3 to what? 0.91. Today I have investment of 5,000 lakhs or crores, whatever number. I have this investment. I am planning to bring in risk free. To bring in risk free, I can do two things. I can keep this 5,000 as it is and put more money if I have. Second option is this, which is what question has said. Number of shares of each company to be disposed of. I am going to reduce shares. I am going to reduce the share. How much am I going to reduce is what we are going to calculate. One option, if you have money available, keep the shares as it is, bring extra money and create a new portfolio. Depends whether money is available with a person, not available with a person. It is scenario based. Here very clearly said number of shares of each company to be what? Disposed of. I am going to dispose of the shares of the company. Dispose of would indicate that we are going to sell the shares and buy new shares. So listen, I don't know what will this number be. This also I don't know. Put together I will have 5,000. Put together I will have 5,000. What is put together 5,000? That is today's value. Put together I will have 5,000. Individual values I don't know. Individual values I don't know. Put together 5,000. Last column 0.91 into 5,000. Again everything will come out of the format into 5,000. 4550. 4550. Listen, I don't know this number. I agree. Whatever be the number, multiplication will be 0. Whatever be the number, multiplication is going to be 0. You can write 1 lakh, 10 lakh, 20 lakh, 40 lakh, 50 lakh. 0 into that number is going to be 0. Balancing figure. Four five five zero. Able to understand this? Again, balancing figure. 4550 divided by 1.3. 3,000. Again, balancing figure. 5,000. I'll have to keep playing around the format. That's all. Keep playing around the format. You will get to the answer. We are going to sell 1,500 lakh shares and buy 1,500 lakh risk-free security. This is in lakhs. This is in lakhs. Indirectly, I'm going to sell 30% of my portfolio. I'm going to sell what? What is 30%? 1,500 on 5,000. Today, I have 5,000 lakhs. I'm going to sell 1,500 lakhs in this. Any doubts first on this? Below this, right? Risk-free security to be acquired. To be acquired is 1,500 lakhs. 1,500 lakhs. If you say I will keep 5,000 as it is, you can do that also. In that case, the numbers will change a little bit. You may not get 1,500, you may get more 1,800, 900, something like that will happen. Any doubts on 1,500? Percentage of portfolio to be sold. 1,500 on 5,000. Percentage of portfolio to be sold. I am going to sell part of the portfolio. I'm going to sell part of the portfolio. 1,500 by 5,000 into 100. What's the percentage? 30%. Any doubts on 30%? Clear? Can you proceed? Any doubts on 30%? Now write number of shares of A to be sold. 3 lakh into 30%. A sell into 30%. B sell into 30%. C sell into everything is sell it. Everything sell 30%. Number of shares to be sold 3 lakh into 30%. 4 lakh into 30%. 2 lakh into 30%. The other one, that 1.56, I'll do it in the next question. Increase beta will be there in the next problem. Let's do it there itself. Let's just close this question. 30%, I'll sell it. This is one way. Other way, as I said, is through Nifty futures. Nifty futures is obviously more comfortable to do because I need not sell any shares. I need not bring any new money. With the existing itself, I can go through Nifty futures route. What is Nifty futures route? Security, beta, weight, product. Any doubts in this? Please complete the balance part at home. Okay. Part 6 is slightly illogical. You see the solution. I don't want to discuss it. Slightly illogical. Answer you will understand, but it's slightly illogical element. So you see this at home. Any doubts on this? Can we proceed? I'll come to 23 in some time. Just give me a minute. Go through 24. This is where we will do that increase decrease. Go through 24. I'll give you 2 minutes. Okay, let's start discussing this. They have given 4 securities. Compute portfolio beta. Usual format. You will get these numbers: 1.1083, 12 lakh, 1330. I want to reduce the beta. How much risk-free investment would he bring in? What will be the new portfolio? Increase the beta. How much risk-free investment would he sell? What will be the new portfolio? And you can also do the same thing through Nifty futures, which is part 4 and part 5, which we are not going to do it in the class. At home, just practice part 4 and part 5 for your understanding if you want. Let's do, first let's do the increasing beta part. Let's do the increasing beta part. Increase in beta. 1.2 times. Anytime you want to increase beta, answer will say you're going to borrow money. When you do the calculation, you will understand you're going to borrow money. That is how increase in beta can happen. When you borrow money, you are increasing the risk. We did one element called as investment with margin of some percentage. That element, when I was explaining, saying that if you invest with margin, you're borrowing and investing. When you borrow and invest, risk can go up. Same 4 columns: security, beta, weight, product. Security, beta, weight, product. Share portfolio, risk free overall. Share portfolio, risk free and overall. Share portfolio, risk free and overall. Share portfolio, risk free overall. Share portfolio, right? 1.1083. Risk free obviously 0. Overall we want 1.20. Now for increasing the beta as well as decreasing the beta, there are twin answers possible. Last question clarity was there. This question clarity is not there. What are the twin answers? Today I have 12 lakh portfolio. I'll show you both the answers side by side. Okay, you can write one of the answer, you need not write both. The other answer is I have 12 lakh now with me. One option is my investment in shares continue to be 12 lakh. Other answer is total is 12 lakh. Total is 12 lakh. How total can become 12 lakh? You will borrow and increase the investment. Borrowing is written as negative in the table. Borrowing is written as negative in the table. You will do the part 1 with me. Part 2 I'm just explaining for your understanding. Okay, you can invest money by borrowing, or you borrowed the money, you're yet to decide what to do with that. You borrowed the money but you're still deciding what to do with that. That could be a scenario as well. Now first one, right? 12 lakh multiply 1330. First let's close this. It remains 12 lakh. It remains 12 lakh. It remains 12 lakh. Okay, I do not put more money in shares. I do not put more money in shares. I think I say I would do mostly this. This is question mark. Multiplication is 0. Question mark. Multiplication is 0. Multiplication is 0. Any doubts on this? 1330 plus 0 is 1330. Reverse work. 1330 by 1.2. 1330 divided by 1.2. Live online guys, participate please. Divide by 1.2, what do you get? 11 lakh 8,333. 11 lakh 8,333. Risk free is balancing figure. You will get a negative amount. You will get a negative amount. Negative indicates liability borrowing. Positive indicates asset investment. Positive is investment. Negative is this. Any doubts in this? What's the balancing figure? Negative 91,667. Below the table, borrow rupees 91,667 to increase beta from 1.1083 to 1.2 times. What am I going to do with the money? As of now, not sure. As of now, I'm not sure. Other option, borrow and increase 12 to 13, 14, 15, 16, which is the other part. Both will obviously give a different risk-free number, okay? It will give a different risk-free number. Any doubts on this calculation? 12 lakh minus 91,667. Previous question, we had full clarity. This question could have asked, how many more shares are to be purchased? Second scenario, more purchase means 12 lakh will go up. It may ask saying that, no, you're not going to purchase and all. You keep the 12 lakh as it is and tell me only the borrowing amount. This part you need not do, listen. This part you need not do, be in listen mode. This is question mark, but multiplication will be 0. Multiplication will be 0. This is 1.2 into 12 lakh. What's the number you get? 14 lakh 40. I don't want you to write this, be in listen mode only. 14 lakh 40. Balancing figure 14 lakh 40 minus 0. Minus 0, you get 14 lakh 40. Division 1440 1.1083. 12 lakh 90 99,287. Borrowing balancing figure. You borrow money and buy more share. You borrow money and buy more share. That's your wish. Whichever way you want to do. You can either do this way or the other way around. Depends what an organization wants to do. In my solution, I would have taken one assumption. Investment will continue to be 12 lakh. Investment in shares will continue to be, okay, this is for 0.8, sorry. 0.8, I'll explain. 1.2, it's the answer. 1.2, investment will continue to be 12 lakh and they may ask you a revised portfolio which you'll have to repeat like this. What is revised portfolio? A, B, C, D and risk free. Is there any utility in this? At least I don't see any utility, but ICI answer wants you to write this. New portfolio. What is new portfolio? According to me, this itself is sufficient. Share portfolio, risk free. My share portfolio is what I have done in the earlier table. Why you want me to repeat the table again? Unless I'm increasing shares, decreasing shares, at least makes sense. Here we are not increasing the shares or decrease. If you increase or decrease, then you will have to do a revised table like this. It makes sense. Any doubts on this? Clear? Next slide, reducing beta. Reducing beta 0.8 times. Reducing beta to 0.8 times. It is assumed shares investment will continue to be 12 lakh. Shares investment will continue to be 12 lakh. Sometime back we did a question where we reduced the 5 lakh to 3,500. We reduced the 5 lakh to 3,500 because we did not have money and the question was very clearly saying shares to be disposed of. Here I am assuming I am not going to dispose the share. I will buy risk free. How am I going to buy it? By bringing extra money, assuming I have extra money. Same table, security beta weight product. Security beta weight product. This is how it will look. 1.1083. Write the table. I continue it as 12 lakh. I continue it as 12 lakh. $12 lakh, 1.1083, 13 lakh 30. Purely format driven area. Just follow blindly this, you will get to the answer. For hedging, also same. For changing through risk free also same. I don't know this. This will be 0. Total is 1330. 1330 divided by, what is the value you get? 1662 500. 462 500. 462 500. There is a doubt which says why they have worded it as, in the question the wording is how much risk free investment should he buy or should he sell. Buy basically means you are investing it, sell basically means you are borrowing it. Sell would indicate borrowing, buy would indicate investment. Buy is positive, sell is negative. Sell is negative. Any doubts in this? Part 4, part 5, if you're interested do it, not interested leave it. Any doubts in this? Can we proceed? Can we proceed? There is a doubt, can we take the total of weight column to 12 lakh? Is it wrong? There's nothing wrong and all. It's just an assumption. It is just an assumption. What assumption ICI will take, I am not sure. Previous question, clarity was missing. Clarity was there. I told you do that. This question, clarity is missing. Clarity is missing. You can take your own assumption, whichever you are comfortable with. Please take that assumption. This assumption or the other assumption, that's up to you. When I did for this, I have shown you both the answers. For point 8, I have not shown you both the answers, but if you want, you can do the other one also because we did that in the earlier question. Any doubts on this? Can we proceed? Any doubts on this? Done? Please read question 23. Read 23. We'll do it together in 2 minutes. Start reading it. Okay, let's look at this. On 1st April, Sunidhi was holding a portfolio of 10 securities whose value is 994, 450. Beta of 9 securities is 1.1. She was expecting a fall in the prices of shares in the near future, and to hedge her portfolio, she sold 5 contracts of Nifty futures. Hedge portfolio means 0 beta. You have brought it down to 0, which was trading at 8767.07. Calculate the beta of the 10th security. A very well worded question. Let's understand the question. I have invested in 10 securities. Value is 994. Beta is given only for 9 securities. First, we are going to do security, beta, weight, product, overall portfolio. I don't know the beta, but that will be balancing figure. How it can become balancing figure? With hedge. With hedge, you have brought it down to 0. With hedge, you have brought it down to 0. We did one question where with hedge, that 4 contracts were sold, our beta was increasing, decreasing, something like that. Here, with hedge, my beta will become 0. Reverse working will the beta of 10 securities. Beta of 10 securities is equal to 9 security into its beta plus the 10th security into its beta. Somewhere we will get the beta of the 10th security. Somewhere we will get the beta of the 10th security. Working note 1, computation of overall portfolio beta. Again same format. Overall portfolio beta. Overall portfolio beta, security beta, weight product. Security beta, weight product. You should be clear on how to read this table. You will be able to handle good number of questions. Security beta, weight product. Overall portfolio. Overall portfolio. Nifty futures. Overall. Nifty 1 beta. Overall 0 beta. This I don't know. This is the question mark. I don't know this question mark. I don't know this question mark. Any doubts in this? Can you proceed? Any doubts till this? How much is the investment on overall portfolio? Product, I don't know. Product, I don't know. Nifty futures, the question has told what we have done. What did we do in Nifty futures? 5 contracts, multiply how much? 25, trading at 8767. Did we buy or sell? Sell. Negative 5 into 25 into 8767.07. 8767.07. We have sold it. Negative 10 lakh 95,884. 884. Excellent format. ICI may not use the format, but grip, the concept remains the same. And they have awarded marks. It's not that they'll not award marks and all. Multiplication is negative 1095, 884. Overall product 0. Overall product 0. Because we have done full hedge. We have done full hedge. Overall product is 0. Reverse work product. 0 minus of minus will become plus. 1095, 884 and beta. Let it be a 4 decimal answer. 1.00. Okay, 1020. 1020. Any doubts on this? I did not write the overall weights total, but even if I write, it's 994, 450. Wouldn't make any difference as such. I can change the question saying that I did 50% hedge, 10% hedge, 20% hedge, whatever I want to do, I can alter the question. Any doubts on this? Can we proceed? Done. Next, right. Overall beta is equal to beta of 9 security into weight of 9 security plus beta of 10th security. I can do it in table also, into weight of 10th security. 9 securities, 10th security. 9 securities they have given the beta, 10th security I don't know. What is the overall beta we calculated? 1.9 securities. What is the beta given in the question? 1.1. I am assuming, this is an assumption, it is equal investment in all the 10, otherwise I cannot answer it. Equal means 9 securities 0.90, 10th security 0.10. I am making an assumption, else I cannot answer this question. Else I cannot answer. So weight is 0.90 plus beta of 10th into 0.10. 9010 is an assumption. No other option available. I will have to take this assumption. I will have to take this assumption. No other choice available for me. Beta of 9, beta of 10th. 0.90, 0.1. You will get answer to beta. 1.1, 1, 2. Any doubts on this? Any doubts on this? Clear? Able to understood this? Any doubts on this? If they want, they could have told 9 securities weight is 0.85, 10th security you do. Our 9 security investment is 9 lakh rupees, 10th is extra 94. I could have done it even in the table format also. 9 securities, 10th security, reverse working, you get to the answer. Whichever way you want to do, you can do it in the approach. Any doubts on this? Then they're saying, reconcile the reason. This is something which will happen in the practical world. In spite of 2% fall in the market went down. As per Sunidhi's apprehension, she would have earned some profit in her cash position. In an ideal situation, hedging should give me 0 profit, 0 loss. How can it still give me profit? I sold Nifty futures. Nifty futures went down, very happy. Nifty futures went down, very happy, 2% fall. On top of it, 10 securities, because of some market issue, went up. My spot is going up, futures is going down, both the places I earn. Both the places I earn. How it can happen? That is the if somebody says Infosys has a beta of 2 times, it does not mean every day Infosys will exactly move 2 into the Nifty. Nifty someday will be down, Infosys could be up. Nifty some days could be up, Infosys can be down. We are just saying that historically we did analysis and this should happen, but on a everyday basis and all, that is not possible. And also for a longer period also sometimes may happen, sometimes may not happen. Our beta, if it's 2 times, market 2% down, our portfolio should go down 4%. Sometimes instead of going down 4%, it may go down only 3, 2, 1. The numbers can change. Any doubts in this? Clear? This is what they are mentioning here. Main reason is instead of expectation of fall, there can be an increase also. There can be a increase also. I expected, why stock market went down, that is market has gone down, my portfolio should also go down, but something great happened and my portfolio is up. Market is down, market down, futures give me profit. Portfolio up, this also gives me profit. Opposite can also happen. What is opposite? Market is going up, my portfolio is going down. Market is going up and my portfolio is going down. Any doubts on this? Can we proceed? Clear? Almost done. There is one type of another question which I need to discuss. We'll quickly discuss that. Go through 25. I give you 3 minutes. Put it in the table format and see how hedging will be done. You do it, I'll discuss. 3 minutes for you. Question 25. I don't want to discuss it. 3 minutes. Put it in the table format. So we'll have to put it in the format. Format is security, beta, weight, product. We have done right. Beta of right is how much? 1.25, positive 50, 62.5. Next one is wrong. Beta is 0.9. We have gone for a short position, negative 25, negative 22.5. Third one is stagnant and then nifty. Stagnant and nifty. Stagnant is 0.75. This is negative 20, negative 15, 1, balancing figure 0. Balancing figure is negative 25, negative 25. This is one way of hedging. The second, which is more complex, which is doing 1-1. Every transaction you hedge it, which is unnecessary. I'll do a single transaction and hedge this fully. Any doubts on this? Can we proceed? No concept, but this is one type of a question which can come in exam where they may ask you to calculate profit or loss. Understand one thing very clearly. If you are doing perfect hedge, you should ideally have no profit, no loss. Perfect hedge is the purpose is that I don't want any profit, any loss. Now you will understand that there can be a profit or loss as well. Let's see. 26th question. Ram buys 10,000 shares of X Limited at a price of 22, whose beta value is 1.5, sells 5,000 shares of A Limited at a price of 40, having a beta value of 2. He obtains a complete hedge by Nifty futures at rupees 1,000. He closes out his position at the closing price on the next day. On the next day, when share of X Limited dropped by 2%, A Limited appreciated by 3%, Nifty futures dropped by 1.5%. Looks little unnecessary for me. Either all three should have been down or all three should have been up. I will make money at some places, lose money at some places. This can lead me into trouble. We'll see when we do the calculation. Requirement is overall profit or loss. I'll read again. I have bought shares. I have sold shares. I have done a complete hedge. So security, beta, weight, product will tell me the hedge. I will need 2 more columns here. I will need 2 more columns. It's a 6-column format, this question, okay? The last 2 columns will calculate profit or loss. It will calculate profit or loss. First 4 columns you know, you do in your notebook. I am doing it in the screen. First 4 columns are known to you. Security, beta, weight, product. Please do in your notebook complete hedge. It is a complete hedge question. Complete hedge question. Last two columns I am going to explain in some time. Security beta weight product. You will need 6 columns. What are those extra? Why? You will understand in some time. Security beta weight product. Complete the first 4 columns. I am doing it in the screen. You do it in your notebook. Complete hedge would mean 0. What is the balancing figure? Positive, negative. Positive 70,000. By now, even if you are a new student of mine, you would have found this very comfortable to take care. The zero difficulty in the format. Just getting grip on the format is critical. Any doubts on this? Ideal situation, this should give me 0 profit, 0 loss. This should give me 0 profit, 0 loss. Any doubts on this? Last two columns. Any doubts on this table? Last two columns. Price change and profit. Price change, profit slash loss. Price change, profit slash loss. X limited, what is the price change they have said? Dropped by 2%, minus 2. Dropped by 2%, minus 2. Minus 2. A limited, what did they say? Appreciated, headache, 3%. Why headache? You'll understand. Plus 3%. Nifty futures, 1 point. The problem here is I purchased the first share, went down. Sold the second share, went up. That is not right. Either all the three go down or all the three go up. I may have a very negligible profit. Also, if I go by beta logic, market went down by 1.5%. X limited should go down by 1.5 into 1.5. And A limited should go down by 1.5 into 2. Ideally, that is what I expected. Ideal expectation is market 1.5 minus 1.5 into 1.5, 1.5 into 2 in the same direction. In the same direction. Now, last column, right? 2,20,000, that is my weight. Weight is my investment into negative 2%. Negative 2%, obviously loss. Negative 2%. 2,20,000 into negative 2%, obviously loss. How much is the loss? 4,400. Second one, negative 2 lakh into positive 3%. Headache. Negative 2 lakh into positive 3% loss. I wanted negative into negative. I wanted negative into negative. I would have been very happy. Negative into negative would have been great. But what happened here? Negative into positive, I have a problem. If this had become negative, our overall loss would have been very close to 0. Overall loss would have been very close to 0. Hedges expecting this to happen. Whether it happens or not happens is not in our hands. We were expecting that hedge will be a perfect hedge, and ultimately what will happen? Negative into negative would be there. Others also negative. I have no problem. But this we are suffering loss. How much loss? 6,000. And Nifty 70,000 into negative one and a half. All the three has been a failure for me. All the three worked opposite for me. First one loss, second one loss, third one also loss. All the three we are losing money. We are losing money in all the three. Reason is the rates did not move in the way I wanted. Any doubts in this? Clear? Just for your understanding, if this was not 2% and this was 1.5 into 1.5 beta, 1.5 into 1.5, this would have been minus 2.25. This 1.5 into 2 minus 3. If this had happened, zero profit, zero loss you will get. If this had happened exactly the way you anticipated, how it would have happened? This is plus 6,000 and this number would have changed as 220 into 2.25. How much? 4950. Put together it will be 0. Put together it will be 0. Now this understanding is for you only. It's not needed from an exam point of view. I've just shown you this to explain the logic. Tell me the overall loss. 11,000. In one exam question, they gave the loss figure. They gave the loss figure saying that loss is 11,450. They gave you these two numbers. They gave you these two numbers. I'm explaining the question. Okay, understand very clearly. They gave 11,440. They gave you 220 negative 2 lakh, everything given. Loss of Nifty futures balancing figure. From the loss, weight of Nifty futures balancing figure. From the loss, how will you do? Negative 1,050 by negative 1.5%, 70,000. And from the Nifty futures, beta of X Limited was balancing figure. From the Nifty futures, one beta was balancing figure. This was drafted. I've removed that question now, but this was one type of a question which they've ended up asking in an exam. What did they do? They gave you overall loss. One of the losses balancing figure. From the loss, reverse work and get the weight. From the weight, reverse work and get the beta of one of the company. Any doubts in this? Can we proceed? Let me see. There's another question. I don't know what is different there. Let's see. Let's look at this. Go through the question. Almost same, but some other requirements. November 24 exam. Go through 27. This will be the last problem for the day. Okay, I think whatever I said is there. I think in this. Whatever I said is there mostly. Let's see. Okay, I think this came in November 24. Earlier there was another question like this. Maybe November 24 exam I've retained. Put it in the table format. Open the 6-column table format. The balancing figure is, I think, 1% gain or loss. So it's just the same thing. Put it in the table format. Security, beta, weight, product, price change, profit, loss. Security, beta, weight, product, price change, profit, loss. We'll complete the table and then they're asking some initial cash outlay and all. I'll explain that. Well, first let's complete the table. I think the same company names: X Limited, A Limited, Nifty futures, overall. X Limited, A Limited, Nifty futures, overall. Good question. X Limited we have done 1.5, 10,000 into 25. Almost same as the previous question with some subtle change. In fact, the other question which I was talking about is even more complex than this, where beta is balancing figure. Here it is relatively simpler. 3,75,000. I'll come to price change and profit in some time. Second one is 2 beta. We are selling how many shares? 5,000 shares into 40, negative 2 lakh, negative 4 lakh. Nifty futures balancing figure 1, overall 0, overall product 0. The student has said some 20,000 shares, I don't know. 25,000 positive. Any doubts on this? Any doubts on this? Clear? Can you proceed? They have given price change. X limited is the price change given. X limited dropped by -4, -4. A limited drop. No. A limited drop. Nifty is 2.5. A limited is the requirement. Part 4 of the question. A limited is the requirement, question mark. A limited is the requirement, question mark. And Nifty futures is 2.5. The student has already given the answer, but okay, let's complete it. We multiply this 2,50,000 into -4%, negative 10,000. Positive weight into negative price loss. That's all. It's very simple. You need not even think much about it beyond this. Last one, 25,000 into 2.5, negative 2.5%. Negative 625. Overall losses given in the question. Balancing figure is the second one. Overall is 16,625. Overall is 16,625. Balancing figure. Balancing figure. How much? Negative, positive? Negative. Negative. Price change will be positive. Why positive? Negative 6 divided by negative 2. Second column into third column is fourth column. Third column into fifth column is sixth column. Third column into fifth column is sixth column. So this is negative 6,000 divided by negative 2 lakh, 3%. There's a doubt saying that can they give percentage change in market and tell us to calculate profit or loss? They can do anything. If they give percentage change in market only, others you will have to go through the beta logic. Others you have to go through beta logic. Overall profit or loss will be 0. Overall profit or loss will be 0. Any doubts on this? Can we proceed? Now, value of Nifty futures done, which is 25,000. Percentage gain is it's gain, but I am suffering a loss. For me, it is a loss, but stock market is only going up. It is going up. Percentage gain is 3%. Any doubts in this? Initial cash outlay and cash inflow at the closeout. Ideally, something like this they should not have asked, but they ended up asking it in one exam. So what they did, I'll explain, and we'll have to do the same thing. I paid 250 for the purchase of the first one. I received 2 lakh, and ICA has assumed for index future you are paying the entire margin, 100% margin. You are paying out the entire 100% margin, which is logical, not logical, is a debatable thing because I don't have any other choice. So cash outlay, right? Cash outlay is equal to 2,50,000 payment, 25,000 payment, and negative 2 lakh. Negative 2 lakh. Negative 2 lakh. What's the answer you get? I pay 75,000. In return, I'll get 75,000 minus 16. 75,000 minus 16. In return, I'll get back 75,000 minus 16. Ideally, 75,000 will not be paid. You'll not pay 25,000 for index futures. You'll pay little lesser. They ask for value of the Nifty futures you have, sorry, okay, after 25,000 you have to divide by 25. One contract is 1000. One contract is 25 Nifty futures means 25,000 divided by 25,000. So initially we paid how much? 75,000, which is what they have done. In the practical world, outflow will not be 25,000. We would be paying only the margin money. In the absence of information, entire 25,000 is taken outflow in line with the ICI solution. Any doubts on this? Inflow at the closeout 58,375. Done. We are done with the entire part. Today I'm not revising it. Tomorrow when I start, I'll first revise it and do one concept which is pending called net realization. Futures is over. Now I think you should find futures very simple. Zero tricky adjustments were there. It's not that I've removed question and all. I have kept all your ICI study mat question. I have kept major MTP RTP question. Any doubts in this? There's a doubt on what is cash inflow at close out. Close out is 75,000 minus whatever is your loss. 75,000 minus the loss. I have to deduct the loss because I'll not get back the loss money. 75,000 minus the loss. Any doubts in this? I'll end with this. Okay, let's continue with the discussion. In the previous session, we are done with almost major part of futures. Just today, I'll first quickly cover that one segment which is pending in futures and then revise the entire segment and then we move to options. There's a small segment which is pending called effective realization or payment in futures. Now, we have till now learnt that futures can be used for arbitrage purpose, can be used for hedging purpose, and in hedging we learned that I make a portfolio investment, I bring down the beta to 0 and that is hedging. Practically there is other way of doing hedging also where my main purpose was to buy that product. For example, I am a farmer. Now I am going to grow rice, wheat, whatever I am going to grow. After 3 months I plan to sell this rice or wheat. Now in the market prices can go up, prices can go down, and I may want to hedge this risk through something called as futures. Now what does hedging the risk through futures mean here? Let's assume today there is a spot market. There's a spot market, just give me spot market and a futures market. Two markets are existing in the practical world. So I went to the market to find out what is the price. The rice is available at 20 rupees in the spot market, and in the futures market after 3 months. After 3 months, the price is given as 18. This is the price given in the market. 20 rupees and 18 rupees is the price given. Now, my plan was to sell rice after 3 months, and I somehow believe that 20 can go down to even 15, 10, whatever number. That can lead to huge losses for me. So I want to freeze the rate. I will go ahead and sell the rice which I have or which I'm going to have. I have or I'm going to have at the rate of 18. I'll just go to the market and sell it at the rate of 18 in the market. I'll just press a sell order and keep quiet. On the maturity date, what will happen is the rice can be at 19 here and here could be maybe 19.1. A small variation could be there. Maybe a small variation is there on the last day. Ideally, variation should not be there, but a small variation is there on the last day. In such case, what will happen is my plan was to realize how much? 18. I may not get exact 18. I may get a slightly more or slightly less because of the hedging which I have done. Hedging, what it should do? It should give me exact 18. It may not give me exact 18. It may give slightly more or slightly less on the last day because of whatever hedging I have done. What is this going to be? Let's assume I did at 18. I pressed a sell order here. I'll press a buy order here. I pressed a sell order, buy order. So I will be having a loss of 1.1. I'll have a loss of 1.1 and I'll go to the real spot market and sell rice at the rate of 19 rupees. Net I'll be earning 19 and 1.1 put together 17.9. Put together 17.9. What is this concept? effective realization in a futures, effective realization in the future, realization will happen as per spot rate. Realization will happen as per spot rate on the last day. Realization will happen always at the spot rate, and there will be on top of it what? Net settlement. On top of it there will be what? Net settlement. Let's see an example. Spot position 20 rupees, spot price, it should not be spot position, spot price 20. Futures market, we have done it at 21. What did I do? I entered a contract to sell. I entered a contract to sell it at the rate of 21. What will be the net realization if wheat price on the maturity date is how much? 25 and 25.10 in the futures market. It is a 25 and 25.10. 25 and 25.10. In one market it is at 25, in another market it is at 25.10. Ideally on the last day both should be same. On the last day both should be same. So if I look at here, when I entered 20, this was at 21. I pressed a sell order here. I pressed a sell order at 21. On the last day this is at 25. This is what I will get. This is what I will get, whatever is the spot rate on the last day. And this is at 25.1. I'll be pressing a buy order. There will be a difference. That will be my profit or loss. And along with 25, it will ensure that I get a number close to 21. I get a number close to 21. When can I get exact 21? I can get exact 21 if on the last day spot and futures exactly matches. Spot and futures exactly match, then I can get 25. This risk is called basis risk. We learnt a term called basis earlier, where it was said the difference between spot rate and the futures rate. In an ideal situation, on the expiry date, spot price and the futures price should match. If it is not matching, it can lead to some profit or some loss as compared to the original 21. As compared to the original 21. This 4.1 I will be losing. That's not my worry at all. This 4.1 loss is not my worry at all. Let it be 4.1567. In the spot, I will earn more. I will lose here. Put together, I'll get 21. Put together, I'll get 21. Objective is put together, I should get what? 21. What is futures is freezing my buying rate or selling rate. This is pure hedging. This is pure hedging. Another example. I could be a copper trader and I have planned to purchase copper after 6 months for my business purposes. I may enter into a buy contract today, freeze the rate. After 6 months, I'll buy it in the spot market and do a net settlement. Put together, I should get my originally contracted rate. I should get my originally contracted rate. If I get my originally contracted rate, then my hedging is successful. If I'm not getting the originally contracted rate, then there is something wrong in my hedging process. This is the broad context of hedging. Clear? Any doubts on this? Can we proceed? Let's see it in 2 questions and then I come back again and then we revise the entire part. Let's come to question 29. Question 29, which is in chapter 10 in Institute Study Material. ABC Technologies is expecting to receive a sum of USD 4 lakh after 3 months. I'm going to receive US dollar 4 lakh after 3 months. Company decided to go for futures contract to hedge the risk. Standard size of the contract is USD 1000. Till now you just write, then I show the next part of it. Maybe you will not have it in front of you. You just, what are we planning to do? Are we planning to buy or sell here? Sell, right? Exposure amount, exposure amount, exposure amount, USD 4 lakh. We are planning to sell one contract USD 1000. Clear? This is the information as of now. One contract is USD 1000 and we are planning to sell it. As on date, spot and the futures is 44 and 45, and after 3 months both are quoting at 44.5. After 3 months both are quoting at 44.5. This is called no basis risk. In this case we will be able to get our originally planned realization. We'll be able to get our originally planned realization. How does this happen? Let's understand this. Any doubts first on the question? Now write the information. Date, spot, futures, spot and futures, spot and futures, spot and futures, day 0, month 3, day 0 and month 3, day 0, month 3. When we entered the contract, what was the spot rate? 44. Futures rate 45. I pressed the sell button here. At 45 I press the sell button. At 45 I press the sell button. Any doubts on this? On the last day, what are they? 44.5. At this rate I press the buy button. At this rate I press the buy button. At this rate I press the buy button. Any doubts on this? Any doubts on this? Are we having a profit or loss here? Profit. So you will get this profit and sell your 4 lakh dollar at the actual spot rate. Sell your 4 lakh dollar at the actual spot rate. Put together you will get your 45 rupees in this case, because there is no basis risk. Next example, there will be what is basis risk? On the last day spot rate and the futures rate do not match. If they do not match, then technically we are having a risk called basis risk, and it will ensure that we don't get that exact 45. What does hedging? Hedging means you have to tell me with confidence that it will be 45. I'm telling you today we are trying 45, but we may get 45 more, 45 less, slight difference can be there. Then the hedge is not a perfect hedge. It clear? Ideal world, on the last day spot rate and the futures rate should match. Spot rate and the futures rate should match. Clear? Any doubts on this? Can we proceed? Let's go back now, right? Futures profit. Futures profit 4 lakh into 50 paise. 4 lakh into 50 paise. Futures profit 4 lakh into 50 paise. 2 lakh. 4 lakh into 50 paise, 2 lakh. Futures profit 2 lakhs. Spot sales 4 lakh into 44.5. Spot sales 4 lakh into 44.5. 44.5. How much it is? 1 crore. Put together 1 crore 80 lakh. Put together it is 1 crore 80 lakh. Divide that by 4 lakh, you'll be getting exact 45. You'll be getting exact 45. Plan was to get 45. Plan was to get 45, and in reality we are getting 45. Only one reason for this: on the last day spot and futures are matching. I'll be doing this area again when I go to forex. There you will see that you will not get exact 45, because on the last day there will be some variation. There will be some variation on the spot rate and the futures rate. Ideally exact match happens, I get my planned realization. Any doubts on this? Let's see one more question. Any doubts on this question first? We sell. No, no, this is separate market. This is separate market. Don't confuse the two market. You sold, you bought, cancel the contract, 50 paise profit you made. That's all. That's all. That's over. No net settlement only. No futures work through a net settlement route. In futures, I earned 50 paise. Ignore that. That's all. Now you have $4 lakh in hand. Go and sell it at the rate of 44.5. You do have $4 lakh. No. Don't link two markets together. Every market you need to do buy and sell. I've done sell, I've done buy. That market is over. In this market, what I do is I have physical dollars with me. I do have the dollars with me. I sell that dollars at the rate of 44.5 and I happily take the money and go out. That's all. Futures always work through net settlement. No? Futures is net settlement. What is net settlement? Is pressing the buy button again. You're clear? Any doubts on this? Any doubts on this? Let's look at this. A rice trader has planned to buy. Okay, I change the question. Okay, has planned to buy. We have already done a sell question. Has planned to buy 22,000 kg of rice after 3 months from now. Spot price of the rice is 60. 3-month futures price is 59. Size of the contract 1000. Price can rise. Okay, let it be sell itself. Let it be sell itself. The price can fall as low as 56 per kg. Interpret the position of the trader, that I'll explain in some time. Advise the trader what should you do, that also I'll explain now in some time. Last one we will do. Demonstrate the effective realized price if he decides to make use of the futures market after 3 months. Spot price 57. Futures contract price is 58. Go through the question. We will do part 3 first. Go through the question. Okay, what is part 1? Part 2 we'll do it in some time. In part 3 we'll do the table. What is the table? Date, spot, futures, 2 rates of spot, 2 rates of futures, sell button, buy button, actual sale, and we'll see net realization which is happening. Now right, particulars, 3 columns, computation of effective realization. Computation of effective realization. Effective realization, 3 columns, date, spot, futures. Date, spot, and futures. Day 0. Day 0. What's the spot rate given in the question? Day 0. 60. Clear? Futures was quoting at 59. It was technically a backwardation market. 59. Futures was quoting at 59. Okay. He planned to sell 22,000 kg rice. If you plan to sell after 3 months, please enter into a sell contract in the futures market. Enter into a sell contract in the futures market. How many kg of rice we were planning to sell? 22,000. One contract is how many kg? 1000. 22,000 by 1000, exact number I will get. In case, for our discussion sake, okay, this is just for discussion sake, let's change the size of the contract to 3000. This will lead to again some more trouble. Size of the contract, I'm changing it as what? 3000. Just for our discussion sake, we are making it what? 3000 kg. This will impact my realization. This will impact my realization. Below the table, number of contracts sold. Number of contracts sold, 22,000 divided by 3000. I'm changing it as 3000 to explain the concept. What's the number you get? I round it off to. Now this is trouble for me. What is the trouble? I wanted 22,000, but I'm hedging only 21,000. I'm able to hedge only 21,000. What will happen to balance 1,000? You are at the mercy of the market. You are at the mercy of the market. Market goes up, you gain. Market goes down, you will lose. So 22,000 you wanted to hedge, but you're hedging how much? 21,000. Futures, practical world is not always a perfect hedge because of multiple challenges. One challenge is this. I wanted how many contracts? 7.33. Obviously, practical world, you cannot get 7.33 contracts. So you're going to get what? 7 contract. Many a times when we did number of contract in beta, we would have got 4.9, 4.8. We would round off. If you round off to 5, it is not a perfect hedge. It will have still some risk in the company. So we have brought it down to 7. Next, maturity date. Day 90. I have changed the problem as 3000 kg. Okay. Day 90. On day 90, futures, that is, demonstrate the effective realized price if it decides to make use of the futures contract, and after 3 months what happened? Spot price is 57 and futures contract price is 58. 57, 58. Any doubts on the rates here? In bracket, sell. I have sold it at this rate because we said number of contract to be sold. This is buy. Sell and buy. Any doubts on this? Any doubts on this? My plan is to realize exact 59. Exact 59 will not happen here. Reason is on the last day both the rates are not matching. Both the rates are not matching. And on top of it, there is another problem. The other problem which we have is our number of contract is in decimal. Any doubts on these two numbers first? Now below the table. In the futures market, are we making profit or loss? Futures profit is equal to 3000 kg into 7 contracts. We did only 7. Printed answer will be different, okay? Printed answer will be 22,000 exactly. 3000 kg, 7 contracts is what we have done into 59 minus 58. 21,000 profit. Printed answer will be 22,000 profit. Clear? Now you'll have to visualize as if you did not do any futures. You'll have to visualize as if you did not do any futures. If you don't do any futures, what will you do? You will go to the market, sell it at whatever rate is there in the market. Higher, lower doesn't matter. Go to the market, sell it at whatever rate is there in the market. This is what futures does. What futures does is something called as net settlement. What is net settlement? Is on the maturity date, you are not going to get the price which is quoted in the market. You are going to get a net settlement and then get the price put together. It should match a number closer to 59. Here it may not match because 57, 58, 1 rupee difference is there. So your realization may go up by 1 rupee, may go down by 1 rupee. We'll have to do the calculation. I'll repeat again. There will be a futures net settlement which you know what to do. Now, spot realization. Spot realization 22,000 kg into 57 into 57 11 lakh 12 lakh 50 total realization 12 lakh OR divide by 22,000 divide by 22,000 57 point per kg 1275 divided by 22,000. Printed answer will be having 58 per kg. Exact 59 also I can get if on the last day spot rate and the futures rate matches. On the last day spot rate and the futures rate matches, and which ideally should happen also, because on the last day both are same, day 90 rate, day 90 rate. In an ideal world both should match on the last day. When we solve question, if information is not there, we assume both are equal. We assume both are equal. Any doubts on the concept here? Any doubts on the concept? If you see the solution, we are earning 58. How I would have earned 59 is if on the last day, let's assume both are 1 rupee. Both are 1 rupee only. Then also I'll get my 59. What is 59? My original plan. My original plan is what? 59. I press the sell button at 59. If on the last day both are equal. Both are equal. If both are 1. Here my profit is 58 rupees. My profit is 58 rupees. Add 1 more rupee, 59. Add 1 more rupee, 59. On the last day, I'm not saying it should not vary. It should not deviate. Price can even go to 1 lakh also. Only thing I want is on the last day, spot rate and futures rate should match. If both become 65, sell it at 65 in the spot market, and here you will be having 6 rupee loss. Here you will be having 6 rupee loss. Put together you will get 65. Put together you will get 65. Able to understand this? Any doubts in this? Other parts is interpret the position of trader in the cash market. Now understand this very clearly. Why am I planning to sell after 3 months? Let's understand. There is only one reason I would be selling it at after 3 months is today I could be having that rice with me. Today I could be having that rice with me, so that I have entered into a contract to do what? Sell after 3 months. Today I could be having the rice. In the rice industry, normally old rice has a higher value, so maybe I want to wait and then sell it. Or I am a farmer, I have grown the rice, rice is going to be harvested, and after 3 months I plan to sell. So if you are planning to sell it after 3 months, today you are having rice with you. If you have rice with you today, it's called long position. You are having rice with you. I have a car with me and I am entering into a contract to sell the car after 3 months. Entering into a contract to sell the car after 3 months. To put it very simply, I have a long position today in the spot market and I am taking a short position today in the futures market. Short position can give me profit, long position can give me loss, or the vice versa, and I plan to get my original planned number. I plan to get my original planned number. Any doubts in this concept here? Any doubts in this concept? This will become very critical when I go to Forex chapter. Any doubts in this? Can we proceed? Clear? I'll repeat again. What we are doing here is we have two contracts indirectly. One contract I enter in the futures market. Another, I don't enter into any contract, but I have the physical rice with me, physical wheat with me, physical copper with me, and I'm having that physical commodity with me. So technically I have a long position. Any doubts in this? With this, my discussion on futures is over. Question originally also asked, price is 59 in the futures market. You are believing it can go down to what? 56. So ICI says you assume both will become 56 and explain your calculation. If it can go down to 56, if it goes down to 56, I'm very happy. In the futures market, 3 rupee profit. In the spot market, get 56 and get what? 59. Plan is to get 59. Plan is to get 59. So if you see here, trader can mitigate his risk by selling rice futures. Gain on futures portion, 59 minus 56. How will it come? Do it in the table format. Revenue from sale of rice. Together you are earning 59. Together you are earning 59. Plan is 59. Plan is 59. There is a doubt by a student, can futures profit be 22,000 into 59 minus 58? I have changed the problem. I changed the question to do what? 3,000 as the contract size. In case it is 1,000 is the contract size, then entire 22,000 is hedged. I have changed the problem. I have changed the problem to explain the concept. Clear? Any doubts on this? Can we proceed? Any doubts on this? Last part, asset swap. Asset swap is a very rare scenario we do, but there's one question in your institute material. Let me quickly discuss. What is asset swap is? I enter into a contract with you to swap something. What is swapping is, I say I will pay you 1% per month. You need to pay me a percentage which is equal to increase or decrease in gold price. Increase or decrease in gold price. This is a contract we are entering. I will pay you 1%. If gold goes up by 10%, you have to pay me 10%. Gold goes down by 10%, you have to pay me negative 10%. You have to pay me negative 10%. This is called asset swap. Asset swap. A person, or I will say, I will pay you Infosys price increase. You have to pay me ICICI Bank price increase. We will net off and somebody will pay to the other party or somebody will receive from the other party. What is asset swap? Asset swap is very simple what we are going to do in an asset swap is we are going to enter into a contract. We are going to enter into a contract where I will be paying you something, you will be paying me something. I'll pay you something and you will be paying me something. What will I pay you? Decided on the terms of the contract. What will you pay me? Again decided on the terms of the contract. I could be paying some fixed item, receiving a variable item. You could be paying some fixed item, receiving a variable, or both could be paying variable, both could be receiving variable. One variable component has to be there. An example: ABC Limited has entered into a swap agreement on a notional principal of 200 crores. ABC Limited would pay 1% per quarter. ABC has to pay what? 1% per quarter and receive the quarterly return on Sensex. Receive the quarterly return on Sensex. Sensex value on day 0, day 90. What is the increase in Sensex? Can you tell me the percentage increase in Sensex? 5% is the increase in Sensex. What will happen here? I have to pay 1%. 1% of 200 crore, 2 crore pay. What will I receive from the other party? 5%. 5% is how much? 10 crore. Pay 2 crore, receive 10 crore, net amount 8 crore I'll receive. Net amount 8 crore I will receive. It can happen the other way around also. What is other way around? Receive is minus 10 crore. It can be negative also. How it can be negative? Sensex is going down. Sensex is going down. It can be a negative receipt also. It can be a negative receipt also if Sensex is going down. If Sensex goes down, I have to pay 2 crore. You have to pay me negative 10. Net I'll be forced to pay 12 crores to you. Net I'll be forced to pay 12 crores to you. Clear? Able to understand the concept here? Any doubts on this? Okay, in the previous question, there's a doubt by a student saying that why is it long position? Again, I'm repeating here. I enter into a contract to sell in the futures market. Don't confuse future spot. If you confuse, then I can't really help you. I've already told you spot is different, futures is different. I am entering into a sell contract in the futures market. Wordings are very clear in the question. You want to sell. Why are you planning to sell? Now you have to think. Why am I going to sell? Because I already have rice with me. I already have rice with me. If I have something with me in the spot market, I already have rice with me in the spot market. If I have something with me in the spot market, it is technically called as holding or long position. I already have rice with me and I am planning to sell it later. So that is why it is called long position in the spot market. If you confuse saying that why are we doing something different, something here, I can't really help it. I have told you very clearly. Spot different, futures different. Don't confuse both the markets together and unnecessarily complication bring in. Futures we are planning to sell. Word is very clear in the question because you want to sell it after 3 months. In the futures market I am selling. In the spot market I am a farmer. I am harvesting rice. I have rice with me. If you hold rice, rice is your asset. Asset is long position. That is why it is long position. Any doubts on this? Clear? With this, at home you can just practice this question 30, which is on your swap. Exactly same thing, Sensex payment and 1% payment. You just do this at home. Clear? We are done with my futures part. I'll quickly revise the entire futures. Everything covered in the futures in a very simple manner. I hope you have tried the MCQs at home. I did not say in the previous session, but I wanted you to complete all MCQs. If you complete MCQs, whatever I have taught you, you would have kind of revised it. Let's quickly go through this. There are two markets. There is a spot market. There is a futures market. In a spot market, you will be doing spot buying, spot selling. In futures market, you will be doing futures buying, futures selling. Both are different markets. You cannot link them together. If you do something in spot market is shop 1. Futures market is shop 2. You purchase something from shop 2. You cannot sell it in shop 1. Assuming you purchase something from shop 2, he says you can give it back to me. You can return it back to me. You can buy it back from me. Same way you can buy here and return here. Shop 1, shop 2. Spot market will give me spot price. which can be used to calculate the fair futures price. There are two types of futures price. One is called actual futures price and a fair futures price. Any buying, selling, hedging will happen only at the actual futures price. Will happen only at the actual futures price. What is fair futures price? Spot price along with some adjustment will give me fair futures price. How will I calculate the time value of money? Spot price into 1 plus r power n, or spot price into e power rt. Spot price into e power rt, or 1 plus r power n. Spot price into 1 plus r power n, or into what? E power rt will give me the answer. Clear? Any doubts on this? Into e power rt or into 1 plus r power n. In the spot price, if there is any dividend, minus PV of dividend. If there is any storage cost, plus PV of storage cost. 10 dividends, 20 dividends, 30 dividends, R become R minus Y, or R becomes R plus S. How do you compute e power RT values? 1 plus x by 1 factorial, x square by 2 factorial, x cube by 3 factorial, and goes on. What are the variables I need for fair futures price? Spot price, time period, risk-free rate of interest, dividend, storage cost, and compounding frequency. What is compounding frequency? If there is any indication like daily, CCRFI, continuous, or e power value given, we will do continuous compounding. 1 month interest rate, 2 month interest rate, 3 month interest rates, compounding per month, compounding per 2 month, compounding per quarter. No indication. Go ahead and do simple interest or compounding once. Arbitrage gain, compare FFP with the AFP. AFP greater than FFP, futures overvalued. Sell in futures market, buy in spot market, take a loan. Arbitrage gain, difference between higher number and lower number, and vice versa. Cost to carry is the difference between fair futures price computed by us minus the spot price. Dividend yield, same dividend yield, go ahead and take it. Different dividend yield for different months, take the average of your futures valuation period. Convenience yield, extra benefit in the spot price and disadvantage in the futures price. You are saying futures should deserve 1000 rupees, market is saying only 980 is right. So FFP as per formula, FFP as per question, and that is called future value. You want to bring it to present value, discount it at the rate given in the question. There can be continuous discounting or normal discounting. Implied risk-free rate is whatever is the normal risk-free rate plus arbitrage gain, because that is extra for you, plus arbitrage gain divided by the spot price into 12 by M into 100. Physical settlement and net settlement. Physical settlement means on the last day, deliver rice, get 59 rupees. Or net settlement. What is net settlement? Do the difference and sell your rice in the spot market. Sell your rice in the spot market. Market mostly goes through a net settlement route. Two types of futures market is there. One is called Contango market and second is called backwardation. Contango is upward sloping, futures more than spot. We saw that rice example, it was a backwardation market. What is backwardation? There in that case, spot was 60, futures was 59. Beta is equal to standard deviation of security by standard deviation of market into correlation coefficient, or standard deviation of spot by standard deviation of futures into correlation coefficient. This can also be used to find percentage change in share price. How will you do? You are going to do percentage change in market into beta, percentage change in market into beta. And I may want to do a hedge, perfect hedge, 0 beta, full hedge, 0 beta, target beta, write the beta given in the question. Percentage 10%, beta minus 10%, 20%, beta minus 20%. Format, security, beta, weight, product. In the security, write various security, beta, various beta given. Nifty will have beta of 1 time. In the weights total, Nifty futures, BSE futures, copper futures, index futures will not come in the total. Product is column 2 into column 3. Keep playing around the format, you will get to your answer. Keep playing around the format and answer will come. When you are doing hedging, number of contracts is always computed based on actual futures price. Any positive value in the table indicates buying, any negative value indicates selling, be it for a security or be it for futures. Normal rate can be converted into CCRFI rate using natural log value, CCRFI into normal rate using e power X values. Modification of beta can also be done through risk-free rate or borrowing, risk-free interest rate or borrowing investment. Which format? Security, beta, weight, product. Only thing you need to decide is, are you going to borrow more? That is, are you going to buy more shares or keep the shares intact? Are you going to sell shares or keep the shares intact? This we saw, when we did problem, we saw if you buy something, buying something is called plus, price goes up is plus, plus into plus is profit. You buy something, price goes up, profit. You buy something, price goes down, loss, plus into minus. You sell something, minus, price goes down, minus into minus is profit, minus into minus is profit, and the other way around. We have seen this when we did problem. Buy something, price goes up, profit. Sell something, price goes down, profit. Other way around, there is a loss for the investor. Net realization concept basically says that whenever I enter into a futures contract, it will always be net settlement. You cannot go to the stock market and say, I give you 22,000 kg rice, give me 59. He says, nothing doing. We will do net settlement. You go to the spot market and sell your rice there. In this process, I may sometimes get a little different value than my original plan. Ideally, that should not happen, but sometimes it may happen. When it is happening, it is more because of market inaccuracy and not the problem with the hedging mechanism. Clear? So my final payment or realization is spot payment plus or minus futures profit or loss. Spot realization plus or minus futures profit or loss. If you are paying two things, add the two things. If you are receiving two things, add the two things. One payment, one receipt, net of the amount. So you may gain in if you have a realization in the spot market, and in futures you have a loss, deduct and write the amount. Asset swap basically says that you are going to swap your returns from one security with the other security. It could be one security like a fixed deposit, which is 1% per quarter, along with the variable element, or it could also be that you are going to do, instead of one with the variable, you may do ICICI Bank with TCS, ICICI Bank with Infosys. You need to know who is paying, what are you paying, what are you receiving, and do the net amount. Any doubts on this? Can we proceed?